Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Lots to talk about. Tariffs, of course, top of mind, top of conversation. Once again, Indonesia this time. Ray of hope, question mark. I'm Prashant. With me, my colleagues Nigel and Rima is with us today. Guys, good morning.
Hi, but still waiting the India-US trade deal, right? I mean, at least for Indonesia, it's come down, the tariff rate to 19% from 32%. But India remains a question mark.
Well, that's right. And it's not a Wednesday, right? We're getting used to Trump saying big, beautiful Wednesday morning. So spoke about coal last night as well. It's not just coal, big and beautiful as well.
So it's the right attitude to start your day, right? I mean, big and beautiful. Why not? Well, let's just quickly take a look at what you need to know as you start another trading session. So let's take it from the top. So President Trump essentially said that Indonesia will pay a 19% tariff after securing a trade deal. So 19 on Indonesian goods, 0 on US goods. But this is the thing. The letter which was sent to Indonesia earlier had 32% as the tariff rate. And that's the point here. So that 32% in a few days of negotiation, back and forth, etc., has come down to 19%. And that is the reason why I'm saying a positive sign, perhaps, for those who got letters and are negotiating. The important point is those who got letters and are negotiating. So two countries in particular, there's Philippines and there is Thailand as well, if you can move this along. And of course, I mean, it kind of also confirms the market's view that higher tariffs will be revised lower. Eventually, higher tariffs will be revised lower. The Indonesian deal also shows that eventual US tariffs will come off but still remain high, around the 20-odd% mark. Of course, I mean, the market expectation is that end-state tariffs could be between 10-15%, but that's moving up. Will it finally land up at around 20%? We'll have to see. It'll be a big jump because, I mean, when Trump took office, I think that number was about 3%, 4% or so. Of course, President Trump also hinted that there will be a couple of more deals announced soon. He hinted that India is working along the same line as Indonesia. But of course, I mean, we didn't get a letter, so we are kind of sort of starting from scratch. We don't know where that process is at this point in time. If the Indonesian deal, as President Trump himself said, is any indication, I mean, we'll see how this one goes. But markets, of course, are not holding their breath. I mean, I've said this before as well. It's not as if tariff news flow is really moving markets in a big way. 30% on the EU over the weekend did not move the euro or the dollar in a meaningful way. So I think not very much else will. That is as big as it gets in terms of trading partners and a big tariff being announced there. US equities last night, I mean, they sold off a little bit. S&P was down 0.4. The Russell was down about 1.9% as well. But, again, a little bit up, a little bit down, but broadly, I think it is the markets remain pretty constructive. Nvidia, of course, continued to drive the Nasdaq outperformance. The Nasdaq actually ended higher, unlike what the S&P or the Russell did. The 10-year, it was up about 5 basis points. We're back to about 4.5%. The dollar index is bouncing around about 98.5 odd on the broader dollar. So those are sort of roughly levels we are looking at. Macro markets, I mean, largely remain. You get these bouts of uncertainty and huge moves, and then the market cools off and does nothing for long periods of time. That's essentially what we've seen in 2025. I'll just circle and tie in the levels then. Yesterday, of course, the market. So Friday was a big corrective day. Nifty lost 200 points. Monday, of course, the market came off a little bit as well. Yesterday, we got a bounce. We'll need to see if the correction, it's a short correction, it is complete or not. And if it is complete, then the low of 25,001 should not be broken, and it should hold. And on the upside, I mean, the 61.8% retracement of this very short fall is 25,400, a very immediate kind of level on the upside, which we'll need to sort of climb up above. For the Nifty Bank, similarly, the support is 56,594 on the downside. Bank Nifty, of course, also ended high yesterday. 57,628 is that same upside level for the Nifty bank, which we need to climb up above for the market to look a little more constructive. So in that sense, an interesting kind of day. GIFT Nifty is indicating 80-odd point lower start once again. Rima.
So pretty much giving up yesterday's gain. So yesterday, the Indian market snapped a 4-day losing streak to end higher by about 110 points. The mid and the small cap indices outperformed, gaining for the second day in a row, up 1% on that. But let's just quickly take a look at the top cues that are shaping trade today. First, on the flows, the DIIs and FIs net buyers. The DIIs buying close to about 1,500 crore in the cash market. FI buying muted at 120 crore. On the global radar will be key prints from the US, the PPI index. We had the CPI print yesterday. Now the producer price index will be tracked, the industrial production and the Federal Reserve beige book. On the earnings front in the United States, big banks will continue to report their numbers. Overnight, we had numbers from JP Morgan, Citi, Wells Fargo. Today, it's going to be Goldman Sachs, Bank of America, and Morgan Stanley. Back home, earnings reaction, and we'll discuss them in top 10 in greater detail, but HDFC Life, ICICI Lombard, HDB Financial Services, Network 18 just dialed. And amongst the big ones reporting numbers today, in the Nifty pack, only one. Tech Mahindra. But outside of that, LTTS, that's L&T Technology Services, Angel One, ITC Hotels, Orient Hotels, and Ixigo. And Glenmark, after that big deal, will be holding its investor day today. And finally, on the India-US trade deal front, a fresh round of negotiations is currently underway in Washington with the Commerce Ministry team on ground. And Chief Negotiator Rajesh Agarwal is set to join the talks today, as both sides are hoping to, finally get that deal going. So those are some of the big things you need to watch today. But Nigel, what are you looking at?
Well, in yesterday's trading session, though the Nifty has been consolidating for the last few days, the good part is the small cap index put on another %. And for this week itself, if you look at the small cap index, well, it's gone up 1% each on both the two trading sessions, and it's at a 6-month high. So that's pretty good news. Good close is what we saw on the small cap index. Well, what about, the other positive for me yesterday was that after a while, we made a higher high. So all these trading sessions, we were making lower highs. And yesterday, in fact, it was a little bit higher. So that's good news, in fact. You'd like to make a higher high. Today, I know the Nifty is going to be starting off in the red, but maybe this is the level that you should be looking at. We like to make a higher high yet again. So we'll keep an eye out on that front. What about the FIs? Well, they added some mild shorts. The clients, though, they are piling on the longs. And if you just take a look at the chart, you'll see that the client positioning, well, it's moving towards that 1 lakh contracts on the long side. While on the short side, the FI short positions, well, they're holding at around 1.21 lakh contracts. As I've been saying in the past, this is the combination normally that you like. But the FIs, having some shorts in the system, gives you a bit of a cushion, provided things don't go horribly wrong. And in percentage terms, the FI short positions are at around that 81% or thereabouts. Well, the options data should come up for you on the screen. And, if there was some put writing yesterday. So we saw a bounce from the lows. So today it will be challenging to see whether or not these puts are unbound, because yesterday there was some writing that we saw both at the 25,200 put, 25,100 put as well, which brings us to the levels that we're looking at. Well, in terms of a support, the 24,950 and 25,000 mark is important. Here's where the 50 DMA comes in at. Here's where, in fact, you have the recent low as well. And it's almost a 50% retracement of that entire move that we saw, from the lows to the highs and then the pullback. So this level, this range is very important. On the upside, as I said, yesterday's high will be 25,245 or thereabouts. But the 20 DMA, that becomes the line in the sand. The Nifty bank, that'll have to lead the way. And that's actually been doing that. And it continues to hold above the 20 as well as the 50 DMA. So that's why, in fact, this one is the one that will have to hold its ground. Till these levels are protected, you'll have to say that the Nifty bank is in a good space. Stocks that I'm looking at, Biocon, the last few years, the stock actually has been a relative underperformer. But they have got an FDA nod for the biosimilar, that's insulin aspart. And, that has a very, very large market out there. So we'll have to keep an eye out on this one. There was some bit of pre-buying that we saw yesterday. So Biocon is one stock. And the other one I'm looking at, is Bombay Dyeing. Yesterday, we had massive delivery-based buying on this particular name. And it conquered the 20 DMA on a closing basis as well. So cash market stock, we'll keep an eye out on this one. Much higher delivery-based buying is what we saw on this name.
Okay, on our radar is Bombay Dyeing. Thank you for that. Let's get to the equity calls then. Venugopal Gare of Bernstein says, while the strain is evident and the government appears to be relatively quieter than they were in NDA 1 and NDA 2, a supportive base, improving liquidity and limited risk from global sources should continue to support a 6.5% range for the economy this year. He says they do not see India in a phase of collapse that we had in the middle of last year, protecting downside risk. He expects some more returns for the Nifty, and their year-end target stays at 26,500, which is another 5% return in H2. From a sector perspective, he says they shift some weights from utilities to staples, moving it into a tactical overweight for a short period. Utilities moves to an equal weight, and they stay overweight on financials, telecom, small discretionary.
Ed Yardeni is with us. He's president at Yardeni Research. Ed, good morning. Great to have you back on the show and on the program as well. This Indonesian deal, 19%, the letter said 32%. How should others who are kind of waiting to negotiate read this? As I was saying earlier, I don't know if it's the right way to look at it, that maybe, there is room for negotiation, but eventual tariff rates are looking like they're going to be closer to 20%, so very high, still very high.
Yeah, still very high, and I think the president has a number of objectives when it comes to tariffs. One of them is to raise revenues, and he's clearly very pleased with what he's seen so far, because at an annual rate, over the past 3 months, we've seen customs duties up at an annual rate of $300 billion. Plus, a little bit higher than that, actually. So I guess he's figuring if he can get that with 10%, then with 20%, he could get $600 billion. And if the rest of the world is okay with it, then that's what it'll be. But at the end of the day, it's not Indonesia that's going to pay that. It's going to be American consumers. It's going to be American companies. Some Indonesian companies may give a break to their American customers and eat some of that tariff, but for the most part, it's a tax on Americans.
And the new tariff rates are much higher than the base case that most investors and economists were expecting. But despite all that, Ed, markets have been very well behaved. It's been a very muted reaction in the financial markets. So what do you make of that? And what are your clients saying, thinking, acting now?
Well, I think my clients are kind of reflecting what's going on in the market. They're a little bit more relaxed than they were back in April about what's going on with tariffs and its impact on the market. I think one of the reasons the market is doing so well is because people have come around to kind of a view I've had for really the past 3 years, and that is don't bet against, don't underestimate the resilience, the strength of the U.S. economy. It put up with a dramatic increase in the federal funds rate, a dramatic monetary tightening, and yet we did not have a recession. And here, so far, knock on wood, so far so good. We've had a situation where the tariff turmoil that we've had so far doesn't look like it's really causing a recession. So I think there's just more confidence that the economy is resilient. And not only that, but earnings were very good in the first quarter. And now there's expectations that the second quarter could also see earnings beat expectations because they've been knocked down so low, it's not going to be that hard to beat them.
Hi, Ed. Good morning. Good to see you. When, just looking at a couple of estimates, and earnings season in the United States is expected to deliver 4.3% growth, which will actually be the lowest growth we've seen in multiple quarters. And yesterday, the earnings that we got in from some of those banking names, Wells Fargo, JP Morgan, BlackRock, some of them were digested as a bit of a miss. So how do you see, earnings pick up from here on? Do you believe that that earnings will actually be better than what the street was working with? Point number one. And point number two, just wanted your comment on the inflation print that we got in yesterday. I think you're in the camp that believes no more rate cuts, right, coming in from the Fed in this year. So just want to comment on that as well.
Well, sure, absolutely. So the bank earnings look just fine to me. I think the reason the bank stocks didn't rally on them is because they already rallied. I think there was a lot of expectations that the banks would do just fine. The bank stocks have already discounted a lot of the good news. And the number I'm looking at is like 3.5%. Maybe you're right. Maybe there's another number out there, 4.5% for year over year as the current consensus of analysts. But they always tend to be too pessimistic, almost always tend to be too pessimistic. And I think it's going to be double that. I think it's going to be 7% on a year-over-year basis. So I think we're going to beat that. And that's exactly what we did in the first quarter. Now, with regards to the Fed. The CPI today came in warm, not hot. Came a little bit stronger than anticipated, but we're looking at a CPI inflation rate on a core basis, excluding food and energy, of close to 3%. I think what the Trump tariffs have done is they've kind of stalled out. They've forced the decline in the CPI inflation rate, which was heading down to 2%. Looks like it's stuck now around 3%, which is not what the Fed wants to see. The Fed wants to see that inflation's continue to moderate to 2%. If it's stuck now at 3%, all the more reason why the Fed will not be in any rush to satisfy Donald Trump. I mean, there's no way they're going to give him a 1% Fed funds rate when it's 4.3% now. And there might be no way that even if he gets rid of Powell, that the remaining consensus on the FOMC, the Federal Open Market Committee, will in fact, again, lower rates. So I think rates are where they should be.
Yeah, no, absolutely. Ed, two very quick points, if you can respond. One, of course, is I think there were some comments from the Treasury Secretary last evening, but where he said that, well, I think he kind of sort of pushed back on the idea of this shadow Fed. He said it'll create confusion. So that is one, if you want to sort of weigh in. Second, of course, is NVIDIA being allowed to sell these high-end chips to China once again. And NVIDIA was the reason NASDAQ was higher last night.
Yep.
So does that show a bit of thaw in that relationship? Or not really?
Well, I think what it shows is that everything is negotiable and everything can be renegotiated a few times. So the head of NVIDIA went to see the president and convinced him that the chips that NVIDIA wants to sell China are not state of the art, and at any rate that the Chinese are going to develop their own chips if we don't sell them our chips. So the president understood the logic of that and agreed to it. So, yeah, I think it shows some indication that we're willing to be flexible on some of the issues with China. But to a large extent, it was the president responding to an American company saying, hey, look, we're going to be number one no matter what, and we might as well sell to China. What was your other question?
The Fed, the shadow Fed. I think he, yeah. I mean,
it's a crazy idea. It would be extremely messy. I'm not quite sure what Trump's goal is here. I mean, he says his goal is to get rid of Powell, but I'm wondering if his real goal is to pound the dollar, because every day that he beats up on Powell, the dollar goes down. Now, I happen to think the dollar's bottomed here, and that the markets are starting to get a little bit bored with these attacks on Powell. And the markets realize that it's a committee at the Federal Open Market Committee. And so even if Powell is replaced, it doesn't necessarily mean that the Fed is going to give the president what he wants. But I also heard that there's some rumors about the possibility that Treasury Secretary Bessent might also be appointed the head of the chair of the Fed, which would be kind of a strange situation, because that would certainly muck up the credibility of the Fed as being independent. But I mean, my advice to the president is you've accomplished a lot. Go on the campaign trail for the midterm elections and leave the Fed alone. You don't need lower interest rates. The economy is doing just fine. Yeah, save lower interest rates for when we really need them, and do something about the deficit that's really, reduces outlays and increases receipts.
On that subject about Scott Bessent being the Fed chair, I think Bloomberg ran a story after that saying the U.S. president stated that Treasury Secretary Bessent is an option for the post, but not necessarily the top option, because he likes the job that Bessent is currently doing as the Treasury at the moment.
Okay, all right. Well, we'll thank you, Ed, for joining in and giving us your view on the markets, economy, as well as on earnings. And guys, by the way, it wasn't a big, beautiful bill. He spoke about coal yesterday. He said it should be called not coal, but clean, beautiful coal. So he changed it around from the big, beautiful to now clean, beautiful for coal itself. Quite interesting. Coal, clean and beautiful.
Well, I think you can rebrand anything, right?
Yeah.
You say it often enough. Well, let's just quickly run you through the interactions which are lined up here over the next 2.5 hours or so. This is what's coming up. 8:35, we'll hear from Karan Thorani, Villara Capital. We'll discuss, of course, what's happened yesterday. Karnataka capping movie tickets at 200 rupees. 9 o'clock, we'll have Jai Kale Villara to talk to us about the key trends in the auto space. 9:20, Samir Arora of Helios will join us. He's a market master of the day. 9:30, Bhavesh Shah of Equirus and Rahul Modi of Ambit will be with us to discuss pickup in M&A activity, the key drivers and likely trends. And following that, Praveen Sahai of PL Capital speaking to us at 9:40. Expectation of the consumer sector for the first quarter, that's QSQT. A little later, 9:50. Gopal Balachandran of ICICI Lombard talks to us about the numbers which came through yesterday. And towards the end of the program, Lata in conversation with the management of Bank of Maharashtra on their first quarter earnings.
Time to slip into a quick break. We've got a lot of stock-specific action to track for you today. We get to that in just a bit in our special Top 10 segment. We're looking at ICICI Lombard, Just Style, Biocon, Dixon, Zydus Life and Kotak Mahindra Bank. All of them will be reacting to positive news flow. But on the flip side, you'll have HDFC Life, HDB Financial and PVR Inox. They are stocks that could open in the red, while Hathway Cable could see a flattish start. Get into that break, come back, we'll get into further detail on all of these names.
Welcome back. Our research team is now standing by with CNBC-TV18's list of top stocks for the day. First up, let's get a handle on all the insurance numbers that came through. Yash, tell us about HDFC Life.
Well, the numbers for HDFC Life looked good as far as the top line is concerned, but the disappointment has come through because of the margin performance. To be specific about the numbers, the new business premium, that came in exactly a little below what the street was anticipating. So the number that came through was about 7272 crore. The poll that we were working with was about 7489 crore. Total AP was also a little ahead of the street estimates. Retail AP, again, being a little ahead of the street estimates. But as I said, margin was that little disappointment which came through. Margins came in at 25.1% versus the poll that we were working with of about 25.63%. So about 50 basis points miss as far as the margins concerned. The stocks rallied very hard in the last 3 months and 6 months. And hence, that small margin disappointment could actually turn out to be a little bigger than just being small as far as the stock performance today is concerned.
Okay, all right, Yash, thanks a lot for that. Yash, but you want to tell us about another company as well? Lombard as well as a stock that you're tracking?
Well, that's correct. So strong numbers coming in from ICICI Lombard. The net earned premium, that saw strong growth of 14%. Underwriting profits, underwriting losses rather, they reduced to about 293 crore versus 346 crore on a year-on-year basis. Operating profit, that grew by about 30% at about 654 crore versus 501 crore. And importantly, combined ratio, that saw a slight dip, came in at about 102.9 versus 102.3. So the numbers overall for ICICI Lombard looked very strong. I'm going with green as far as that company is concerned.
Got that. Let's talk about Just Dial. Well, Just Dial was an okay set of numbers. Not very bad, but there was nothing to excite the street. The company on the top line reported a revenue growth of about 3% quarter on quarter. On a year-on-year basis, it was a growth of about 6.2%. And that's broadly been the growth trajectory for the company. If you look at it, so this quarter, year-on-year revenue growth was 6.2%. Before that, it was about 7%. Before that, 8.4%. So in a way, growth has slowed down. But again, Q1 was, it's an okay set of numbers. Margins have come in at 29%, slightly lower than the 29.8% in the prior quarter, and profits have been on the flatter side. Paid campaigns growth stands at 4.3% on a year-on-year basis. Cash in the books continues to remain healthy, nearing 5,500 crore rupees. So all in all, okay set, a bit slow. But even Just Dial's growth has slowed down to single digits and now mid-single digits. But Ekta, what about Biocon?
Well, yes, Biocon is in focus because they've received approval from the US drug regulator for insulin aspart, which is basically a biosimilar insulin, which they have been awaiting approval for a couple of years now. Now, remember that this approval is for the first and only interchangeable biosimilar to Novolog, which exists, which is basically insulin aspart. This particular insulin aspart has been available in Europe and Canada since 2022. But remember that Biocon had faced some issues with regards to the US FDA approval because they received a complete response letter for this particular product approval for deficiencies at their facility in Malaysia, which is where it will be manufactured. This took place in 2022-2023, but eventually the Biocon Malaysia plant was re-inspected in September 2024, and now they've cleared any kind of queries in the CRL, and that's the reason that they've received approval from the US FDA. $100 million is what they could make on a conservative estimate. Depends on the dynamics. It could go up to around $300 million for Biocon as well.
Okay, all right, Ekta, thank you very much for that. PVR Inox is the next one we want to focus on. Vamakshi's got details on this one. Vamakshi, morning.
Good morning, Prashant. Well, not very good news for PVR Inox, and that is because the Karnataka government has, in a draft notification, proposed that movie ticket prices should be capped at 200 rupees. Now, keep in mind that this is only the draft notification, so a time of almost 15 days has been given to the public to submit their feedback on this proposed, proposed regulation. But this could be, if this does go through, it could be a negative for PVR Inox, and that is because almost 40% of PVR Inox screens are located in South India, out of which almost 12.3% are in the state of Karnataka itself. Now keep in mind that earlier on, when PVR Inox did speak to us, they were betting big on the southern market because average occupancy here is above what the consolidated level for the company is. It's at almost around 30%. Now keep in mind they had also highlighted some plans to expand in the southern markets. So they were adding almost 100 screens, out of which 40% of the screens were in the southern markets. So therefore, given this kind of cap, it could put some pressure on the revenues as well as the average ticket prices, going with the red for PVR Inox.
But I'm sure the industry will challenge this. In fact, a similar such measure was implemented or announced by the government in April of 2017. I was just reading what Karan Taurani, his view is. A similar measure was implemented earlier by the Karnataka government in April 2017 when it introduced a cap of 200 rupees on movie ticket prices across all theatres, including multiplexes. However, the film exhibition industry challenged the decision in court and in 2021 secured a favourable verdict from the High Court, which allowed exceptional pricing for luxury and special formats. But this one will be on the radar for sure. Dixon Tech, that's going to be interesting. Vinny, what's the news and the importance of this development?
Absolutely. So positive news coming in for Dixon Tech this morning. What Dixon Tech has done, couple of news flows. One, they've acquired 51% stake in Q-Tech India. This is going to be through primary as well as secondary investments. And Q-Tech is among the top 5 camera module suppliers globally, and in India, it's the largest amongst this camera module suppliers. Now, obviously, this is a significant step that comes in. Why? Because one, it's that backward integration which the company has been focusing on, and this will add value to that smartphones backward integration that the company has been focusing on. Now, other than that, the second news flow that also came in was that the company is going to be forming a JV with Chongqing, which is a company which is mainly into component manufacturing, precision component manufacturing. What is this used for? This is actually going to be used for components for laptops, mobile phones, in terms of automotive applications, etc., where they can use these components for. Now, this is going to be a 74 to 26 JV. Dixon will be holding 74, and the other company will be holding 26% in this JV. So, backward integration is what the company has been focusing on, and in the recent time also, they've done a lot of backward integration. They had also made an JV with HKC as well. So that is the focus on a positive coming in there for Dixon Tech this morning.
All right, thanks a lot for that, Vinny. And, I was reading a DAM note that suggested that value addition as a percentage of their mix was at around 15%. They're expecting it to go to 35% by FY27. Good on you, Vinny, with regard to that pronunciation as well. Thanks a lot for joining in. Let's wind this down, though, with Ria on some stocks in the news. Ria, take it away.
Well, yes, Nigel. First up, we're keeping an eye out on Hathway Cable after their Q1 FY26 numbers. This time around, the net profit has jumped up by around 69%, and the strong growth in net profit has largely been driven by other income. Margins have also been driven by dealing in securities and not from the core business of the company. And it's important to note that the cable TV business, which drives most of the revenue for the company, is still loss-making on the EBIT level. So mixed set coming in for Hathway Cable. Moving on, Zydus Life will also be in focus today. They've received the final approval from the US FDA for capsules that are used to treat arthritis. So stock expected to open in the green today on the back of that. And the last one is Kotak Mahindra Bank. The president and the chief credit officer of the bank, Mr. Shankar, has tendered his resignation with effect from the 21st of July of this year.
Thank you very much for that. And finally, HDB Financial, the newest kid on the block. Let's see what their numbers showed up. Gaurav?
Well, yes, HDB Financial reported its Q1 numbers, and let's look at it in two perspectives. On a weaker side, we saw asset quality and disbursement, and on a stronger side, we saw net interest margin. So first, let's look at the numbers. Net interest income has increased almost by 18%. This is also reflected in its net interest margin, which expanded almost by 10 basis points. But on the other hand, credit cost has increased again on the back of some stress which is rising from the CV loan, and that is the reason when we look at profitability, there we saw a decline of around 2% on a year-on-year basis. Now, what company has said is that the disbursement slowdown and as well as some stress in the asset quality is because of the CV loans, and on back of this, we will be watching out on the other counters as well. But what company has also said is that the net interest margins are likely to expand even further, and the reason being that 90 to 95% of its book is EBLR linked, and with rate cuts, this will be passed on further in the net interest margins, and that is the reason why they believe that ROAs are going to expand. Let's not forget that ROAs have also come down to 1.9%. But there is an impact of the recent fundraise, and if we exclude that, the ROAs has remained around 2%. So definitely on the weaker side, we have seen some aspects, but on the back of the positive commentary, we will be watching out on this stock.
All right, Gaurav, thanks very much for that. You know, what you do is take a quick commercial break here, but here's a quick recap of the stuff that we put out in terms of stocks. ICICI Lombard, Just Dial, Biocon, Dixon, Zydus Life, and Kotak Bank are stocks with some green based on, of course, the news. HDFC Life, HDB Financial, PVR Inox likely to open in the red again based on news flow. Hathway Cable kind of flattish. Well, we'll quickly turn to commodities now. What's top of mind, what's making news, and what's keeping Manisha occupied. Manisha, good morning.
Morning, Prashant. Thank you for that. Well, the energy as a space seems to be doing well. After 2 days of decline, crude oil prices are trading in the positive again. There is improving demand signals coming in from US and China. It is also about strong summer travel, rise in gasoline consumption, and Chinese data coming in better than expectations. OPEC report that came in yesterday also is projecting strong global economy in the second half. And it's not just crude. Within the energy space, you have the coal futures trading at a 5-month highs. This is after Chinese government has mandated plants to increase stockpiles by 10%. That immediately has taken the prices higher. But barring energy, everything else is into slight profit-taking. Silver, after hitting 14-year highs, has seen a decline. It was down 1% in the overnight markets. Copper prices also are trading 0.5% on the weaker side, and that pretty much is the case across precious metals and base metals, which are trading marginally on the weaker side at this point.
Thanks a lot for that, Manisha. Well, we'll slip into a short break. On the other side, we have Deven Choksi of DR Choksi FinServ, who will join in for some fundamental stock talk. Well, multiplex operators are in focus. The Karnataka government has issued a draft notification to cap the movie ticket prices at around 200 rupees per show across the state. The proposed rule would apply to all theatres, including multiplexes, and cover all language films. The cap is inclusive of entertainment tax. To discuss this and more, we are joined by Karan Turani, the EVP at Elara Capital. Hi, Karan. Good morning. Thanks a lot for joining in, Karan. Well, the stock in focus today is going to be PVR. So if you could tell us what kind of exposure do they have in terms of number of screens, how much of their revenue profitability comes in from Karnataka?
And Anjali, good morning. I think PVR Inox has got a reasonable amount of exposure in Karnataka as a state, largely because of Bangalore being a metro city. If you look at the screen share, around 12 to 13% of the screens are in the state of Karnataka. And if you look at the overall box office market in terms of revenues, if you put regional and Hindi languages put together, it is anywhere in the range of 10 to 12% of box office revenue coming from there. So I think this news will definitely have a negative impact on the overall ATP for PVR Inox. 30% is the downward revision. The average ticket price for PVR Inox today is about 260 rupees. If we go by this ATP cap of 200 right now, there's a 30% downward revision on 12 to 13% of your revenue exposure, which means there's a 3 to 4% kind of a revenue negative impact. And in terms of EBITDA, you could see a downgrade of anywhere in the range of 2 to 3%.
This has happened in the past, right? In April of 2017, also, the Karnataka government had introduced this movie cap. What happened then, and what parallels can be drawn from that episode?
So I think even right now as we speak, the order has been passed, but they've given a 15-day window here, for getting public opinions and try to basically see whether or not they should be implemented. So there is some kind of grace period. I think exhibitors will try to lobby hard for this move not to happen. Now, in the past, when it happened, they had gone to the court and appealed. And that time around, this order was rolled back. This was, I think, in 2017. If you look at South as a market now, I think most of the states in South have got a ticket price. If you look at AP, Telangana, they have a ticket price more towards 200 rupees. If you look at Tamil Nadu, they had 160 rupees ticket price since many years. So most of the regional markets do have a ticket price cap, which is already there. The bad part for the multiplexes is that the timing, right? So had this come about 6 to 7 years back when occupancy levels were great for multiplexes, some bit of negative impact of ticket prices could have been offset by higher occupancy. But as we're seeing right now, the industry is really struggling for occupancy. There's a structural dent right now. Occupancy levels fail to revive towards more than 60-70% of pre-COVID levels on a steady state. And secondly, also you have to put in the fact that exhibitors are expanding aggressively in the South market. So more than 50-60% of the new screens are coming in the South market, which means that there are more concerns for them. So I think we'll monitor these two things from here on. And if at all this order is passed, it's going to be a huge negative for the exhibitors.
All right, Karan, personally, I'm hoping that a film that releases in Karnataka over the weekend does well. Due disclosures on my part as well. This weekend itself, Junior is the film that I'm looking out for, which is releasing in the Kannada market. That said, is there a risk of contagion? Other states as well looking at this price cap, which as you said, occupancy has been low. And then, in fact, you have a price cap. That's a further dent, right? Do you see that risk playing out, or do you think it will be restricted to the south part of India?
So predominantly over years, we have not seen these kind of caps in the northern, the western, the eastern markets. It's predominantly there in the south market as well. So we don't foresee any risk as such of this coming into other states as of now. Why it is there in South is because obviously South, there's a huge fan following. There is a star power. People really want to go, and people actually, the government actually wants to make cinema an affordable medium in terms of consumers. And typically because of the ticket price cap, the occupancy levels are almost 1.5, 2 times in the South market as compared to the Northern and the West market put together. So we don't see an extension of this coming into the Northern and the Western belt as of now. But yes, even in South market, as I said, because the expansion initiatives are so aggressive right now, because you'll see more screen additions in the South market, this will definitely have a negative impact right now and going ahead as well.
So 2 questions, Karan. One from an PVR point of view, PVR Inox. Now they are planning to expand aggressively in South India, including Karnataka. Will this derail their expansion plan, even if it's a franchisee-led model? And 2, your own target price is 1,100 rupees per share, I think, on PVR Inox. Now you're talking about a revenue EBITDA impact of 2 to 3%. So if it gets implemented, going with that assumption, how would your target price change? And what is the advice now to shareholders?
I think firstly, if it all gets implemented, there's not going to be a big change in terms of target price. The only thing is the valuation de-rating that we'll see for the company. If you look at the EV/EBITDA pre-Ind AS valuations, the revenue has been below par since almost 1 year and a half, right? That's primarily because of content not being consistent, primarily because of occupancy levels not being up to the mark and profitability concerns as well. So we see valuation multiples may not be able to move up beyond a point because the structural dent, it is not like a 1 year thing which will have a negative impact. Things will kind of, come back. Things could have come back. As I said, had this been 5 years ago, occupancy levels could have kind of offset negative impact of the ticket prices. That could have been a scenario. Second thing on the expansion plans, definitely I think they'll relook the expansion initiatives given what has happened in Karnataka, because as I said, because of Bangalore being one of the top metro cities in the country today, they will have to relook at the expansion plans in Karnataka going ahead.
Yeah. The angst mostly on social media, etc., is not about ticket prices, it's about popcorn prices, usually. But yeah, I mean, we'll see if this does go through or not. And it could be, I mean, if it does go through, then it's a kind of a signaling effect in for other states, etc. as well, right, Karan? Possibly. We don't know.
Very low likelihood, because predominantly since many years, 10, 15, 20 years, we haven't seen the northern west market states behave this way. These kind of ticket price caps have only been implemented in South. So it does not have a spillover impact, but because, as I said, regional content has come up in the post-COVID. Regional content contribution in the pre-COVID times was below 30-odd% for the exhibitors. Today is more than 40-45%, and even more than 50% when you see a large film like Pushpa coming in. So I think, this will definitely have a negative impact in terms of their box office revenue growth, in terms of the valuation multiples.
Got that. Thank you very much, Karan, for running us through, how to think about this one. So valuation de-rating if it goes through. But we'll, of course, an important point, this is sort of this kind of stuff only from southern states, but we've not seen those from northern western states, which are the other bigger and crucial markets for these companies as well. Devin Choksi is with us at DR Choksi FinServ. Devin, good to have you on the program as always. Thanks very much. Just a quick word on the market itself. Directionally, Devin, do you have a strong view? Is this corrective kind of phase over, or you think there is more to go on the downside in absolute sense?
Good morning, Prashant. Well, I think initially, maybe in the near term, we might see some amount of sector churning. We might see some amount of pressure on some high value stocks. And maybe post sector churning exercise gets over and the positions built by most of the large players, I would like to think that the market would possibly assume the higher trajectory. Crucial levels at Nifty are 25,200. And I think that level is sustained. Then possibly we would see a continued rally going as high as to around 30,000 in a course of around 12 to 15 months. So certainly the reason to remain bullish is also because of the fact that current year has started on 2 or 3 promising notes. On one side, we have the lower amount of cost structure, which is promising better profitability for most of the companies in general. That's what we are expecting. Second, the business scenario remains absolutely strong and convincing, where the demand outlook for most of the businesses and the companies therein, they look relatively very strong, and as a result of which, we are seeing the growth on that side as well. And last but not the least, the higher amount of inflow of money is also coming into the market. Look at the number of IPOs coming into the market. The flow of money is regular, and more particular going into some of the high growth or the fast growing areas. So in that situation, we believe that the market has a support of liquidity, market has a support of fundamentals as well. And that's where probably we should be seeing the higher trajectory for the market going forward.
One of the important stocks of the day could be Dixon, as it enters into the camera and fingerprint module manufacturing after acquiring a 51% stake in QTech India. What have you made or your team made of this development for Dixon?
Yes, the amount of business that they would be possibly adding into the top line would be significant in the given situation under this acquisition. because it's a 51% acquisition. So obviously the business gets added into the consolidated level. So that is one strong point I think which one can expect. Not completely sure about how much I think improvement in the profit margins that the company would have going forward. As far as I think the buying opportunity is concerned, yes, there may be small upside definitely there in this kind of a news-driven activity. But to me, I think everything is in price. I think valuations are fairly reasonable or fairly stretched, as you may want to call it as. And that's where probably the fresh buying opportunity I don't see unless we trade momentum.
All right. Hi, Deven. Good morning. Good to see you, Ben. We've got a few numbers, right? We've got insurance companies, HDFC Life, ICICI Lombard. From the financial space, we had HDB Financial, first time that they're reporting numbers. You had a look at any of them? Do you like any of those numbers? Any commentary?
Hi, Nigel. Good morning.
Morning.
Well, I guess I think the life insurance business in particular, it remains, I think, a point of attraction to us also, because of the fact that I think in the current year, with higher amount of disposable surplus in the hands of people, a portion of money is going to get into the investment assets, including the protection assets like insurance. And that's where probably I think the new business premium that we are talking about could possibly be on a rising curve. And that's where I think one would like to look at some of the companies like HDFC Life or even SBI Life for that matter, Bajaj Allianz Life Insurance. I guess I think these companies are definitely looking relatively more stable compared to what they have been in the past because of the higher growth trajectory they achieved. However, I think in some of the cases, the valuations are fairly rich. So you are not expecting a very sharp jump. Maybe I think in some cases you might see 15% odd kind of a jump. And that could be, I think, a similar situation along with, I think, some of the consumer finance or housing finance companies as well. But at this point of time, I think the more importantly, life insurance, HDB in particular, I guess I think we want to see how exactly they are implementing the technology at the front end, fintech at the front end, to expand the book size in a systematic manner. Should that clarity come in, I think that it should be, I think, an interesting one to watch out for.
Deven, HCL Tech, now the street is divided. Yesterday's shares were down close to about 3%. Some analysts are worried that this generative AI could be deflationary. Margins will remain under pressure for the entire industry. But there is that other camp which believes that the margin pressure is only going to be, transient. It's going to be temporary. Margins will bounce back and focus on the fact that HCL Tech's revenues are outperforming peers, even though it may be a growth of just about, 4.5%, 5%. Where do you stand on HCL Tech and the larger IT companies now that quite a few numbers are in?
Well, Rima, I'm a firm believer of one thing, that the technology is going to add into your cost structure in P&L. And I think that is given. Given that situation, whether in whichever part of the world I think you cater to, I think the amount of money that one will be spending out of the business on the technology, I think is going to be a sizable portion. In good old days, I think we used to call it as a raw material cost. I think here out this particular subject is also going to be an operating cost, I think, as far as the balance sheets are concerned, the P&Ls are concerned. So I think I am of the belief that the margin trajectory is not going to be soft. It's going to be, I think, relatively firm, and if not, I think, very high. But it is going to remain firm. And that will apply to most of the IT companies. Now, how they position in their business environment is more important. Those B2B companies, those who are providing the solutions to their OEM customers, in my viewpoint, I think are relatively better placed in form of, I think, getting the larger amount of order inflows and at the same time commanding better margins. Some of the large companies like HCL or Infosys or TCS, even Tech Mahindra, I think they are probably, I think, trying to readjust themselves as far as I think the business model is concerned. And in some cases, I think they are successful in driving the AI into their portfolio. In my viewpoint, I think it will be still some time before which I think we see a larger growth coming into their books, the larger companies' books. But mid-tier IT companies, I guess I think they're relatively better placed, particularly ones with an engineering R&D focus.
All right, Deven, final question before we let you go. What's the view on Biocon? If I look at the 5-year time horizon, actually the stock hasn't given great returns. I mean, it could be flattish actually. But now they've got that much awaited approval, insulin aspart, interchangeable biosimilar, which is known as Kirsty. And that could be 100 to around $300 million as per what Ekta just told us. The market size of insulin aspart, I think, is more than $1.2 billion globally. And there's been strong demand. Supply has been an issue as it is. Your view on the stock?
So, Nigel, I think Biocon has always been a very high potential company. And I think somehow the it has all delivered. The main point here in this particular news item is definitely once again ask for a delivery. I think that's where the difference would be. We will be very closely watching this particular development and we'll see how exactly on a quarter by quarter basis they are giving a positive commentary on it. I think for implementation sake. I do agree that insulin market, I think, is a large market. And I think if this company delivers at this point of time, probably I think they will have a game to play in next 3 to 5 years. But wait and see. I think we'll track this level.
Okay, no, absolutely. Devin, stay with us. What we'll do is we'll take a quick commercial break here. We'll come back with some technical trading ideas. Sudarshan and Mitesh are going to be with us. Comes up in just a bit. Okay, welcome back. Flash at the bottom of the screen. HDFC Bank is going to consider a bonus issue along with results on the 19th of July. That should be music to the ears of shareholders. Markets will take note as we begin today's session. That is HDFC Bank, almost at 2,000 rupees. And growth started to come back. And hopefully as industry growth picks up from those 10% levels, credit growth, HDFC Bank, of course, will get the benefit of that as well. So bonus issue.
I don't find any history of
bonus. Yeah, I don't recall.
I don't think. Just looking at the exchanges.
Yeah.
I don't see anything, at least of the recent past.
Yeah, we'll have to see if. It's a long history, right? It'll go back 25 years. 1995 or maybe a little later than that. But yeah, we'll have to check if this is, a first. But we'll see. Not in the recent past, as Nigel said. We'll confirm that. But this is certainly good news for shareholders.
And there's another sweetener, special interim dividend as well.
Yeah, so rewarding shareholders for being patient and sort of, staying with the business, staying with the company. That is HDFC Bank for you. Sudarshan Sukhani and Mitesh Thakkar are with us with a quick technical check on things. Gentlemen, good morning. Great to have both of you here. Mitesh, so 25,000 roughly is basically where we got. Those lows are kind of held. What do you think? Is with yesterday's bounce, is the small corrective phase over? But I think your view was that maybe there is a little bit more downside here. What's your sense?
Good morning, Prashant. I still maintain that. I also mentioned that the bounce back which could happen from these levels could possibly see supply emerge around this 25 to 50, 300 zones, give and take a few points. And I think we kind of got back to about 25 to 50. Yesterday was the intraday high, and today we might open with some kind of a negative gap. So in the short term, I think, and as long as we don't get past 25, 300, 320, I think good chance that we'll see the markets again come down, maybe test 25,000 again, and I am still hoping that there'll be a lower bottom at around 24,850 out there. So the short term view is mildly biased on the negative side.
Sudarshan, how would you prepare for today's market opening? If we have a gap down, as the GIFT Nifty is suggesting, what would you advise?
Yeah, good morning. Well, yesterday was a buy day and today is a sell day. If you have a gap down, you wait patiently for some small intraday rallies and look to go short in the Nifty. Now, these are one-day trades. Essentially, this means you don't carry them. On the larger picture, yesterday I explained that I'm in agreement with Mitesh. The chances are that we'll slowly see a drift downward. On a day-to-day basis, markets will do differently. Some days are buying, some days are selling. But on a larger, I'll say for the next couple of weeks or few days, we will slowly see the Nifty maybe reach 24,500.
Okay, 24,500. That's 700-point pullback from these levels. Got it. Both of you are sounding a little bit cautious. Sudarshan, you go first. Individual stocks, what's on your radar?
That becomes a problem because only the stocks that come are for buying, despite the fact that the Nifty's undertone is not good. Syngene is a buy with a stop under 643. Hero MotoCorp is a buy with a stop under 4370. KEI is a buying opportunity with a stop under 3,800. And Petronet is a buy with a stop under 300. Remember, this is for viewers. You don't have to go and rush and buy. You buy them only when the stock or the market stabilizes.
Mitesh, your stock calls?
So I have a mix of buys and sells. On the buying side is HDFC, AMC. If you get it around 52.60, which is about 15-20 points lower, buy then with a stop at 5,200 for a target of around 5,400. ITC is a buy with a stop at 417.5 for targets of 430. A sell on BDL, Bharat Dynamics, with a stop at 1846. Look for targets of 1750. And Airtel, Bharti Airtel is a sell with a stop at 1960 for targets of around 1865.
Thank you, gentlemen, for joining in. We'll connect again. For now, it's time for a very short break. On the other side will be pre-opening, and we'll also talk about auto. Auto was the best performing sectoral index yesterday, plus Tesla drives into India. Jay Kali of Elara Capital will join in with his insights. Welcome back. The first rate on the pre-opening is down 120 points in the Nifty. The Nifty is retraced 150 points down, but it's still settling in. Let's wait for that. let's talk about auto now. Auto is in focus because India's EV space is heating up, with Tesla debuting in India with Model Y. The price is set at 60 lakh per car on an average. Jay Kali, Executive Vice President Research at Elara Capital, is now joining in. Jay, at this price point of 60 lakh for Model Y, it's pretty much competing at the super luxury end, your BMW, your Mercedes, etc., and not the Tata Motors and the Mahindra, largely where Tata Motors and Mahindra caters to. So what is the impact of Tesla on India and the listed players?
Yeah, good morning. Absolutely, this is definitely the price point is at the premium luxury end. We know that the luxury market in India is around that 40 to 50,000 units per annum, which contributes to just about 1% odd of the total passenger vehicle market. The price point, of course, is higher because of the duties that are there. And definitely, the entry of Tesla is a positive in terms of kind of energizing the EV space, given the brand aspiration of Tesla globally, which will, to a certain extent, trickle down to India. But definitely, this is not something that is competing with the likes of some of the listed players that you mentioned in India. And we will have to wait and watch how the duty story unfolds with the India-US FTA or the India-EU FTA, and then how the pricing settles down eventually. But for the moment, definitely a very niche market.
Indeed. What's the view actually on a Mahindra and Mahindra? Normally when we have heard this Tesla news, the stock has pulled back. But the stock has been, technically as well, it's been showing some strength. And it seems the street is willing to look ahead now. Pricing point itself is very, very different. So your view on the stock?
Yeah, I think, we have been of the view that Tesla will come up with the Model Y in India first, and now with the duties that they are, because it is going to be at definitely at a higher price point, which is coming at around 60 odd lakhs. So really no impact on Mahindra per se with these prices. And we have been positive on Mahindra for multiple reasons, like the market share gains that they've seen. Despite industry growth being weak, they've shown a double-digit growth consistently. And of course, tractors is also holding out well. So I think there will be this news flow-driven ups and downs for Mahindra, which has been the case in the last 3-4 months. But I think now it's kind of settled, given that we know the price point that Tesla has entered at.
Generally, I think the BSE or the Nifty Auto Index has outperformed the benchmark. So how are the valuations, if you could give us, of the individual auto names, in the four-wheelers, tractors and two-wheelers, how are the valuations now?
Yeah, I think valuations are definitely, the recent run-up valuations are elevated. The stocks are factoring in a decent enough recovery in the festive season. And we'll have to wait and watch, because the current trends of the first 4 months have been, first 3.5 months have been pretty weak on the demand side. Even recent trends of Vahan retail show quite a lot of weakness. But the expectation is that, with the slew of measures that the government has taken in terms of income tax rate cut, etc., should trickle down to some bit of, kind of a demand revival in the festive season. But definitely valuations are elevated, and one would want to stick to names with minimal expectations of earnings downgrades, if at all.
Yes, Swaraj engines actually the low liquidity, but the street like those numbers. I think the sense is that rural India is still doing better. What is your take? Because, if I look at a couple of segments, the MHCV and all, they're yet to see some kind of a pickup. So how do you view demand on that parameter?
Yeah, I think the rural side is doing well, and that is especially seen. Tractors has been an outlier. I think, in the first quarter, we're seeing close to double-digit growth in tractors. Far higher than many other segments like PV, two-wheelers, CVs, etc. And that has also helped the stock that you mentioned. But going forward, I think FY26 is expected to be a high single-digit growth for tractor industry, led by the rural demand pickup, which eventually we are hoping should translate into good numbers for the passenger vehicle and two-wheeler industry also during the festive season.
Recently, UBS had downgraded Maruti. because they're saying that it'll be tough for the company to regain the lost market share. Anyway, the small car segment is, struggling with the price increases that we've seen. And even competition, for the number two, I mean, generally competition is also going up. So where do you stand on Maruti? And do you think this downgrade, I mean, the points made are valid?
I think the Maruti definitely in FY26 was supposed to be a play more on the industry growth revival and not so much on market share. Because we had seen a slew of launches. There is not a very big launch pipeline for Maruti in FY26. Industry growth is kind of faltering currently, and one needs to see when the first-time buyers come back. I think that will be a trigger for Maruti going forward. Currently, we have a positive view on Maruti Suzuki.
Okay, all right. And a quick word on the two-wheelers. Yesterday, the top gainer was Hero MotoCorp. Yesterday, they had some comments coming in from their annual report. And the commentary said premiumization is their focus, exports markets as well as something they're looking to penetrate in. And the commentary was very positive. Street bought into it. Your take in terms of two-wheelers, and what's it in terms of pecking order?
Yeah, I think in two-wheelers, two-wheelers industry as such is expected to grow at around 7% in FY26 is what our expectation is, much higher than the passenger vehicle as well as the CV industry. So to that extent, we remain positive on the two-wheeler space as well, and our pecking order would be TVS, Bajaj, followed by.
Okay. All right. Got it. Thanks a lot, Jay, for joining in and giving us your take on all of those stocks from the auto pack itself. Well, the markets, I think we have the pre-open rates that should come up for you on the screen. We're just going to be ending, the pre-open session. So just a very, very mild downtick is what we're seeing on that particular front.
Absolutely. And, Nigel, as that Tesla conversation shows, right?
Yeah.
70% duties. Will those duties eventually be brought lower? I think we'll have to wait for that deal, right? With regards to US and India. So here's President Trump. I mean, it's been basically put on, it looked like the deal is moving slower than what most expected. I think that is just a fact. But here is President Trump on the deal with Indonesia, but also, of course, hinting that the deal with India perhaps is being followed through on those same lines. Listen in.
We made a deal with Indonesia. I spoke to their really great president, very popular, very strong, smart. And we made the deal. We have full access to Indonesia, everything. As you know, Indonesia is very strong on copper. But we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing. I think it's a good deal for both parties. But we will have full access into Indonesia.
Yeah, I mean, that's Indonesia, but let's just play out that India bit as well.
We have a couple of those deals that are going to be announced. India basically is working along that same line. We're going to have access into India. And you have to understand, we had no access into any of these countries. Our people couldn't go in. And now we're getting access because of what we're doing with the tariffs.
Well, all eyes on the contours and when this deal with India will be signed. But let's get in the 9-10 calls. Mitesh is back with us. Mitesh?
I remove the sell on Bharti Airtel for targets around 1865.
Sell on Bharti Airtel. Let's get to some of the big stocks of the day. Potentially, it could be Dixon Tech. Vinny is now joining it.
Hi, good morning. So yes, keeping an eye out on Dixon Tech today. They've acquired a 51% stake in Q-Tech, which is obviously going to be a primary investment as well as a secondary investment. Q-Tech is among the top 5 camera module suppliers globally, and in India, it's amongst the largest over there. Now, this is a significant step that comes in from Dixon Tech, mainly to enable value addition in the smartphone side of the business, as well as they've been doing a lot of backward integration. That's what will add value to the company now. Other than that, they made another announcement that That is, a company is signing a JV with Chongqing, which is a precision component manufacturing company. Now, Dixon will have 74% in the JV, while the other company will hold 26%. And these components are mainly used for mobiles, laptops, or automotive applications, etc. What the company can use these components for. So, backward integration positive coming in here. And obviously, in the last few months as well, they had made HKC JV also, which was a backward integration. So, brokerages are positive on this one. CLSA is also positive on this. They said that this would add value to the smartphone side for at 45 to 55% currently, from 15 to 17% is what it would go to, 45 to 55%. All brokerages are positive on this one. I beg your pardon, and we'll keep an eye out on the stock.
CLSA has a high conviction outperform on Dixon. But Sudarshan, pre-open, Dixon suggests a 3.5% up move. Your thoughts on that? And what would your 9-10 call be?
No, Dixon is a buy, but not after a 3.5% up move. I think it'll correct, if not today, soon enough. Petronet is a buying opportunity for 9-10 with a stop under 306.
Petronet. Let's get back to the other stock which should be on your radar. That's Biocon. Ekta joins in.
Well, yes, I'm looking at Biocon because they've received approval for insulin glargine from the US FDA. Now, remember that this is an important biosimilar in their portfolio, considering that they have been awaiting approval for this particular product since a couple of years. They had received a complete response letter from the US FDA citing some deficiencies at the Malaysia plant, which had delayed the approval. This took place in 2022-2023. Finally, they had the US FDA re-inspect the facility in September of 2024. And now they have received US FDA approval for insulin glargine. It's expected to be around $1 billion in terms of sales. On a conservative estimate, Street is anticipating maybe around $100 million in terms of sales, which could possibly even go up to $300 million based on market dynamics at this point in time.
Okay, all right. Ekta, thank you very much for that. Biocon, keep an eye. But let's also talk about PVR Inox once again. We had that discussion with Karan earlier. But what's the Street broadly making of it, Vamakshi?
Well, PVR Inox, it could be a negative implication for that, given that the Karnataka government has proposed in a draft notification that movie ticket prices could be capped at 200 rupees. Keep in mind that this is only a draft. This is not the final verdict on this particular matter. A time of almost 15 days has been given to the public for submitting feedback on this proposed regulation, and the expectation is that exhibitors may rally against, this proposed regulation. Now, keep in mind that this could have a negative impact on PVR Inox, given that almost 40% of its screen presence is in South India. In fact, we spoke to Karan Torani as well, and he said that almost 12.3% of PVR Inox total screen portfolio is in Karnataka. In fact, the state contributes almost 8% to the Hindi box office collections and 10% to the overall collections. And the average ticket price in Karnataka is somewhere around 260. So therefore, if it is capped at 200, it would mean a 30% decline in the average ticket prices, and overall this could lead to a consolidated decline of almost 4% of average ticket prices for the company. There is an expectation that revenue as well as EBITDA could be hit. This hasn't really gone through, but if it does go through, it could have negative implications for PVR Inox.
All right, so negative implications for PVR. Vamakshi, thank you very much for that. So that is the overall picture as things stand right now. Lots of stocks in focus, markets, of course. Let's just look at the GIFT Nifty once more. And by the way, also notice that the rupee, at least at 9 o'clock open, had opened about 12 paisa lower, if that is any indication. So the Nifty is now actually flattened out with the pre-open ending. So it's going to be another, we know, getting used to flatter openings, right? But that's the wicks had dropped to one of the lowest ever, the India wicks, that is, over the last couple of days. And we are, of course, now in quieter markets. A much more quieter phase, even as compared to, say, a month and a half ago or so. I think just the rupee, if we can, the dollar rupee, if we can quickly look at it. And then we will just sort of maybe just revisit one or two stocks and then look at market open. 86 or so is where the rupee is at. Yeah, that's a 22 paise fall against the dollar. So that is a big move actually coming through on the dollar rupee past 86, and maybe we should put out a flash as well at the bottom of the screen with what's happening there. The big problem point, of course, has been IT services, and and that's been the pain point ever since TCS reported numbers. HCL Tech followed through with weaker set as well, and there's a big sector still. So eye on that as well. First rates coming through 25,200 on the Nifty. The Nifty Bank is up about 0.25%. And you've got the mid cap and small cap indices which will show up as well. But they're flat, at least in the first rates that are coming up on your screen. So not very much at all on either of the four indices that we typically look at. Right out of the gate, stocks are still opening. Maybe it's too early to look at market breadth, but it's kind of evenly matched as we begin this particular session. Just a quick heat map, which will give you a snapshot view of how many are up and down in the Nifty 50 stocks. So it's mostly all about, 40-odd names are lower, and you got about 11 names which are actually higher at this point in time. I can spot some financials at the bottom of the screen, so let's get to stocks. Rima.
Well, the top gainer is HDFC Bank. The street is excited with the bonus announcement. Stock is up 1%. HDFC Life, top line looked good. Margins were a bit subdued, but the stock is up and about in trade. And SBI Life, that too is moving up in company. SBI Life is a gain of nearly about 0.5%. HCL Tech was the top Nifty loser yesterday. It fell by more than 3%. There hasn't been a recovery in HCL Tech. I don't think it's fallen more, but it's a flat opening for HCL Tech after yesterday's fall. On the way down, Reliance Industries is struggling. Remember, it comes out with numbers on Friday, post-market hours, and ahead of that, Reliance is under pressure. Shriram Finance is seeing a big fall. In fact, that's the only one with a fall of more than 1%, and it's straight away 4% gone on that. Did I miss the news on Shriram Finance? 4% down, large volumes. And no other stock is showing this kind of an exaggerated move, either, on the way down. So at least Shriram Finance is, seeing a big fall. Outside of that, Cipla, Bajaj Finance, Hindalco, JSW Steel, and ICICI Bank. Metals too appear to be a tad on the back foot.
Well, that's right. A few stocks in the broader markets that are catching your eye. Coffee Day, the stock is up 10%. So big volume out there. That's coming up one of the top volume movers. Biocon, the stock has relatively underperformed if you look at it for the last few years. But now that biosimilar getting a green signal, the street likes it. And that's why, in fact, that stock is up and about in today's trading session. Hathway Cable opens up with a gain of around 4%. Network 18 is up close to around 5%. Due disclosures, please note. Both those two are doing quite well. Edelweiss Financial, well, that one as well is up close to around 2%. These are all the top volume movers. HDB Financial, that's reacting negatively to its results. I think we should get that one as well up for you on the screen. It's seen a 2% downtick. And Diffusion Engineers, that's one of the new listings out there. That's up close to around 5% as we speak. So good up move is what we're seeing on that one, on fairly large volumes as well. In terms of losers, yeah, I think Shriram Finance, that's the one that's calling for attention. And Newland Laboratories, I think this week it's up 20%, even after the 4% pullback that you're seeing. So some kind of cooling off after the big run, as is the case with ITD Cementation as well. Stock now down 3.5%.
Absolutely. So it's quite a start. Nifty, the bank's index is doing much better. With 57,130. The Nifty is slightly lower at about 25,160 at this point. Small caps are doing up. They're up about 1/3%. Maybe if you can just quickly look at the IT index, and then we'll move on as to see what's happening in the rest of the space. I mean, IT index absolutely flat for now. Let's welcome in our market master today. Samir Arora is founder and fund manager at Helios Capital. He's with us. Samir, great to have you with us as always. Good morning. I want to start with exactly that, which is IT services. I mean, you've had this pet peeve for a long time with IT and their acknowledgement or lack of acknowledgement of the disruption. Let's just start there. What you made of the earnings and go on. Yeah, please.
I think more than that. First big goof up is that not to invest in any new technologies, helping others, do this. For example, if you've heard of a company called Zscaler, founded by two Indians, those Indians are worth combined husband, wife, some $18 billion. To see all this happening and to help others, but because of this fascination with cash flow and dividend yield and buyback. So, we are stock market guys and we like people who care about stock prices. But still, there has to be in not 1 year, 2 year, now 20 years have passed to not make $1 worth of investment in all these new technologies happening in front of you, not in front of us, but in front of them. To not do it is very disappointing. Second thing is, as I said, lack of acknowledgement, which actually distorts many careers. Because even today, if you keep saying everything is good and you don't openly discuss because next quarter price might be down, how many people are now learning coding when you know that the coding job will be 1/3, say, I don't know, say half, whatever. 10 years later, 5 years later, you have to guide the world a little bit every day to only focus on what is to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like. But they are disappointing on many levels, philosophically and on a day-to-day basis.
You think at some point there will be a pivot, and you will, as investors, I mean, at the end of the day, viewers want to know whether they, money can be made here.
Of course, I will do it, and then I will come and confidently tell you why I like them at that point of time. But the point is, today I don't, and I haven't. And this issue is a bit serious. So this issue is, you can say, like the consumer staple guys. You are still the best companies, big companies, important for country, important for foreign exchange. It's just that your growth is gone. And when the growth is gone, you try and find all these bad, I mean, sort of in hindsight, you can call it, I don't care. But right now it is bad. So there's no point in saying that, now it's too late. It's not late, according to me. And we are not just telling you, you can see our portfolio, what we have and how much we have. And we also don't like, 3-4% kind of growth. Who cares for 3-4% kind of growth? If that is the case, then maybe the PE should be like HPCL or something 5. Then you might say, okay, doesn't matter. One day something will happen. But if you're already trading at these valuations, then you don't want 2 years of 5% growth, because one day it might become 6 and surprise everybody. That's too boring.
Okay. IT is boring. But other than that, you like the market, you said.
I like the market. I have broadly liked the market. In between, there was this confusion that I had on this India-Pak war and all. But this time we realized that, these things get sorted. Unless they become very bad, then of course that is a low probability event. But generally, these things get sorted in 10, 15, 20 days. And then sort of the rebound is at least half to 80% and move on. So I've been bullish on two things. For India, that is. One is that for last 6-8 months, not now, but say 2 months ago, from say September onward, there were big FII outflows driven by people feeling that they should go back to US. And so in September and January, there were very big sales of maybe more than 25 billion or so in 2 months. I mean, in these 2 months, not together. And then since April, May, it is clear that the world is not fascinated by US to the extent that they want to put back everything that they may have sold. And you can see that from flows into ex-US ETFs. There's a MSCI World ex-US ETF. There were articles on how many billions it has got suddenly. Even we in our global fund have reduced US weightage from 70% to 50%. And the world there's so many things you can read on that the world has slightly brought down their US, if not this much. For the first time in many years, the ex-US index is beating the US market. And therefore, if that happens, and there is a shift of 3-5% from the current US exposure of 70% to say 65%, 68%. That is massive money for the rest of the world. And in that, India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency dollar has depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months.
So, Samir, you said that in your global fund, you've brought down the US exposure from 70 to 50%. So, which other markets have you deployed that money into and how much?
So we used to have this, by the way, fund went from 70 to near zero. Fortunately in Feb, so it has been brought back. So what we've done is we used to have 5-7% in China, which we are now targeting, still haven't reached, but 15. So we are at 12 or so, and we did not have gold in that fund. I used to personally own gold, but in that fund now we have already bought 5% gold. And we are going to keep these forever now. I mean, ever means, let's see. And then the rest is in, we had these 8-9% in these two Indian ADRs all our life, which have not helped, particularly, you know which one. I hope one day it helps, which is HDFC Bank ADR. And the rest is rest of world, 20%. So 50, 15, 5, 10, and 20.
All right. Hi, Samir. Good to hear you this morning, and thanks a lot for joining in. Samir, what about, the Indian economy? How are you reading it? Because urban India still appears like it's very, very slow. If you look at, numbers coming out of Trent and the likes, which one would say is a little bit worrying. However, inflation has cooled off. And if I look at the nominal GDP, it's going to be sub 10% in all probability. So one way to look at it is the RBI is going to pump it up even more. We're going to get further rate cuts, which in turn could be the start of a fresh leg on the up move. How are you reading these data points that are coming in there?
So right now, if I look at it purely from earnings point of view, earnings are not great. As in this year, you can't grow more than 10% here or there because IT growing below 5 maybe. The large consumer companies growing 4-5%. The large banks or banks in general growing below 10 because of NIM compression and all that. But at least that one hopefully gets sorted out in 3-6 months. So for this year, whether we are positive because of flows, we are positive because of interest rates, we are positive because of SEBI and RBI being pro-market in some sense by reducing some regulation, putting in liquidity here, there. Still, you can't make obscene money, which would, according to us, be 20%. So you will make 10-12%. If you see now year to date, the market is up some 5-6%. So more or less, 0.8 to 1% per month, if you get, that is enough. So that issue is there, and you need a new cycle of something or some of these to do better. This negative overhang of IT is also actually going to, over time, feed into our consumer sector. So it's not straightforward, but 10-12% return is still reasonable to expect for some time, and then hoping that some of these things, either because of pumping of liquidity or interest rate cuts or whatever, goes back to a little higher than they are now, and therefore the overall market growth is about 13-14%, which is sort of normal. Right now it is below normal.
No, absolutely. I got that. By the way, Samir, there is, with regards to what the RBI wants to do, what we've been sort of hearing, picking up, and there was a RBI governor interview yesterday as well. I mean, they're very, they are, and we've heard it from the horse's mouth, but also generally feedback, people who go and give suggestions, etc. When RBI wants suggestions, I mean, it seems to be squarely focused on growth. I mean, asking banks, tell us what you need. And they're very focused on kickstarting another credit cycle.
Because we need it.
We need it. So if they are successful, even mildly successful, where will this show up in your way from an investment point of view? How do you connect it?
So as I said, the first thing is that in financials, we expect that the growth rates will go back. That is in the banks and all. I am still a little bit hesitant on our own sub-segment, which is capital markets, where again, we are getting carried away that every day the volumes have to go up and depository accounts have to go up, and all that is, we are over pushing it. For example, I saw on Twitter somebody saying that BlackRock has some 12 trillion, therefore the asset management companies in India can grow forever. I mean, if this kind of wild connections are drawn, even though we ourselves own HDFC AMC, and of course we own our own Helios AMC, but still, we don't want to overdo these things. But before that, India, as of now, also seems to be a relative beneficiary of the US trade deal, because at least so far it has not happened. And if we finally get some 15% even, then all our competitors, China has 35 right now, 10 plus fentanyl, Vietnam has 20, Sri Lanka has more. Also, all these similar guys, Japan has 25. So even if we get below 20 anything, I hope we get 10, but let us say that looks a bit very optimistic right now. That also will be on the margin positive. So overall, it's okay. But in terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no, because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap. And therefore, you have to cover some other angles to spend that money or invest that money.
Samir, any new idea as an idea that you want to talk about?
No, we don't want to talk about, because
Stock as an idea that you
can
want to
see them in the mutual fund disclosures, and you can talk to the mutual fund manager or that team.
But I think the Flexi Cap Fund has made 4 additions in June. Siemens Energy India, Vishal Mega Mart, Niva Bupa Health Insurance, and Swiggy. So
I'm delighted to hear that you are reading your sister company's articles.
Yeah.
Control. You should have your own articles.
Oh, who told you that's not our article? That's our article.
I also saw it today morning on Money Cut.
No, Samir, you're wrong. We are reading our own content.
It's your own company, actually. The point is, by the way, the Flexi Cap is doing very well. If you see it from, Jan was bad, but overall, if you do 1 year since inception, 1 month, 3 months, since February 1, it would basically massively beat the market. If you see it from inception, it would have beaten by more than 9% in less than 2 years, which is quite big, and bigger than the biggest guys who are more in the news every day.
I got that. Do you think, one thing I've heard from many is insurance. I mean, again, we spoke about financials, but insurance perhaps, in a way, does better and better. The last 2 years, again, like many others, lots of regulation, lots of changes, but now it's settling in. We, of course, still are waiting for the new IRDAI chief, but they perhaps will be a little bit of a pivot, more friendly to industry, etc. Any thoughts?
So we have 3 actually now in all our funds: HDFC Life, and we bought the Nuva Bupa, and we also have ICICI Lombard. And the first reason was that they had done very badly. Like HDFC Life in the beginning, after a very successful IPO and all its returns being made in the first 2-3 months, I think, basically for 3-4 years, the stock market performance was ordinary to zero, and then the fundamentals caught up. And big picture is positive for this theme and this sector anyway. So if the theme is otherwise good, you just buy the obvious candidate also is enough sometimes. And these are the obvious candidates in this field.
And I think Bajaj Finance as well, you're topping up out there, right? That's
Bajaj Finance, we are topping up means actually that topping up is because that fund gets new flows.
Oh, okay.
But otherwise, all are buying. We all have it. Even I have it here. But the topping actually in some sense sometimes doesn't show. Sometimes doesn't show. We are very positive, very bullish. But what I'm saying is every move in a mutual fund, you should take a little differently from, say, some other fund which has, sort of a more or less a regular size rather than like the mutual fund getting every month. Mutual fund is a good business, I must say. Every month the flows are very big, and it is very heartening and pleasing to see that every day. But that also means that you don't interpret every stock trade as a new something.
Samir, quick word on gold, because that's, as you said, the recent addition, at least in the global front. You've had it personally. I mean, it's had such a phenomenal run. So it's very hard to make that argument that those kind of returns, or smart returns, will continue even in the future on that kind.
Actually, the thing is, this is the whole story which nobody knows. That the whole reason for being, not whole reason, but one of the reasons for being confused about US by the world is that the US debt is unsustainable. If you read this Ray Dalio book, Why Countries Go Broke. So all these things will lead you to believe that it is okay if you don't make much money on gold, but you don't want to have a situation where the currency in US goes a lot. But Ray Dalio says that in 3 years, US will have a seizure plus minus 1 year, and he has written a whole book basically to lead to that conclusion. And we can see that the world, there is not enough of an alternative, as in if you don't like the US dollar, it's not that the world likes euro or the world likes yen, or they believe that those can take over. But gold is a neutral this thing, and it is, you can say, insurance, but also it's a hedge, you can call it, whatever you want to call it, to against the fact that the US goes bad. And of course, recent days the US market has done well, but every time these tariffs were increased and uncertainty was increased, and basically President Trump was very aggressive in criticizing other countries, for example, saying they are coming here to kiss my ass or something. So all these things would make you feel that these other countries will try, if they can, reduce, limit, but at least definitely not overly support the US Treasury.
You could have said, just kiss me. Kiss me.
So I'm saying, every time it looks to me that the word which was friend of US might say, now it is deal to deal, trade to trade, and just randomly putting everything in the US, if they have surpluses, all that is changing. Whether it is for fundamental reason or personality reason or ego reasons of everybody.
Laughter in the morning, Sameer. I mean, that's what the conversation with you always leads to. Lots of gyan, insights, but really sort of, some laughter as well, which all of us look forward to. Thank you very much for joining us. Great speaking with you, and appreciate your time here on CNBC TV18. I think the market's not doing very much, 50 odd points lower, 25,150. But, the deal pipeline, Reema, Nigel, in terms of blocks and IPOs, etc., supercharged.
Indeed. So let's straight away get to, the big block deals. The most recent one was the one that we saw in VIP, where Multiples and Sancheti Brothers picked up about a 32% stake in Piramal's. But there have been so many others, and the IPO pipeline continues to remain red hot. So to decode the key drivers, the trends, the pipeline, we're now joined by Bhavesh Shah, Managing Director and Head of Investment Banking at Equirus, and Rahul Modi, Managing Director, Co-Head of Investment Banking at Ambit, joining in. Gentlemen, thank you very much for joining in. So just to first understand, the numbers in the first half of this calendar year, and what the numbers in terms of M&A and IPO pipeline that you guys see in the second half of the year. Bhavesh, you want to go first?
Sure. I think, Reema, thank you first of all for having me on the show. We are seeing a lot of activity across the board, be it IPOs, be it M&As, be it block deals. This is a investment banker dream that we are all living. We all grew up as analysts to where we are today to see this kind of an activity. But if you were to really look at it in terms of numbers, I think M&A was something like $25 billion year before last, but it's now become about $30 billion in 2024. What we are seeing is a multitude of game change in terms of optionality, which the companies have. Today, they can actually list the company. They can actually, sell their stake through block deals, not necessarily through an M&A, but also an M&A is an option. So it's a multitude of options which is available for the companies, and that's how the trend is looking at in terms of numbers, etc.
All right, good to see you, Bhavesh, as well as Rahul. Thanks a lot for joining in. Rahul, let me come across to you. The recent few deals, SML Uzuzu, you have the deal in the paint space, Saxo Noble, and recently VIP as well. All the three deals, well, they're viewed very, very positively, and they're large-sized deals as well. However, one would say that all the three deals got done at a sharp discount. How are you reading it? One would say it's good for the industry, good for the country on the whole. However, do you think some of these were distress sales? The promoter entity out there was a little bit more desperate to get out of the business?
First of all, thank you for having me on this discussion. No, I wouldn't say so. I think each deal has obviously very specific deal dynamics. So I wouldn't generalize or say that they were distressed deals. Obviously, you have to consider where and I think a number of deals you mentioned are publicly traded, and obviously the markets and the valuations have been quite good. And it's quite normal for some of the secondary deals to be priced at a discount. So I wouldn't say so.
All right, Rahul, fill us in with your view then. How's the pipeline looking? If the markets remain very, very buoyant, then this deal street is likely to keep buzzing. Your take?
Absolutely. So, see, as Bhavesh said, I think we are seeing a very significant activity both on the M&A private capital raise as well as public markets, equity capital markets. The volumes on the M&A side have been quite robust. And I would say there are maybe identify four drivers for this. One, which is very basic, is I think we had great last year in terms of the equity capital market performance, but that was corrected a little bit earlier this year, initially because of this whole global tariff situation and a bit of geopolitics. And what that did is had some correction in valuation. Obviously, markets have gone up since then, but that makes the deals between buyer and seller and agreement on valuation more possible and pragmatic. So that's a very key driver, I would say, for M&A surge this year. Secondly, if you see, and in fact, you named a lot of the deals, but if you see one theme that has emerged is the large corporate houses have done, very meaningful M&A. So if you see, you mentioned JSW, ExxonMobil, Bajaj acquired Allianz's stake, Mahindras have done a few deals, Torrent did JB Pharma. So, there has been a spurt in activity from large corporate houses. Thirdly, private equity has been pretty active, both on investments as well as exits. And some of the exits have been through IPOs and blocks, but some have been through M&A and secondary sales as well. There has been focus on control deals from private equity. And it's not only the traditional private equity houses. You see real estate funds, infrastructure funds, pension funds, sovereign wealth funds also participate. And lastly, and again, that's something you touched upon, is that while even if they've corrected, the valuations are still good. So what we are seeing is, monetization by some Indian promoters or even foreign strategics. So you mentioned about VIP deal. We know the ExxonMobil deal, but there are a couple of Whirlpool is there. There is Novartis. So I would summarize all these four factors are contributing to very robust M&A pipeline.
I did a couple of these discussions, and we spoke with Ramdevji as well. And one thing he said kind of stayed with me. He said, well, so much supply essentially means that perhaps it puts a bit of a cap on the higher side. But a lot of the money which is being taken out, I'm talking about exits from PE, VCs, promoters, etc. A lot of it basically comes back into the market. So that kind of also provides some sort of a floor as well. So PE and VC exits last year were about 1.15 lakh crores. This year so far, this is till the 3rd of July, that number is close to about 40,000 crores. And of course, promoter exits 2 years in a row, 23 and 24, a lakh crore plus. And this pace, we're at about 65,000 crores already. I think we'll beat the last 2 years as well. But I just want to quickly get for our viewers, Bhavesh and Rahul, right? As they say, buyer beware. Deals will come, and promoters and everyone will try and maximize. Where is all this stock going? It's going to DIIs, and DIIs are buying because they're getting all this money from retail investors, local investors in many ways. The quality of paper, I just wanted to quickly, if you both want to weigh in for 30 seconds each, Bhavesh, in this cycle where we are right now, what do you make of it? What's coming to the market?
So Prashant, I think it's a very fair observation, and obviously, great amount of activity happening, which also leads to a question as to whether it's really good quality paper coming into the market at the cost of the retail investors. But I must tell you one thing, is that the mutual funds, the institutional investors, that is, they have significantly upped their game in terms of the processes, in terms of the work and the diligence that they do in identifying the companies or where they want to invest, and the pricing as well. There's an extreme amount of discipline which is there. And I think it is but natural, because all these institutions have scaled up significantly because of the money coming in. Every mutual fund wants to grab a share of this 27,000 crores which is coming in. So they better be sure about what kind of companies they're investing in. Are they making good returns or not? So there's a
Bhavesh, absolutely, point taken. But as I don't know if you heard Samir earlier, right? Towards the end, he said one thing. He said, because we are getting this gush of money, so anything we do, don't take that as this new kind of big view. You just you're getting the money, you got to put it to work. So while I take your point, but it is also just a function of the fact that you can't sit on cash. You've been given money, this gush is coming in. and you got to put that to work.
And exactly, which is why this supply of high quality paper really helps. And if I were to correlate this to M&A, for example, earlier a large stake sale in companies would invariably have to be done through strategic. Now strategics will try to kind of really kind of bring the valuations down or kind of arm twist on the valuations. But now with the markets opening up, with the private equity opening up, the optionality of good quality paper coming at reasonable prices has also kind of come up significantly. So the incentive for the companies to go for markets rather than do a strategic is there. At the same time, there's a good supply paper coming in, which kind of absorbs this liquidity in the market.
Rahul, have you seen a distinct increase in PE-led acquisitions or consolidation? So the most recent one was Multiples and VIP. Then there was Temasek-backed Manipal acquiring Sayadri. Before that, Bain Capital invested about 18% in Manappuram. So compared to the last, say, 3-4 years, have PEs become more active in India?
Yes, absolutely. I think, and it's been very steady. So if like last year, maybe just the PE investments were $30 billion. And we see this year tracking that and probably doing a lot better. As I was mentioning, we see a great level of confidence in PEs across sectors. They are willing to do more control deals as well as significant minority deals. And this confidence comes from economy in general, the business case of particular investments, but also their confidence in exits. And I think, as Bhavesh mentioned, you have multiple options to exit now. So we're definitely seeing that, and there's been across sectors. Consumer, we've seen a couple of very large trades like Haldiram, Theobroma, which got announced very recently. There are a few in pharma and healthcare, KKR acquiring HCG and so on. So other aspect of this is that it's not only the traditional sectors, but there is a lot of capital that is coming into real assets, so real estate. So Blackstone acquiring properties in Kolkata. Infrastructure has been very prolific for the last few years, and I see that continuing. As you know, there has been extension of certain tax benefits which are attributed to pension funds and sovereign wealth funds, which were extended by full 5 years in this budget. So that story is going to continue in every possible infrastructure, roads, renewable, digital infrastructure, energy infrastructure, and so on.
Yeah, I mean, that real assets story, right? It's very, very small right now in India. I mean, if you look at the sort of market cap of, say, REITs as an example, compared to how large that market is in the US. But maybe things will pick up on that particular front as well. We're out of time. I had a couple of more questions, but maybe we can request both of you to come back on the air. Bhavesh and Rahul, appreciate you joining us here on CNBC-TV18. Thank you. We'll take a quick commercial break here. We'll come back. We'll have the management of ICICI Lombard join us on the other side. We talk about their quarter numbers and, of course, the outlook more importantly. Okay, welcome back. ICICI Lombard is the next management as promised on the program. The stock's higher. It was high yesterday after it reported good set of numbers. Net profits have risen 28% to 747 crore rupees. We are now joined by Gopal Balachandran, Chief Financial Officer at ICICI Lombard. Thanks very much, Mr. Balachandran. Good morning, Prashant here. So if you look at the net earned premium growth, that is in line. But if you look at the PAT growth, as I just mentioned, that is much higher, 28-29% kind of growth is what we've seen. Could you just briefly tell us what led to this very sharp move on the bottom line front in the quarter?
Morning, Prashant, and that's a great question. I think from an ICICI Lombard standpoint, I think we have maintained it even in our earlier calls. As a company, what we have tried to do is to stay focused and be disciplined in terms of our insurance outcomes. And more importantly, also kind of leverage the investment float that we kind of generate in our business and put it to optimal use. So the number of 28% growth that you see, I think the markets have been kind in the quarter. And therefore, to that extent, whatever growth that you see is a combination of both an improvement in our insurance results, which is largely reflected in the combined ratios. And equally, obviously, there has been an improvement in our overall investment income. A combination of the two is what has led to a growth in profits of 28%. But as we keep saying, I think some of these, how sustainable, I think better is to always keep looking at results more on an annualized basis. That will be far more reflective of what one can expect insofar as the full year operations are concerned.
Mr. Balachandran, and that was exactly my question, because during the quarter, because we get these monthly numbers, right? Except, I think, retail health, across all other segments, ICICI Lombard sort of gave up a little bit of market share. So is this performance sustainable, or do you think we will eventually see deceleration in premiums as well as we go through the rest of FY26?
Again, that's a great question if you ask us. I think that again, let me just put this in context. I think let's look at in terms of where the market is currently positioned as. One is in terms of what is it that you can exhibit as top line growth. And the second, what I said, what is it that one can exhibit in terms of profitability outcomes. If you look at the overall market, the industry is kind of currently losing roughly about 12 to 13 rupees for every 100 rupees of premium that you collect. So which is why the industry combined ratios are operating at around 113%. So when there is so much of underwriting losses, I think from an ICICI Lombard standpoint, what we have always tried to do is to obviously accelerate in segments which we think are preferred segments at this point of time. At the same time, be guarded and cautious and wait for the cycles to turn around and obviously seize the opportunity for growth as we head into the subsequent quarters. And that is how we have always operated as an institution. And that's the reason not just now, even at any points of time, generally, if you see relative to the industry combined ratio numbers that I spoke about, ICICI Lombard's combined ratios have been kind of better by at least about 10 percentage points or thereabout. And to the markets, what we have been largely talking about is to see how we can continue to deliver a sustainable return on equity in the range of 18 to 20%.
Okay, all right. Hi, sir. Good morning. Good to see you, Ben. A couple of quick questions then. So you're saying that you'll outgrow the industry and the combined ratio as well will be far better. Could you put a number to that? What kind of industry growth are you working with? I think in the past you've said that you'll outbeat industry growth by 100 to 200 basis points. So do you hold on to that? Are you looking at any kind of price increases as well, price tweaking? Give us clarity on both those two fronts.
Again, Nigel, I think that's a great question if you ask us. So again, let me just put this in context. I think when we had kind of talked about us outperforming on growth, exactly to the numbers that you indicated, which is about 100 to 200 basis points, that's relative to, let's say, where the market is expected to operate at. Vis-a-vis that, what we are seeing at this point of time is obviously elevated levels of competitive intensity. And therefore, to that extent is what I kind of talked about, to be a bit guarded or cautious. And in that context, I think we are happy to kind of let go market share, particularly around these times when the market remains elevated. Having said that, obviously on the segments where I think things have been reasonably good for us in terms of the pricing regime, I think we have continued to stay accelerated, whether it is growth in our retail health book, within the commercial lines, whether it is a growth in the SME segment, I think that continues to do well. Within the motor segment, if you were to see our shift in mix to private car relative to, let's say, commercial vehicles. So that's how we have kind of obviously kind of moved across business lines, depending on what environment that we are seeing in the market. Your second point on Where do we see the price? I think the good part is, again, let me kind of pick each of the segments. Commercial lines, if you recollect, last year had a tough time in the pricing market environment. This year, clearly, if you see the numbers, that is reflected for the overall industry also. The pricing seems to have kind of come back reasonably well, though not fully to our expectations, but there has definitely been a price improvement. On motor, I think there has obviously been from an industry an ask to possibly seek an increase in third-party price. We will wait and see when that final notification comes through, and we'll be happy to talk through whenever it happens. But in general, there is definitely a need for price increase in motor because industry combined ratios on motor are operating at 124%. On health, I think again we have spoken about from an ICICI Lombard standpoint, the loss ratio range on an annualized basis, which we are comfortable with, is between 65 to 70%. And at this point of time, looking at how things are playing out for us, it seems to suggest that we should be within that range.
Sir, thrice you referred to elevated competition in the industry and how one needs to be guarded. Can you describe a little bit more about what we are seeing with respect to the competitive intensity and what's the extent of market share loss that you've ceded? What's the number?
Yeah, so again, if you look at it, let's take individual segments. Let's take motor. We would have lost roughly about 0.5% market share. We touched almost close to about 11.1. As we speak, we are at a market share of 10.5%. And this is not just this time, Rima. I think in general, I think our approach, which is what I talked about, when I said the industry combined ratios in motor is at 124%, that is a lot more money to lose even relative to, let's say, the aggregate. What I said, industry is losing about 12 to 13 rupees for every 100 rupees of premium that they collect. So in motor, you're actually ending up losing almost 25 cents to $1. So that's a lot of money to lose. And therefore, in these times, it is far more important for us to make sure that we continue to stay invested in our service/distribution expansion initiatives. But at least insofar as growth is concerned, at an aggregate level, you will possibly see us underperforming the market. But this is how the nature of the business works. And hence, to that extent, I think we will obviously be able to kind of position ourselves far better. Whenever the cycle reverses, we'll be able to capture the opportunity of growth.
Are you comfortable losing more market share? I mean, what if the cycle doesn't reverse? You've already lost 60 basis points in motor, for instance. I mean, what is your plan B or your thinking behind it?
Absolutely. I think this is again, I think I would again kind of put this in the context of, because the informations are all in the public domain. I think companies which have tried to be very aggressive, again, if you would have seen over the last 2-3 years in specific, clearly you have seen them significantly getting impacted in terms of their combined ratio/profitability outcomes. And today, if you were to see the growth numbers of some of those players, they have significantly calibrated growth. And in some of the instances, they've actually kind of degrowing their book. So that's exactly what happens, particularly when you start to see your combined getting impacted, profitability is getting impacted, solvency getting impacted. So that's exactly the nature of the business that we are in. And over a period of time, and just to kind of refresh quickly, in motor, while I said currently we're at a market share of 10.5%, post-COVID, actually our market share came down to 9.5%. But since then, when we saw an improvement in pricing, we were able to improve the market share from 9.5% to 11%. And today, I think again, when the competitive intensity is far more elevated than what we would have expected, happy to stay guarded and cautious and wait for the cycles to reverse.
Very quickly, sir, you said you're going to be shifting more towards private in the motor segment. What is it at? What is the mix currently? Very quickly.
The mix for private is about 55%, two-wheelers is about 27%, and the rest is commercial vehicles.
Okay, all right. So you're saying greater focus on private, right? So the number goes to what?
So Nigel, again, let me just put this in context. This number is for the current quarter. Okay. If the market environment change, this mix can completely undergo a change.
All right. Not out of questions, but out of time. Thanks a lot for joining in. We look forward to having a chat with you, maybe in the middle before the next quarterly numbers.
Thank you, sir.
But it's time for our special segment, Quarter Se Quarter Tak. We bring expectations from each sector. Today, Upasana is going to tell us how the expectations are in the consumer durable space. Upasana, over to you.
Consumer durable companies are expected to post mixed growth trends in Q1 FY26. During the quarter, cable and wire segment witnessed a robust growth led by strong volume growth and price hikes. Now coming to EMS companies, this pack continues to outshine as demand tailwinds continue to drive growth. On the flip side, AC players are expected to witness a weak Q1 owing to delayed summer and early monsoon disrupting their overall sales. Now coming to cable and wire players, strong growth momentum is likely to continue and exports are expected to pick up. Cable and wire volume growth is expected in mid-teens, indicating a solid start to FY26. Strong execution of government-led projects, steady demand from real estate projects, and a pickup in exports should drive robust growth during the quarter. Now, Motilal Oswal estimates aggregate revenue growth of 17% in Q1 FY26 versus 11% seen last year amongst these players. Given the volatility in the commodity prices during the quarter, it estimates cable and wire margins likely to be flat on a year-on-year basis around 11.3%. Now, amongst the players, Polycab is expected to report highest growth of 17% on a Y-on-Y basis, followed by KEI Industries at 18%, while Havells and RR Kabel is expected around 15% of a revenue growth on a Y-on-Y basis. Now, Motilal expects margin expansion for Polycab and RR Kabel, while margins are likely to contract for KEI Industries and Havells. Now, coming to RAC and other appliances segment, weak summer affected the demand for RAC and other summer products. Industry demand for RAC is estimated to decline by 20 to 30% in Q1 due to high base, disrupted summer, and even aggressive channel stocking seen in Q4 FY25. Industry leaders such as Blue Star and Voltas full-year growth guidance remains intact as they are hopeful of making up for the lost demand. Also, Motilal estimates UCP segment revenue to decline by 16% for Voltas due to decline in their RAC and air cooler category, and 14% decline is what they estimate for Lloyds. In ECD segment, Kotak estimates 5% growth for Havells, while Crompton expects a decline to be offsetted by double-digit growth in pumps and appliances. Now, coming to the main EMS companies, they are likely to outshine with their strong revenue growth trajectory and aggregate revenue growth of nearly about 51% on a Y-on-Y basis in Q1 FY26. This is mainly aided by healthy demand across end-user industries and even strong order book execution. All EMS players are likely to report revenue growth barring Syrma SGS. Dixon continues to lead the pack with strong and anticipated revenue growth of 82% on a Y-on-Y basis, followed by Keynes at 50% and Sign DLM at 7%, and lastly Amber is estimated around 6% on a year-on-year basis. Overall, EBITDA margin is likely to contract for this pack by 10 basis points on a Y-on-Y basis, led by margin contraction in Cyan DLM and Amber. So let's see what holds for consumer durable as a category, but overall we are expecting a mixed growth trend.
Okay, all right. Thanks a lot for that, Upasna. Well, we have Praveen Sahai, the research analyst at PL Capital, who joins us on the show. Hi, Praveen. Good morning. Thanks a lot for joining in. Well, first up, we have some news flow on Dixon overnight with regard to their JV that they've done and that small acquisition as well. How does it change things for them? If you could put a number to the EPS upgrade you could see, say, in FY27?
Yeah, hi, Nigel. So one thing is Dixon is not under our coverage, but entering in the component that will first make them a backward integration, and definitely that will add to their profitability from here on. So yeah.
All right. Okay. All right. Well, let's focus then on the quarter numbers itself. If you had to pick an outlier in terms of a positive surprise, which would that stock be from the coverage universe?
Yes, so wire and cable companies are expected to deliver very strong numbers in terms of the volume as well as improvement in the margin. So Polycab is one of the company which expected a top line growth of around 18.5%, which is a mix of wire, domestic wire expected around 20% growth in their revenue, led by the largely volume. And similarly, that the KEI also expected around 17% of a growth on the overall basis, their wire and cable also expected around 20% of a growth. So these are the the wire companies, wire and cable companies are expected to outperform in the SPY, whereas RR, which is more on the wire-based company, expectation for the growth is around 15% for their wire and cable. Overall, they are expecting around a 12% of a growth in their top line for this quarter. Even there is an improvement in the margin profile because the copper prices, if I look at, has been a quite a firm for this quarter versus the last year first quarter. So that is the reason there is a good improvement in the margin, and we are expecting the probability for RR to improve by around 32-33%. And so as for the polycap, and KEI is on the little lower side because the margin expected to be maintained on the YOY side of 10.3, 10.4%.
But broadly, the wires and cables will have a good quarter. But they're also expensive. So between KEI, RR Cable and Polycab, which stock offers the best risk reward at this point?
Yeah, you are right. They are now run up quite significantly post correction due to a news of a new entrant. If I look at Polycab, it's trading at 36 times FY27 earning, 35 times for KEI, considering KEI 23% of earnings CAGR and 18% CAGR in the Polycab. My prefer here is a KEI because a KEI is a more on the HT or the LT cable based businesses, as well as extra high voltage segment to kicking from 27 for a KEI, and that will be a higher margin and also will drive the top line for them. So I think KEI is a better place at this point, trading at a 35 times, and our target multiple is around 40. So there is some good upside in the KEI. Versus other two, whereas RR is trading at around 30 times, and I believe the maximum 32, 33 times is a peak for the RR, looking at the volatility in the business.
Voltas, which operates in the room air conditioning market. Now we know that Q1 was a tough quarter on the back of this unseasonal rains, but that's well documented. The stock, in fact, is down 22% from the start of the year. Is this a good buying opportunity? Do you see the cycle turning and things improving, from a demand point of view? Not backward looking in Q1, but just looking ahead for Voltas.
Yeah, sure. So for a Voltas for the RAC segment, there is a one event lined up for the 1st Jan 2026. That's a BE norm change, and that will further increase the cost by 800 to 1,000 rupees. Now the summer has been very bad. Now there is a pressure on the the brands to liquidate their old inventories as well. Usually Q3 is a quarter where the most of the inventory filling is started for the summer, next summer. So I think Q3 definitely they will bring the volume, but the margin may be under pressure because of a liquidation, because the offers and discounts they need to give. Because in the past quarters we had not seen, even a tough quarter, there is no much discounts or scheme were there. So I think the margin is under pressure, will be pressure the way forward. And further, if all things is eyeing on the next summer, if that will be not so great in terms of the prediction, then there would be a pressure on the margin further of increased cost, how they are passed on. So I think we need to wait for a Voltas for the next 2 quarters at least, especially looking at the scenario in the industry. Also, I can highlight over Voltas that's their project business to somewhere is quite volatile because of international projects. There are some hiccups they are facing in. So I believe I think we need to wait for 2 quarters, and then after we'll look at the Voltas.
Thank you very much for joining in. Get into a break. On the other side, Manisha will join in to talk about commodities. Stay tuned. Welcome back. Things are quiet, at least on the index front. The Nifty and the Sensex down just a bit, 0.2% lower. Mid-caps flat in the green for now. Manisha is now joining in, and she's got her eye on copper. Manisha.
Well, thank you for that. Yes, that is because most of the metals are not trading in the positive, but copper is, and LME markets really have seen some support come back as well. That is because you're looking at better than expected Chinese data. The GDP numbers, the services numbers were on the stronger side, and various economic data reports show that the improvement in demand is sustaining, whether it's about US or China or Asia for that matter. The market's also clearly reacting to the US levying 50% of tariffs on copper from 1st of August, and the inventories ahead of this tariff has striped up to nearly 7-month highs. A lot of metal from various parts of the world has been flown into US ahead of this deadline of 1st of August. The lack of official details on whether it's going to be about just copper or copper products or copper cathodes, that clarity is something that the markets are still awaiting. So ahead of that, you've seen copper in all forms being imported into US. Well, apart from that, the premium between the US and LME, well, that continues to hold at a record 25%. And the markets do believe that this will only start to ease after 1st of August, once you have more clarity on the products and, of course, the kind of inventories that US seems to be holding. And that is the reason you're looking at such a huge price disparity that we have seen on LME and in US. When you look at the last 1 month, well, LME has seen a 2.5% decline in case of copper because there are no more takers. Whatever copper had to be sent to US already has been done. So now the copper just continues to lie around. And we've also seen the LME inventories gain up. The COMEX copper prices in the meanwhile in the last 1 month have gained up by 15%. And that exactly mirrors or calculates onto the YTD so far. While the LME copper is just about gained 10%, the US copper prices are up by 38% at this point in time. Well, US does import nearly 50% of its refined copper requirement. Much of that comes in from Chile, Canada, and even as China exported copper worth $866 million to US in 2024, the markets do believe that a lot of other trading partners with US are not in a very beneficiary state, and China perhaps could be sending more copper to US. Canada, Chile, copper just about has turned expensive, and this could really change on how copper is going to be traded globally after 1st of August. If you look at supply disruptions, that's yet another thing that the markets are really taking in support from. Remember, copper is essential to modern industry like EVs, infra, and defense as a sector. There is supply disruption that has been reported from Congo, Peru, Chile. Chile is looking at drought concerns, by the way. So supply disruptions, strong demand, and of course the tariff concerns, all of those factors are keeping the copper prices on the higher side. What is going to be even more important is the whole host of data that is coming in from US. You have jobless claims, retail sales coming in, also the home sales, builders' confidence data, all of that comes in today. And then apart from that, there are 4 Fed officials also slated to give out speeches. Markets will be taking further cues from all of these.
Okay, all right. Manisha, thank you very much for that. State Bank of India is in focus. Sources tell CNBC-TV18 that SBI is likely to launch its 25,000 crore QIP as early as today. Vivek is here with details. Vivek, morning.
Well, that's right. In line with the story, our colleague Ritu had put out, towards the end of last month, what we understand from our sources that SBI is all set to launch its mega QIP. Remember, the company is looking to raise close to 25,000 crore via the QIP route. And we understand that this QIP may be launched as early as later today. Remember, we've reached out to both SBI, and we also reached out to LIC. We understand that LIC is going to be one of the primary participants, one of the anchor participants in this large QIP. We understand that there has been a soft commitment from LIC to put in to put in bids for as high as a little over 5,000 crore rupees for this particular QIP. We also understand that demand from both the mutual fund industry, especially domestic mutual funds, has been very, very strong. SBI is likely to offer a very minor discount to this particular QIP. We understand there's probably going to be a discount of just 2 to 3% to the current market price for this particular QIP, keeping in mind that the demand has been quite strong. We reached out to both SBI, we reached out to LIC as well. Once we get a response from both the bank as well as LIC, we will update our viewers on the same. Just to give a quick update as to what exactly our colleague Ritu had reported earlier. Remember, Ritu had told us that there were 5 bankers that were appointed for this particular QIP, and the main reason for the QIP is to go ahead and augment the capital base of the company. Remember, if SBI goes ahead and successfully completes the fundraise, it will be the first share sales of the bank since 2017.
Okay, all right. Thank you very much, Vivek, for that. Markets, of course, are down about, 60 points or so. So it's a little slightly muted kind of day, 24,140. Network 18, the stock is rallying 11% in trade post its first quarter numbers. The margins have improved for the company on a year-on-year basis, while its share in viewership has risen too in this particular quarter. Let's listen in to what the company's managing director, Rahul Joshi, had to say on the performance and, of course, the road ahead for the business going forward. Just a quick disclaimer, CNBC-TV18, the channel you're watching, is very much part of the Network 18 group. Listen in.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
the same.
Can I start? Bank of Maharashtra has once again posted a pleasing set of numbers with a 23% growth in profits. Advances have grown 17%, deposits by 14%. Both are above industry levels. NIM's net interest margins are down, of course, with all the rate cuts, but they're down only by 6 basis points. The point I'm trying to make is this is one of those rare public sector banks with a 1.8% return on assets, ROA. And a 23% ROE, I think 23% would be the highest among all banks, and 1.8 ROA is definitely the highest among public sector banks. On that note, let me welcome Nidhu Saxena, the Managing Director and CEO of Bank of Maharashtra, to our studio. Thank you very much, Mr. Saxena, for coming over to our studio itself. This conversation is always better.
Thank you for having me, ma'am.
Okay, let me start with the profit, sir. The 23% rise in profit. You've been posting almost a CAGR of over 20%. Now, one small advantage you had was the tax write-back. This year, you told me last time the tax write-back will be over. So, will you still be able to post, another 25%? You've done almost 1,600 crore. So, can you give us a profit of 6,000 crore this year?
Right. So, you're right. We have accumulated losses which are remaining to be adjusted, which are available for this FY 25-26 of around 1,200 crores. So, we were aware of this, mindful of this. So, 1,200 crores I will be apportioning in 4 quarters mathematically equally. But what is not going to change, I don't see much headwinds here. I should be able to achieve my guidance and achieve the profit numbers that we are looking for. Basis which I am telling this, we have been doing extra provisioning. So we are mindful what RBI for some time, regulator tells that these are the best times, good times. Keep yourself extra cushioned, keep making extra provisionings and make yourself better for that if the cycle tomorrow has to reverse. So if you ask me, every quarter more than what IRAC norms are there, we are doing some extra provisioning, quarter on quarter basis. That provisioning will be now shifted to making extra provisions for my taxes. So by and large, that is, so this is one. Secondly, we are also growing fast. And when my growth is happening top line, growth is, mantra is very clear, growth with profitability. Yes. So we are very, very conscious about bottom line's growth. And I think put together these two things, we should be able to manage, and what we plan, we should be able to do also.
Okay. Now let me come to the more crucial question of margins, which we will ask all the bankers. You have lost only 6 basis points. What is the see, at that time only one rate cut had come. Now with the June rate cuts, you have got another double dose. So what can be the impact on margins?
So we have done our calculations with 100 bips of rate cut in stages that have come. It impacts my NIM to around 19 to 20 bips.
Okay.
If you see my cost of funds and cost of deposits in this period has come down by 15 bips. And very, very consciously, we are trying to see NIM contraction is bound to be there. And to what extent we can arrest that NIM contraction. Okay. So 15 bips versus 20 bips, there's a 5 bips. And if you see my quarter 4 NIM was 4.01.
Yes.
I have done 3.95. So it manages.
Okay.
And how we have done the cost of deposits is that we have focused more on the low cost component of the liability side. And very strategically, we have shunned the high cost bulk deposits and replaced them with alternate sources of refinance and raising infra bonds. Trying to see, and that is actually helping me protect my NIM.
So what may you end the year with in terms of NIMs? So there will be a cut in the coming quarter as well. I mean, that is in the current second quarter. But then in the third and fourth quarter, you're getting a little bit of CRR advantage.
Right.
So you may end the year with what kind of margins, exit margin?
Right. So, yes, you rightly said the retail inflation number has come.
Yeah.
Even we have looked at the governor's statement, and there is a scope for a rate cut. And we are okay with the more rate cuts as they are coming. I have a 40% portfolio which is linked to the repo. So it has to be mandatorily passed to that. We will do that. CRR, my around 12,000 crores of funds are blocked for meeting the CRR of at 4%.
Yeah.
Now with 3, I'm going to get 3,000 crores freed. I will earn something on that 3,000 crore. That is one thing which will some way offset the part of it. Then in the last 10 to 12 months, we had also done some MCLR review. And 35 bips of MCLR was actually raised. There is some portfolio which is yet to be repriced. I have 55% portfolio linked to MCLR.
Okay.
And we will see another 1 or 2 more quarters where repricing will be happening. So put all together, I am keeping a guidance of 3.75, which is a conservative guidance. This number also I had kept for last year. Despite doing 3.97, 3.98, 3.98 and closing the year with 4 NIM, my guidance last year was 3.75. I'm maintaining that conservative guidance.
But you're likely to overshoot.
So that's what we always want to wish to give the comfort to the investors that MD says, and we are able to deliver. Bank delivers what guidance number is there. So we want to be conservative. 3.75 is the.
What about advances? Will you be able to, this 14%, 17% growth in advances is, very good compared to the system, almost double. System was running at 9% last quarter. Now it has risen to 10. Where will be the growth triggers? Will it be retail? You have not done much on MSME. Will that be, what will be your growth horse?
Right. So we are looking at all the verticals, and I am trying to look at wherever the profitable growth opportunities are there for us, we will definitely participate, whether it be corporate, MSME, agriculture. So RAM plus corporate, I have kept a guidance of doing 60-40, but that number is not something sacrosanct as we see more opportunities. So in the corporate book, we are bullish in sectors where there is a lot of emphasis coming from government. So in the infra, and we are also examining what the risks are there. We are comfortable with road projects under HAM model which are coming from NHI. We are bullish on LRDs. In my last 12 months, we have done a lot of green finance. So renewable energy is one area where we are very bullish on. Data centers we are doing. So all these kind in the corporate sectors, corporate side we are doing. RAM is also doing fantastic. Agriculture and MSME, these two verticals, I have created 2 verticals this year to have a complete focus. And we have done, then the third element is some co-lending interesting partnerships. I have ramped up the co-lending partnerships from 2 when we began the year to 9 now. And it is becoming a substantial book. We are using some in-house technology that is there to take care of the transactions.
Fair points. Actually, I'm out of time, and I wanted to ask you about the way in which you have been able to get the Supreme Court of India account and other accounts, but that longer discussion for another day. Thank you very much indeed for joining us with your thoughts.
Thank you so much for having me.
Okay, so that's the word coming in from Bank of Maharashtra. Excellent set of numbers. And I think an OFS will also come because they are 79%. But that conversation another day. Wrap up on Bazaar. Chartbusters coming up.
Shares of Dixon Tech trade higher as it forms precision component manufacturing joint venture with Chongqing Yuhai. Also enters the camera module manufacturing with the acquisition of 51% stake in Q-Tech India. Brokerages CLSA, JP Morgan and Nomura are bullish on the stock. Network 18 trades with gains of over 10% after reporting a profit versus a loss in the corresponding quarter last year. The company's operating cost falls 5% while viewership share rises. HDB Financial shares fall as profit and disbursements dip in the first quarter. AUM growth remains modest while asset quality was hit by the commercial vehicle segment. Shares of MAS Financials trade higher as Nippon India Mutual Fund raises stake in the company, buys nearly 20 lakh shares or 1% equity for about 61 crore rupees. And ICICI Lombard rises as the first quarter profit for the company increases 29% to over 740 crore rupees. Management, however, tells CNBC-TV18 they're seeing increased competitive intensity.
Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam, and the headline index, well, it's a little bit under pressure. We're down close to 50 points, but the story yet again is in the broader markets because the number of stocks advancing are better than the stocks that are declining. And as we have seen the last couple of trading sessions as well, the small cap index has rallied more than 2% in a week that the Nifty hasn't done much. Hey, Mangalam.
Nigel, all the indices above my head, Nifty, mid-cap and the bank index doing a lot better.
These guys,
you'll have to just support them. You'll just have to support them because really no concerns out here.
Yeah.
You know, yesterday we did fairly well. Yes, the last 4 trading sessions were weak, but yesterday we recovered from those lows, and today as well. While we are lower on the frontline index, the broader market is doing a lot better, 1,500 stocks which are higher. And even in the frontline indices, a lot of stocks are putting good gains. You have HDFC Bank, a key weight on the index, up around 0.2%. IT stocks are bettering themselves for the last 2 trading sessions. So Wipro is up around 0.8%. And we are seeing continuous up moves in a couple of these FMCG names, case in point, something like Nestle India, which is up 1.5%, and the broader markets doing a lot better. Titagarh Rail Systems, for one, is up around 1.5% as well as we speak this morning. Chandan Taparia of Motilal Oswal Financial Services joins in for a quick technical check on the market. Chandan, we've been consolidating, grinding lower from lower levels, seeing a bit of an up move. Now we're lower by 50 points. Do you think this dip is worth buying?
Good morning, Mangalam. Thanks for having me. So I believe that the market is likely to consolidate, but the good part is yesterday it negated the lower top, lower bottom of last 4 or 5 days and formed the bottom near 25,000 marks. In fact, we have seen put writing at 25,000 and the index is also holding well to its rising support trend line. Earlier, 25,000 used to act as a key hurdle. Now the same can provide some support. So I believe with support of 25,000, index has potential to remain positive to range bound for an upside move towards 25,400. And to talk about Bank Nifty, that also negated the lower top, lower bottom, holding the gains, but comparatively follow-up is missing. With support of 56,750, Bank Nifty has potential to rally towards 57,500. So in both indices, looking for some positive to range bound bias, while at the same time, stock specific and selective sector can do well in this scenario.
Okay, let's hear then the stock specific action that you have, Chandan.
Yeah, good morning, Nigel. Thank you. So first trading idea, that is buy on Paytm. The stock has been making higher tops, higher bottom from last 4 or 5 trading session. We have seen build up of long position and now counter is heading towards the fresh leg of rally. In fact, on the monthly and the weekly chart, the setup indicates fresh leg of rally. So recommended to buy for an immediate surge towards 1,050. One can buy with support of 990 level. Second idea, that is buy on Titagarh Wagon. We have seen open interest addition of around 3 to 5% in the counter. And a small follow-up could see the next leg of rally. In fact, on the daily chart, we are witnessing a pole and flake kind of pattern, which has bullish implication. So recommended to buy on Titagarh Wagon with support of 940. And here this stock can head towards 4 digit of 1,000 marks. Last trading idea, that is buy on LIC Housing Finance. A long consolidation breakout of almost 12 weeks is now coming for a fresh rally. We have seen short covering, call unwinding started to witness with higher base in the counter. So recommending to buy on LIC Housing Finance with support of 615 for an upside target towards 660 marks.
All right, Chandan, thank you so much for joining in. A lot of these small cap names also buzzing. The cash stocks. Pull up Tilaknagar Industries. That's the one which is up around 7%, has done well this week, up around 12% for this week. We have also seen some traction in Protean e-Government. Remember, that stock was down and out and now has seen some recovery from the lows, up around 5.5%. And Godrej Industries, that's the other one that I'm looking at right now, up around 5% for that stock as well. So there is Tilaknagar Industries doing well. We have Protean e-Government and we have Godrej Industries, which is up around 5% as well. So in a market like this, what are the ideas for profit? Let's go across to our colleagues at Money Control Pro who are joining in with some ideas for profit. Khushbu Rai joins in with the stock.
In today's idea for profit, we have Home First Finance Company, a key player in the high-growth affordable housing finance segment. For Home First, early adoption of technology and strategic market selection has driven scale as well as profitability. The focus on emerging states like Rajasthan, UP and MP will further drive penetration in high-growth regions, which will drive sustainable growth in the medium term. The company has also maintained strong focus on improving the collection efficiency and reducing early bucket delinquencies, both of which has supported the asset quality in FY25. The recent capital infusion and credit rating upgrade is expected to lower the overall cost of borrowing and drive net interest margin expansion. Home First's productivity is unmatched thanks to the technology investment, and we feel that the steady NIMs and credit cost and lower leverage will drive return on asset in the coming period.
All right, with that, let's tell you a programming note as we move into this short break. Remember to tune into the all-new CNBC-TV18 Prime, which brings you insights from policymakers, business leaders, economists, all of them shaping both India and the world's future. CNBC-TV18 Prime decodes global shifts and the impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC-TV18 Prime at 12 noon for Global Reset, at 1 p.m. for Big C, and the Global Lens at 8:30 p.m. all weekdays and weeknights.
Welcome back. You're tuned into Chartbusters. Let's focus on a couple of stocks that are buzzing around. Biocon has received an approval from the US FDA for diabetes drug. Ekta joins us to fill us in with details on that. Ekta?
Well, yes, an important approval for Biocon, which has come through, where they've received approval from the US drug regulator for their biosimilar insulin aspart, which is basically used for diabetes. Now, this particular approval was pending for some time now because they had received a complete response letter from the US FDA, which had brought up some amount of issues with regards to the Malaysia facility where this particular drug was being manufactured, and this took place in 2022-2023. Eventually, the Malaysia facility got re-inspected in September of 2024, and now they've received the US FDA approval for insulin aspart. Remember that they've already received approval in other markets such as Europe, and they have been selling it in other markets such as Europe already. Now, in terms of the size, it's around $1 billion in terms of market size for Biocon in the US, and it is possibly expected to be around a $100 million opportunity for Biocon. But based on market dynamics, such as the kind of competition that they would probably see from the innovator itself and the changing landscape of diabetes drugs, the opportunity could probably even go up to $300 million, however, contingent on a lot of factors.
Thanks a lot for that, Ekta. Well, let's focus on the other buzzer. That's Dixon Technologies, buzzing in trade on the back of a new acquisition and a JV as well. Vinny joins in to fill us in with more details on that. Vinny.
Hi, good morning. So yes, we're seeing Dixon Tech that's in focus, buzzing in trade. Like you mentioned, one is an acquisition, one is a JV announcement that's come in. Now the acquisition, they're acquiring 51% stake in Q-Tech. This Q-Tech company, what does it do? It's among the top 5 camera module suppliers, and in India, it's one of the largest. So this acquisition is a backward integration for the company, but this adds value to the company. They've been focusing a lot more in terms of backward integration. So value addition comes in on the smartphone front for the company in terms of manufacturing and manufacturing components as well. Now the other announcement, that is the JV that they've signed as well. This JV is a 74% JV that Dixon will hold, and the 26% JV part will be held by Chongqing, which is a precision component manufacturer. This is mainly where is these components used? They're used in mobile phone, laptop, Internet of Things devices, automotive applications as well. So a lot of this will be used internally for them, and backward integration again in terms of this is a positive. Now, obviously, do not forget in the recent time they had HKC JV as well, which was for a display module of phones as well. So that was also a positive there. And because of all these JVs and acquisitions, this is a positive coming in here, and brokerages are also giving it a thumbs up. Now look at what CLSA is saying. Outperform rating, target price of 19,000 rupees. And what they're highlighting is that this JV will add value to Dixon. That would be around 45% to 55%, I beg your pardon, from the 15 to 17% that is currently there in terms of value addition. So sharp rise there, increase in terms of margins by 150 to 200 basis point is what one could see coming in. Even JP Morgan is saying that this backward integration will get completed by Q2 FY26. That would be a positive and add to the revenue of the company in FY26. Additional revenue would be around 2% for FY26, 3% for FY27, and margins also improvement in terms of margins. Nomura also is giving it a thumbs up, and that is why positive notes, backward integration, overall a positive for Dixon Tech.
All right, positive for Dixon Tech, and that's reflecting the stock as well, up around 3% right now. Just keep an eye out on a couple of other stocks as well, which are spiking right now. We have Delivery, which has moved to the high point of trade. Kalyan Jewelers has been doing well all through the morning and currently has now surged to the higher point of today's trading session as well. And it's a big recovery from the lows that we're seeing on a name like SML Isuzu. Remember, the stock has seen a big rally already, but now if you pull up the intraday chart of SML Isuzu, you would see that there has been a recovery from being down almost 4.5%. The stock has moved into the green.
Yeah, right. In Mangalam, another company, TFS, has just listed the travel food services company. Yes. I recall you saying that from the highs, it hit a high, opened up in the green, and then it corrected last couple of trading sessions. In fact, on the listing day, it ended in the red. It appears the initial sellers, they seem to be absorbed out because today as well, the stock had opened up in the red, but TFS, Travel Food Services Company, I think we should get that stock up. It's popped up in trade, so just keep an eye out on that particular name as well. The new listing, suddenly it saw a bit of a spike from around 10 a.m. odd. And the other one is Vascon as well. Small EPC company that's moved into real estate. that as well has seen a bit of a bounce, and it's moving on rather large volumes, not just today, but the last few trading sessions, it's seen a bit of a spike up.
All right, let's move on and let's get you some important exclusive conversation. In his first television interview since taking charge, the RBI Governor Sanjay Malhotra says he's not allowing foreign banks to own a 26% stake in Indian banks. Defies logic. In an exclusive conversation with Lata Venkatesh, he promised that the RBI will examine cases if there are requests. And the governor was also asked about this in the context of, remember, Dubai-based Emirates in NDB Bank potentially picking up stake in private lender RBL Bank. Here's what he had to say.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So, what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So, as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%. Yes. All right? And the foreign banks can actually start business in our country as even up to 100%. So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
All right, with that, we'll take a short break, come back on the other side, more news and updates. Welcome back. Markets actually not much changed from the time when we started this show for the frontline index, though we have a couple of stocks which are spiking from the broader markets. We have Patanjali Foods, which is up around 3.5%, a stock that was buzzing yesterday as well. The board meets tomorrow to consider bonus. Titagarh Rail Systems, which was one of the picks that Chandan gave us, that too has moved to the high point of trade. And we are seeing some traction in Sammaan Capital. That stock too has moved to the high point. On the other side, there are some stocks which are seeing some profit booking. So we have Nykaa, which has moved to the low point of trade. Marico is doing, weekly in today's trading session, or rather well asked for rather than well bid, which is why it is at the low point at a time when all the other FMCG companies are doing well. And AB Fashion and Retail is the other one, which is lower as well. But let's go across to Vivek now. He joins us to tell us something about Veranda Learning. Vivek, it's a fundraise that the company is eyeing?
That's right. It's a fundraising spree across, most promoter-driven companies. So what we understand is that, Veranda Learning is in the market. They're looking to raise funds. And the mode that the company will be looking to raise funds is most likely going to be via the QIP route. In fact, we understand from our sources that the QIP could be launched as early as this week. The company is looking to raise close to 380 crore via the QIP. And we understand that the majority of the proceeds of this particular QIP would be used to retire debt. Now, the company has close to 340 crore of high-cost debt that they are looking to retire. Now, given the fact that this particular QIP and the quantum of the QIP forms a significant part, in fact, of the current market cap itself of the company, we understand that there could be a significant discount to the current market price in order to go ahead and attract investors to go ahead and participate in this particular QIP. So Veranda Learning are looking at raising close to 380 crore via the QIP route. We understand that this will be done as soon as this particular week. We reached out to Veranda Learning earlier today. We are yet to receive a response from them. It will be interesting, number one, to understand the quantum, the usage, as well as what will be the actual discount to the current market price that the company has will be offering the investors. We understand that there has been interest from large HNIs as well as family offices for this particular QIP.
All right, Vivek, thanks a lot for that. A QIP, a fundraise coming in from Veranda. The key point to note is that this will be used to retire debt, but more importantly, the offering itself could be at a significant discount to its current market price. With that, we'll leave you on this edition of Chartbusters. Thank you so much for watching. On the other side of the short break, you have the team of Trading Hour taking all the market action forward.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal, and with me, as always, Hormis Fatakia and Reema Tendulkar. Good morning, guys. Well, yesterday we saw markets at least maintaining the gains that we saw. But today there seems to be some profit booking or consolidation, so to say. It's a 60-point downtick that we are looking at the Nifty right now. 25,135 on that one. Mid caps are flat, but there is some positive bias to that. Banks also flat. So while HDFC Bank is lending some support, the others are pushing it lower. So it's a mixed picture as far as banks are concerned. Important flash at the bottom of your screen. Jio BlackRock AMC, it has received a SEBI nod to launch 4 passive funds. The passive market, that is doing really well. There has been a massive growth in the AUM when it comes to the passive mutual funds as well. And do remember, Jio did see a good response to their liquid fund as well. And right now, with the savings bank rates coming down, people are looking at investing more in liquid funds. And now, for more passive funds, that is an offering that we'll be watching out for from Jio BlackRock.
And I think I remember you telling me once that, you can access this via the apps like MyJio or any of the Jio platforms. So it's going to be digitally very accessible, and they're going to eliminate perhaps a distributor or bypass the distributor. So, the question is, will this in a way disrupt the entire AMC industry? Early days, but it's the latest development coming in from Jio BlackRock. They've got the SEBI nod to launch 4 passive funds, so that's a seminal move. But for the markets, as you rightly pointed out, things are on the quieter side. The Nifty and the Sensex slightly lower, mid caps holding flat. In individual stocks, Shriram Finance continues to be the top loser. That's lower by nearly 3%. Auto stocks, which raced ahead yesterday, are retracing a bit. Hero MotoCorp and M&M. Both of them are down in excess of 1%. Eternal has a cut of 1.5%. Sun Pharma is losing ground. A couple of metal names are under pressure. And on the way up, it's Nestle, Wipro, Adani Ports, IndusInd Bank. These constitute your top 4 Nifty gainers right now.
Interesting moves that are coming in. But since we were on the subject of Jio BlackRock, the 4 passive funds, it has been given approval to launch. One includes the Jio BlackRock Nifty Mid Cap 150 Index Fund, the Nifty Next 50 Index Fund, the Nifty Small Cap 250 Index Fund, and the 8 to 13-year GSEC Index Fund. So these are the 4 passive funds that SEBI has given its approval for Jio BlackRock to be launched, and the stock too duly recovering from the lows of the day after the news that has come in. Some of the other peers as well within the space. HDFC AMC was one stock. That stock was trading at a record high earlier in the morning, and it's continuing to build on those gains even in today's trading session. 1% higher on that stock. So now, based on the current price, the stock is up 5x from its IPO price, which was around 1,100 rupees a share. So multi-bagger turning out to be is HDFC AMC. But some of the other movers within the broader markets, Metropolis is among the top gainers today on the Nifty 500. And that, of course, is on the back of some rising cases in the city of Mumbai with regards to malaria, dengue, and a lot of these other monsoon-related illnesses. The stock is seeing a bit of a reaction today, 6.5% higher. Pull up Dr. Lal as well, just to see if that too has seen a bit of a reaction in response to the moves that Metropolis has seen. Not quite. The stock trades absolutely flat in today's session. So that is one of them. Zensar is the other one, 4.75% higher on that stock. And among the top losers, some of the other top gainers that were in yesterday's session are seeing a bit of a reaction today. Newland Laboratories has seen a very significant up move in the recent past, seeing some profit booking, 5.5% lower on that stock as well. We take this market conversation forward with Shisadri Sen, who is the head of research and strategist at MK Global, who's now joining in. Mr. Sen, good morning. Thank you for joining in. We are at a very interesting juncture when it comes to the market, be it our own or be it the global markets as well, because of the fact that there are so many moving parts, right? We are still awaiting clarity on the trade deal with the US, which is likely to happen based on what the US president has said by the 1st of August. We still don't know the contours of that. We are in the middle of an earnings season that has so far flattered to deceive. It's not been the most impressive start to the earnings season. Do you see the valuations to be justified, considering the fact that the macros so far have been relatively stable?
Hi, thanks for hosting me. A lot of questions packed into that, so let me take it one by one. In terms of the weak earnings season, yes, we anticipate a weak earnings season in this first quarter. While we are constructive on an economic recovery in FY26. We think it's going to be back-ended, and most of the earnings growth will come in the second half of this year. So from a medium-term perspective, the weak earnings season shouldn't matter. We don't think that there will be major earnings downgrades on the back of this weak season. But in terms of a near-term impulse, this is undoubtedly a negative. Secondly, on valuations, the 10% rally in the Nifty in the first quarter of this financial year has taken a lot of the valuation comfort out. We wouldn't say that valuations are in bubble territory. They are neutral. Most of the indices are trading at between long-term averages and +1 standard deviation. So that's not alarming, but it's not really comfortable for it. What we are saying is that from here, stock performance will be driven more by earnings growth rather than re-rating. The re-rating has done its heavy lifting in this last 3 months. And from here on, earnings growth and earnings upgrades will be the key driver for the market. So, and the other factor, the point that we are making is that in the short term, for the next month or 2 or 3, the markets are likely to mark time because, as you correctly pointed out, there are other moving parts as well. The trade deal will come through, and the full impact of that, I think, can only be assessed once it's announced. There are too many moving parts in that. And the impact of the monetary easing, what we expect it to come through strongly in the second half, is not visible yet. And near-term macro indicators are also sort of iffy. Growth numbers, monetary transmission numbers are, if you look at concurrent numbers, they are not very constructive. So our belief is that after this strong rally, you will see a little bit of a pause in the markets. And if we are right on our overall macro thesis that the rate cuts will translate into a consumption-led revival in growth in the second half, then you will see the next leg of market performance come in at that point.
Okay. Seshadri, I wanted to get your point on what's happening with the primary market. Suddenly there's a flurry of IPOs. What does that indicate? Does that indicate that there is a froth now? Or do you think this is something which can indicate positive market sentiment as well?
For a longer-term perspective, I firmly believe that IPOs are good for the market. They help widen the universe. They help absorb flows and avoid bubbles getting created. One of the reasons why we are not into bubble territory yet is because despite very strong flows from both domestic and international investors, there's been enough supply to absorb some of that. And so from a long-term perspective, I'm not worried about IPOs and new companies coming to the market, especially when some of the macros in India are changing, some new sectors are emerging. It is logical that some of those will come to the market. Internet, ENS, so, you will see more and more companies coming to the market in some of those sectors, green energy, etc. From a short-term perspective, yes, it does create an overhang. But I don't think we've seen that kind of, there have been flows which match these IPOs, right? And therefore, it's not creating an overall pressure on the market. That is not, to me, a major worry. It's good for the long term, and in the short term, the market is healthy enough to absorb these IPOs and create. And many of these are very high quality companies which are coming through. So I don't think that is a major worry, at least from my perspective.
Got that. Seshadri, hi. So how stretched are the mid and small cap valuations right now? Which are the pockets where you think there is a risk that overvaluations will need to get corrected? And where do you see some pockets of a reasonable risk reward right now?
Overall, I don't think mid and small cap are overstretched on valuations. The optical high numbers have many nuances to it. In summary, the mid and small cap, post-COVID, that entire universe has shown better growth than large caps. With stronger, with improving balance sheets. And I think that's something that's missed. In the post-COVID world, cash flows have improved, ROCs have improved, debt has gone down in the small and mid-cap universe. So for them to be trading at slightly premium valuations is not a surprise. Moreover, it is also down to sectoral composition. We did a piece some time ago which pointed that out. The large cap universe is very heavy in some structurally low PE sectors like banks and energy. Whereas the large cap, the small and mid cap universe has a much smaller share of those sectors, which is why optically the valuations look easy. If you break it down and look at sectorally, there is not a case to be made that there is a large bubble building up there. In terms of where do we find value in terms of the large demand, you're absolutely right. With the indexes trading in the 30s, there are pockets of overvaluation. So as I said, when the valuation comfort goes, you've got to be more selective. Where we like small and mid caps, auto and auto ancillaries is one space where you're finding reasonable value. I think in that consumer discretionary space, you will find industrials is the other area where if you look hard enough, and especially the power ecosystem, there are plenty of opportunities for the small and mid cap. In some sectors like FMCG, which I'm structurally bearish on, value will be found in the small and mid cap space because that's where the market share gains are coming.
Interesting, bit of an anti-consensus call on the financials, Seshadri. I remember speaking to you about this the last time as well. You still continue to remain underweight on the sector. Is the NIMS compression worry the only factor behind why you remain underweight, or there are multiple other factors as well that keep you on the negative side when it comes to what is possibly pretty much a consensus bullish call on the street?
Near term, it is NIM compression for certain. There is a small worry I have that the street is underestimating the quantum of that NIM compression, and therefore you may see a little bit of earnings downgrades coming through in the short term. But my view is not based on that. My view is a more longer term structural view where the banking market cap is largely composed of private sector banks. And the large private sector banks have seen a structural fall in their growth rates. I've covered this sector from the beginning of the century, and we've defended 4 times price to book for some of these banks because they were growing at 25%. Now most of them are struggling to grow above mid-teens. And once your growth falls to that level, then it's difficult to sustain the high price to book. Admittedly, some of those price to books have fallen, but even a 2.5 time price to book is very difficult to be supported by just a 14-15% ROE when you're not even 14-15% growth when you're not even exceeding your ROE in terms of growth. Moreover, profitability is becoming more difficult to find. So it's a structural call. It's not just the names.
We get that point. Thank you so much for joining in with your insights, Seshadri. Always a pleasure speaking with you. That's the word coming in from MK on Indian market outlook. But for now, we'll slip into a break. Up next, we'll discuss what's buzzing in the commodity space with Manisha Gupta. Stay tuned for that.
Welcome back. Shifting focus now to commodities. Manisha is here and she will be talking about crude oil prices. Manisha.
Thank you for that, Hormuz. I'm doing that because after 2 days of decline, there is some support coming back in case of crude oil prices. We seem to be holding around that 69.70 mark. What the street also is looking at is improved demand signals, especially coming in from US and China. It is summer travel season in most of the Western world. It's holidays there. And the rise in gasoline consumption is what really seems to be supporting the markets. Well, that's about US. But when you look at the Chinese market, whether it has been about manufacturing numbers or the second quarter growth, which has been better than expectations, also leads the markets to believe that China, which is the largest consumer for crude oil, could be looking at improved demand going forward. And then there was an OPEC report projecting strong global economy in the second half as well, and in anticipating that the demand will be stronger, especially from countries like China, India and Brazil. Markets also are looking at OPEC's June output, which is 41.56 million barrels per day, which is higher than what we saw in the month of May, but still lower than what the OPEC has introduced into the markets as additional output production. So those numbers lagging also has been supportive. It also is about API, which is suggesting that 10.1 million barrels of increase in inventories is what we could be looking at. This clearly means that there are refinery runs which have declined, and that indirectly is supporting prices at this point in time.
Okay, all right. Thank you so much, Manisha, for joining us as always and telling us what's happening in the world of commodities. With that, we'll slip into another break. Alok Mishra from Microfinance Institution Network will join us next. We'll talk about the microfinance sector and what's happening with rate moves there. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. Let's talk about microfinance institutions. They appear to have raised their lending rates even after a percentage point reduction in policy rates in the country. To discuss this and more, we are now joined by Alok Mishra, CEO and Director at MFIN. Mr. Mishra, good morning. Thank you so much for joining in. Well, there are reports suggesting that MFI institutions, they've gone ahead and increased their lending rate. This is despite the 100 basis points cut that we've seen in repo rate. First, is that true? And second, if it is true, what is the reason?
Yeah, thanks for having me here. And it's a very, what should I say, a technical topic. So give me some time to explain it. Number one, when you refer to the reports, I think you're referring to a specific report which says that the 2 or 3 institutions have raised their lending rates. Let me tell you that we track the data on monthly basis for all our member NBFC MFIs. If I compare Q4 of the last financial year and Q1 of this year, I don't see any movement overall in the weighted average interest rates. It has remained in the same range between 23.6 to 23.7. 1 or 2 institutions might have raised their interest rates by 15 basis points or 20 basis points, depending upon their individual situation. That might be true. And that is true. I should not say might true, that is true. But we have to look at the larger perspective. And when it is linked with repo rate cut, let me tell you the critical fact is that while you rightly say that the repo rate in 2 stages have been cut on 100 basis points, if we look at the cost of funds, which the NBFC MFIs get from banks, the reduction has hardly been not even 15 or 20 basis points. And on top of it, the lending to the microfinance institutions has got reduced by 53% year on year, if I compare Q4 of 24-25 with Q4 of 23-24. And what that entails is that not only has the repo rate not been fully transmitted, because the last cut was only in June or July, it will take time for the repo rate cut to transmit. And we all know that transmission takes time from banks to NBFCs. So first, that has not happened. Second, the bank funding has got slashed by around 53%. And because that has got slashed, the other sources of funds which you have to rely on are a little costly. But despite that, the sector's overall weighted average interest rates has remained range bound. And as a proof of that, let me also tell you, the other proxy indicator can be, if you look at the financial results of FY 24-25, quite a few of our top players also have incurred losses during the year because the credit quality losses have come in.
So going ahead, on an industry-wide basis, on an average, do you expect the rate hikes that we've seen from 1-2 institution to spread more? Or do you think the repo rate cut will now kick in and on an average the rates come down? I mean, what's going to be, and give us a timeline.
Now, the timeline has to come from the banks. If the funding starts and if the funding passes on the transmission of the rate cut, from our side, what we can say is that the credit quality worst period is over. Now the credit quality is getting back to normalcy. That should come in by Q2. That we are already started the Q2. By Q2 end and start of festive season, it should get to almost to normal level. If the bank funding also resumes to the levels which we saw in previous years, and the rate cut is passed on, I am sure that the rate rationalization will happen sooner than later.
Have you all spoken to banks? I mean, are they willing to lend? I mean, last year you said funding was down 53%. What was it in the last few months?
When I say 53%, I was referring to the cut. If I look at Q4 of last year to Q4 of even year to that. So regarding banks, as you would be knowing that last week we had a symposium of NBFCs with organized by DFS, where the Honorable Finance Minister had an interaction with us. We have requested our request, and even the Honorable Finance Minister has exhorted the banks to start lending. We hope, and we are also making efforts talking to the banks, giving them confidence. So if the lending starts and the rate cut is passed on, which RBI has done its job, now it is for banks to do the job. And rest assured, if it comes to us, we will do our job.
Okay. Mr. Mishra, where are we in the cycle? In the past, we've seen data suggesting cyclical nature of MFI segment, but it does see a sharp rise after the problems that we see. Where are we in that cycle? Do you think it has bottomed out?
Well, It's a very good question, and again, it will require a largest answer, but let me give you a brief answer to it. I see that, there are the problems come from two angles. One is if there is excessive lending or over leveraging or external impact. Last year, what we saw in pockets, I would not say that everything was hunky-dory. Yes, there was some stress. Plus, there were a lot of external events, starting with non-state actors disrupting credit discipline, with even Reserve Bank had to intervene and issue a press release. So that is, I think, almost contained. Credit cycle, all the guardrails which we have put in, all the members and even the banks and SFBs who are our members are following it. That is also being followed. So I feel if we continue that path and there is no major external disruption, the worst is over.
Okay, so the worst is over. That's a big statement. And thank you for explaining that to us so comprehensively. And always a pleasure speaking with you, Mr. Mishra. Thanks a lot for joining in today with your take with what's happening in the industry as of now. So the word coming in is that lending rates are largely stable. There are credit cost issues, and that's the reason some of the players have gone ahead and increased lending rates by, say, 10 to 15 basis points. We'll slip into a short break now. When we return, we'll discuss market technicals with Miresh Thakkar and also discuss his top trading bets.
Welcome back. Still 50 points lower on the index. Some flashes on your screen there. Premier Explosives has bagged an international export order for the supply and manufacturing of defense explosives worth 105 crore rupees. The stock seeing a bit of a perk up after the order win. So 2.75% higher is Premier Explosives at 550. Mitesh Thakkar joins in now for a quick chart check. Mitesh, thank you for joining in again. You mentioned that your bias remains towards the downside. You still expect the Nifty to grind lower towards the 24,900, 24,800 levels, and of course your stock recommendations for the morning.
I think that's a very strong possibility, given the fact that today is to a certain extent the Bank Nifty, which is kind of supporting the Nifty. Otherwise, we could have had a much lower level. So I believe that a retest of 25,000 is very likely, and maybe 24,860. And this negative view will hold as long as we don't get past 25,300, 325 zone. So in that sense, yes, I think the chances of downside declines are possible. On the stock side, I have a buy on Maharashtra Seamless with a stop at about 719. Look at targets of around 765, 770 to begin with, maybe even higher levels. But that's the initial target. And the other one is Alchem Labs. Disclaimer, we have some positions over there on the future side, so there's vested interest, but Alchem Labs could be bought with a stop just below 49.85 for targets of around 50.80.
50.80 on Alchem Labs. Stock is spiking up, in fact, as we speak. You can see that in the price action. Thank you very much for joining in. Just a quick word on Just Dial. So that's under pressure post the Q1 numbers. The reason number one is growth for the company has slowed down. About 5 quarters back, it had a growth of close to about 16%. It came down to 13.6%, and then it started moderating to single digits. And in the last quarter, it came in at mid-single digits, a 6.2% revenue growth on a year-on-year basis. And that chart will come up for you on your screen. Paid campaigns, too, have slowed down. From high single digits, we're looking at low single digit kind of 4.3% kind of paid campaigns growth. The question is, margins are resilient so far. Margins have come in at 29%, but will they be sustainable? The business development related costs, according to Ambit, they say the business development related costs are now starting to creep in as the company has restarted with Salesforce hiring and ad spends. So therefore, they believe the ad spends are not sustainable. Last year, the company's overall margins were in excess of 29%, and they believe this will come down to 25% by FY28. So they have a sell rating. As they say, the revenue growth trade-off with margins will continue. On the positive side, though, the cash on the books, right? The cash on the books is nearly 5,500 crore rupees. Citi has a buy call on Just Dial. They say undemanding valuations. Because if you look at the valuations, X of cash, cash accounts for more than 2/3 of the market capitalization. X of that, the stock is trading at sub 8 times forward multiple. And then you've got that potential for cash deployment, which can boost growth. So that's the Citi view, which is why they have a buy call with a target price of 1,100. But for the day, the stock is reacting to slowing revenue growth. And now revenue growth for the company is down to mid-single digits.
The lowest point of the day is Just Dial. The Citi, though, remains optimistic, but the street, as of now, not quite. The stock did open higher, but since then has seen some selling pressure. Take a short break. On the other side, we bring you excerpts of our conversation with Network 18's Rahul Joshi over the first quarter performance. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Network 18 that stock has rallied over 12% in trade post its Q1 FY26 numbers. Margins have improved for the company while viewership share has risen too in the quarter. Our colleague Prashant spoke to the company's managing director Rahul Joshi and began by asking him on the company's revenues and margins and also on the overall environment going forward for the business. Listen in.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%, but from last year it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops.
Rahul, just one number out of the way, and then we can get into specific segments, etc. You've recorded exceptional gains from an investment revaluation in this quarter. Outside of such one-offs, can you tell us when do you see the total business returning to consistent profitability? I mean, what's the timeline like?
No, so that number that you see there is because of assignment of voting rights to Inadu in light of the CCI dictated sort of order at the time of the merger of Viacom 18 and Star and Disney and Viacom 18. So we had to market to fair value and not at cost. So which is why you see that bump up in that number. So that explains that part. And I think that in this first quarter we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. I think we'll have to keep an eye on the earnings next quarter. So things are looking up, but I wouldn't rejoice at the moment.
I mean, the festive season is going to be upon us. Is that typically that is a bit of a, that gives a bump up, a tailwind, right, to advertising revenues?
No, yes, of course it does, because clients are waiting for the for the sentiments to improve, for the festive mood to kick in, and that is when they also open their purse strings. So I remain hopeful that July is looking slightly better. I wouldn't be very excited yet, but I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We have only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
Advertising, of course, is outside of one's control, but you've at Network 18 driven and focused on subscription revenues in a big way through platforms. I mean, reach is 300 million. Money Control Pro has done quite well, but that question still comes up. Can subscription revenues really scale in a big way in a price-sensitive market like India? And you're doing this across properties now. Could you give us a sense of what's happening in each of these properties?
No, that's a good question, and I'm glad you asked this. 4 years ago, when we were embarking on our subscription drive with Money Control Pro, there were a lot of people who told me that you will not even get 10-20,000 subscribers. It would be a huge success if you managed to get that number. So we started with $9.99 per annum, And very quickly, we notched up a number of 1 million in 4 years. 4 years, we hit the 1 million mark. Now, that is quite remarkable. We were so enthused by the success of this that we have now launched something called Money Control Super Pro, priced at 2,500 rupees per annum. It's just 2 months that we have launched it, and the numbers are really heartening. So this gives me reason to believe that the naysayers, were entirely wrong. There is a market for where people are willing to pay. If there is high-quality content, if there are tools that will enable traders and retail investors to, in their investment journey, there is every reason that they will pay. So on CNBC also, we have started something called CNBC Access, 10,000 rupees per annum. So we're getting more and more ambitious. And 10,000 rupees, it is not like Super Pro or Pro, which is only giving stock advice or tools, but it provides, it sells the entire CNBC experience. So you'll be invited to all the events, you get to interact with the anchors, you get to visit our studios, you get value-added shows, you get exclusive interviews only behind the paywall on CNBC Access. So we are hopeful that we'll be able to crack this 10,000 rupee price point as well. So as you see, our price points are only going up. People are continuing to pay. The question is, if you are India long and you take a punt on the economy over the next 10 years, it remains the fastest growing economy in the world. I have every reason to believe that subscription is the only way forward. The people who latch on to this early on will be able to reap the benefits in time to come.
Absolutely. I mean, media is one of the top consumption sectors and is a play on consumption. So for these two, Money Control Super Pro, CNBC-TV18 Access, if you can give us an early sense of how these, it's very early, but I mean, are they doing as well as you thought? And can they become sizable revenue streams going forward? How long will it take, the journey take, in your opinion?
So, just to give you, I can't speak numbers and I don't want to get into granular details, but let me give you a perspective. Money Control till about 4 years ago was absolutely and only driven by one revenue source, which was advertising. Today, we are doing subscription through Money Control Pro and now more recently Super Pro. We also launched lending on our platform. We do unsecured lending on our platform. No default risk on our balance sheet. We have onboarded partners, lending partners, and we get some commission from that. We've started that also as a new revenue stream last year. We've done almost a year of that. Very enthused about the performance and how we have done in the lending business. So as you see, we are moving away from content, advertising to subscription to even lending. And if I were to give you an idea, maybe last year from 100% advertising, we did about 70% advertising and 30% non-advertising revenue. Right? I am reasonably sure that over the next few years, this will substantially change in favor of revenues and in favor of subscription revenue and other forms of revenue. That is the only way we'll be able to grow our business. We have to keep growing advertising. This does not mean that if advertising becomes 50% in the next 2 years, that's not growing. That's growing as well. But the overall pie is growing even faster.
Absolutely. Can you give us a split between advertising and subscription as things stand right now? And where would you like this ideally to be, that number, that split?
So I gave you the example of Money Control. I'm not giving you the, because subscription also means television subscription. We get a sizable number from the television subscription revenue as well. That continues to be, subscribers are falling off, all cable and DTH operators. They're reporting lesser numbers. But for us, our revenues are very stable over the last few years because we are a large group. We have large number of television channels. So it's a big bouquet. So that continues to give us the benefit. I don't want to say anything on the numbers at the moment and what is my prediction over the next few years. But I was giving you the Money Control example to tell you where things are moving and how we as a group are prepared to exploit this.
Is there a broader, and this is a question we ask to most CEOs nowadays, Rahul, with these very fast developments in AI and AI being used to increase productivity at pretty much everything that one does in the workplace, how is that, does that kind of sort of go into how you think about workforce requirements? I mean, in the news business, people are the biggest expense in that sense. How do you think about this?
our biggest expenses are, talent cost, people, distribution, because we have to, invest behind distribution and reach, and also tech. These are the three large cost pillars for us. Now, if you look at our existing businesses, they are mature businesses. Costs are not really going up there. In fact, we are being able to achieve cost efficiencies there. AI is helping in a big way. We have recently nominated an editor who's our AI head. One of the few companies in India to do that. We have a CTO who only focuses on AI initiatives. So we are adopting AI as a very critical, element in our work process and making it more and more efficient. So going forward, we will not hire talent in areas where we can use AI to get better efficiencies. We will hire talent, which will add impact to our business. So that is the way to look at the entire business. I think AI is helping in a big way. Across the group, a lot of AI initiatives, not only to look at efficiencies, but also to look at driving traffic, engagement, and many other ideas. So that's how we look at AI.
And a standard disclaimer on your screens, Network 18, a company that operates CNBC-TV18, is controlled by the Independent Media Trust, of which Reliance Industries is the sole beneficiary. We take a short break here on trading hour. The index has recovered from the lows of the day. Now just 25 points lower is where the Nifty stands. So an interesting move from the lows. Take a short break, back on the other side.
Welcome back. A definite recovery in the markets, and that's led by some banking names. So the banking index also has recovered. It's up around 30 points as we speak, but it continues to be about IT, right? We do have Tech Mahindra that is reporting numbers, and L&T Tech Services as well. Rima, let me start with Tech Mahindra first. What are we expecting?
Well, expect the second consecutive quarter of a revenue drop. So on the top line, dollar revenue is likely to go up by 1%, but constant currency, that's expected to drop by nearly 0.7%. And as I said, this would be the second consecutive quarter of revenue weakness. Where Tech Mahindra has been improving has been on margins. Margins have been steadily going up now for the last 6-7 straight quarters. In fact, margins may have bottomed out in Q2 of FY24. That's about 7 quarters back, and margins were at 4.7%. And since then, they've been steadily inching up. 10.9% is our poll for Q1, but the company's aspiration is to hit 15% margins by the end of FY27. So we still have some time to go. So how does the company get to those margins? And they'd also said, as a part of Mohit Joshi, who is the CEO, as a part of his turnaround plan, he also wanted to get to industry-leading growth by the end of 3 years, which comes to an end in FY27. So, the path to that, this turnaround progress, will be tracked very closely by the street.
Interesting. And what about LTTS, Rima? That too reporting results right now?
Indeed. So for LTTS, it's expected to be a muted quarter. Revenues for the company are seen down 2% on a quarter-on-quarter basis. Constant currency revenue growth is likely to fall even more, down close to about 3%. This is an account of weakness in one of the businesses, Smart World SWC. Even high-tech has been a bit subdued. Automotive has been under pressure. So the outlook for mobility has been weak too. Margins are likely to remain flattish, so 13.4% versus 13.2%. Now here the big question is, last time the company did acknowledge that Q4 didn't pan out as we were expecting. We thought we would grow, we didn't. But we still hold on to a double-digit revenue growth in FY26. Now, does the company maintain that? Because Q1 is going to be soft. So that is going to be the crucial part for L&T Tech. That does the company hold on to its double-digit revenue aspiration? Back to you.
All right. Thank you so much for telling us what to expect from these IT names today. For the markets, there is a further recovery now. The Nifty is down just 9 points. We do have the Bank Nifty, which has surged to levels of 84 points. The likes of Asian Paints, there's Tech Mahindra. Some of these consumer names actually are also batting for the bulls as we speak. So Asian Paints at the day's high, Tech Mahindra doing well. Tata Consumer is the other one which has recovered. Nestle, Wipro, Kotak Mahindra Bank, ITC. So a couple of these names lending support to the Nifty as well from the lows of the day. That's, yes, Kotak Mahindra Bank recovered from the lows. So we'll keep tracking all the market moves for you. For now, we'll take your leave on this edition of Trading Hour. Stay tuned. Halftime report is up next.
Stocks trade ranged, awaiting a clear signal on the India-US mini trade deal. FMCG and IT eke out gains, while autos and metals drag.
State Bank of India is expected to launch its 25,000 crore QIP today. The offer, CNBC-TV18 learns, is likely to be at a small discount to current market prices and could see strong subscription from insurers led by LIC.
HDFC Bank's board will consider issuing bonus shares and declaration of a special dividend on July 19. This move follows the bank raising 10,000 crore from its divestment of part stake in HDB Financials.
A draft notification of the government of Karnataka looks at cap price at the theatres and multiplexes at rupees 200 per ticket. The move, if implemented, can significantly dent revenues of PVR Inox and impact the profitability. Hello, good afternoon and welcome to Halftime Report, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala, with me is Mangalam Malu as well as Ekta Batra as well. Good afternoon to you as well. And seems like just a few minutes ago, we've seen a bit of a spike coming in the market, though it's not anything exciting so far as well. But the mid and small cap, that manages to do well. Mid cap is trading with slight bit of a gain. At least that green is there. Mangalam, the mid cap is wanting to twin with you today.
Yeah, because it's right above my head as well right now. I'm looking at the mid-cap index as well as the Nifty. The important part, however, is that it's a very good trading session from a bull standpoint, given the start that we were expecting. Yeah. Overnight, there was weakness on the Wall Street. Yesterday, we broke away from 4 days of, losses. And now the low being protected and us actually rallying from the lows is good sign from the market's health standpoint and the bulls. More importantly, if you look at the broader markets as well, we have more number of stocks which are advancing than the number of stocks which are declining. And some of the frontline indices or frontline stocks are doing extremely well in today's trading session. Put up something like a Nestle that's moved to the high point of trade, fairly well bid on that stock. And the IT stocks, they continue their up move from yesterday as well. So they've been underperformers. Now the IT stock supporting the frontline index yesterday as well as today does well for the sentiment at large. And actually, the up move both yesterday and today has been led by the IT pack.
Yes, absolutely. So overall, you'd have to say that, yes, we're incrementally better from where we started, but still a range-bound day of trade. But what we do need to focus on is a lot of earnings in today's trading session as well as over the week. So for today, we have Tech M, L&T Tech Services, ITC Hotels, Angel One, which will be releasing numbers tomorrow. Axis Bank, LTI Mindtree, Wipro, HDFC, AMC. So a lot of these companies will be releasing their numbers. Friday, we have Reliance Industries. And then on Saturday, we have HDFC Bank and ICICI also releasing numbers. So it's definitely going to be a power-packed few days when it comes to Qs, especially from the frontline space. So that's what's taking place in terms of the markets right now. But I'm watching a couple of stocks, guys.
Yes, Biocon, that's what you're watching, Ekta. We want to understand why exactly are you looking at Biocon? What exactly is happening out there? What's the reason?
Well, yes, Biocon is in focus because the US FDA has approved a key diabetes treatment drug, which is insulin aspart, or they branded it as Christy, in the US market. So the US drug regulator has basically approved the biosimilar version of insulin aspart in the US markets for Biocon. Now, it is interchangeable as well. So that means that basically, if you have a prescription, you go to the chemist and or you go to the pharmacy in the US, they will only be able to give you what's on the prescription. But in this case, if the drug is interchangeable, then they can give you Biocon's drug, even though there is another drug's name written on the prescription. So that is basically what it means when you talk about interchangeability. In this case, I assume if it is the patented drug's name which is written on the prescription. Overall, expected to be positive because it's been a long journey. They did have a CRL on this particular drug and then they eventually got approval for it. This Malaysia plant where it's manufactured was inspected just in September of 2024. $1 billion in terms of market size. So let's see what they come down to in terms of opportunity. $100 million is possibly what they could earn, and it could probably even go up to around $300 million based on market dynamics. So overall, net positive for Biocon, up around 1.4% for the stock.
Okay, that's interesting there. And a lot of positive news has been coming around Biocon in the recent times as well, right? The facility clearances as well. So this one surely keeping the stock abuzz in today's trading session. But let's move on. And his first television interview since taking charge as the RBI governor, we had Sanjay Malhotra. And he's saying not allowing foreign banks to own a 26% stake in Indian bank defies the logic. In an exclusive conversation with Lata Venkatesh, he promised that RBI will examine cases if any requests are made. And the governor was asked about this in the context of Dubai-based Emirates NBD Bank as well, potentially picking up stake in private lender RBL Bank. Here is what he had to say.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, you know, its own banking license and owning 24% in Yes Bank. So, you know, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%. Yes. All right. And the foreign banks can actually start business in our country 100%. As even up to 100%. So that's even more than 74%.
But they don't want that. They want to get into, you know, established Indian banks.
Yeah, so, you know, Indian promoters are already allowed up to even more than, you know, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, you know, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, you know, 26% stake, economic interest, voting rights.
Yeah.
There should not be any difficulty in them having, you know, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
We have not come. So you know, we have not, you know, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, you know, we are already reviewing the policy, as you are saying. There is some kind of, I mean, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, you know, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
Right, and that was the RBI governor speaking to Lata Venkatesh, no holds barred conversation, and a lot of you know, insight coming in out there as well. Sudarshan joins in with what he makes of the RBI governor's commentary on RBL Bank. Sudarshan.
So there is an update in RBL Bank. So basically June shareholding pattern is released and there is a big uptick in the holding of mutual funds and FPIs. And in front of that, there is a reduction in the holding of foreign companies as well as retail. So for mutual funds, as of June 2025, total holding has increased to more than 29%, and in the end of March, it was just around 15.3%. Similar pattern was seen for FPIs. As of June, its stake has increased to 17.6% from 14.4%. As far as retail is concerned, the stake is reduced to 28.7% from 38.7%. And for foreign companies, because British International Investment had sold the stake, so foreign companies' stake has reduced to 3.5% from 7.4%. As far as insurance companies are concerned, they continue to hold stake around 3.3% stake. Now, if you talk about mutual fund company, which are those mutual funds which have increased the stake or have just entered in RBL Bank? So some of the big names are SBI Mutual Funds with 3.3% stake, Tata MF with 2.1% stake, HDFC MF with 1.6%, Aditya Birla MF 1.3%, ICICI Prudential MF with 1.2%, Mirai MF with 1.1%. These mutual funds have created fresh additions, basically have made fresh entry in the RBL Bank in the first quarter from April to June. Two mutual funds, that is Nippon Life, has increased stake to 4.3% from 3.1%, while Quant Mutual Fund maintains its stake around 6.6%. So now just look at the stock of RBL Bank. This month, it's up almost 10%, and in 2025, it has outperformed by wide margin all the other banks, and it's up almost 70%.
Okay, Sudarshan, thank you so much for the latest update coming in here for RBL Bank. But on that note, we're actually going to slip into a very short break. And, after the break, we'll bring you a conversation that we're going to be having with HDFC Live. So stay tuned in for that after this break. Welcome back to Halftime Report on CNBC-TV18. And like we promised, we do have the management of HDFC Live joining in with us to talk to us about the Q1 FY26 numbers. And we do have Vibha Padalkar, who's joining us right now on the show. when you're looking at it, HDFC Life as of now is trading with slight bit of a premium, positive sign that we're seeing coming in and an uptick that we're seeing after the numbers of the company. So, Vibha, thank you so much for joining in with us on the show. And firstly, if you could just start by talking to us about overall the numbers that are coming in for the company. What are we watching out for in terms of the APE growth, the VNB growth for FY26? What is the expectation there?
Right now, given the macro situation and given that consumption has been sluggish, we still think that growth will be a shade lower than overall for all sectors, including insurance, than what we have seen in the past year. For insurance, more specifically, first half for us grew by 31%. So we also have to contend with a base effect. If I were to even out the base effect, then if I were to look at first quarter growth, it has been a very respectable 21% on a 2-year CAGR basis.
The question is, Vibha, the FY25 APE growth, that was 18%. Will FY26 be lower than that? And if yes, how much lower?
Yeah, so we grew 18%. Of course, it was a story of two halves last year, wherein first half for us was around 31% and lower in the second half, averaging out to 18%. But if I were to look at on an overall basis at an 18% growth, which is nothing but the story that time and again over several cohorts of 4 years, and this is there in our investor presentation, on several cohorts, we have doubled every 4 to 4.5 years, which is we're saying, growth in the region of 16 to 18% is something that is the rightful place.
Okay, that's interesting, Vibha. But, when you're looking at it right now, ULIP share has remained quite flat in this quarter. Do you expect it to pick up in Q2 or second half of FY26? And do you think FY26 could be the year of product mix dominated by ULIPs and or maybe we could see a bit of a flat margin on that front as well, or a compressed margin?
So as far as ULIPs is concerned, we have been range bound. So it is not that ULIP growth isn't there or demand is not there, and hence we ended at 38% as ULIP share. That is not the case at all. In fact, we would rein ULIPs to a handle of about 30 to 35% in terms of the outer limit. So at 38%, we are already on the upper end of the outer limit in terms of balanced product mix, which is core to the way HDFC Life does business. That's point number one. Point number two is that even in quarter one, we have deliberately reduced our dependence on ULIP. If you look at quarter four, ULIPs were about 43% on a standalone quarter basis versus 38% that we have managed to rein it in. Third point is that we are looking at how to make unit linked more profitable. As you know, it is for an insurer, life insurer, it is one of the least profitable products, especially at market economics. And they were looking at many ways in which we can improve the profitability to move to double-digit kind of margins on unit linked. And happy to share that we are very well on our way to increasing margins on unit linked.
All right, so higher par book, lower non-par book, and higher ULIPs. What does that do to your margins? Because, the street believes that this could be margin dilutive. Where do margins come in for FY26?
So I want to, before I get to the full year margins, let us just deconstruct quarter one margins, because optically it looks like quarter one margins have been fairly range bound. Quarter one last year was 25%. Quarter one this year was 25.1%. But if you look a little bit deeper, and the waterfall is there in our investor presentation, you will see that the starting point itself of 25% last year would have been lower by 0.3% or 30 basis points due to surrender charges. And this came in effective from 1st of October last year. So against 24.7%, we have delivered a margin of 25.1%. So it is an increase already of 40 basis points. To your question on where are we likely to end, what we are looking at is fairly range-bound margins, optically range-bound. The way I'm saying 25 has gone up to 25%, 25.1%. So optically range-bound, but underlying, actually, there will be an increase in margin to make up for the full year impact of surrender charges. Whatever margin uplift we could get, especially in the second half of the year, if what we talked about in terms of the consumption story getting better, then we will want to invest it back into the business in two directions. One is in growing our own proprietary channel. So this is our agency channel as well as direct to customer channels, both in person and online, as well as we are well on our way to delivering benefits from investment in Project Inspire, which is our flagship technology transformation project. So these are the two aspects that we will continue to invest in while holding margins.
Okay, while holding margins, but overall then, for FY26, could margins be slightly lower than FY25? What are we watching out for?
Look, rather than being tethered to a margin, the focus in terms of priority, number one is to grow faster than industry, and that's something that we have time and again demonstrated over the past several years. Second is in terms of VNB growth, and we're saying that VNB growth will be in line with APE growth. And that is important, and that will be a function of both top line as well as margin, while keeping margin range bound. Now, whether it is a little bit lower or higher, I think we will look at how macroeconomics are panning out, what are customer preferences. But you will see that other than due to either a COVID or regulatory recalibration of business models, our margins have continued to hold or trend upwards.
What's the one immediate thing you would want the new IRDAI chairman to focus on, and the one thing you would want him to do differently from the previous one? Because there's a lot of chatter around this one. The industry wants something.
I think last few years have seen a lot of support that the sector has had, whether it's expenses of management, whether it is looking at sub-debt related rules, so freeing up our ability to raise capital, whether it's looking at some of the weights on solvency, many things that I can rattle off. I think it has been a very good innings, very supportive, and trying to think big. I think now with the new regime, it is imperative, and proof of the pudding is growth back. I think that is extremely important. So the number one thing would be to facilitate how growth can come back, while of course looking at many other aspects like risk-based solvency, IFRS. These are all forward-looking aspects for the sector.
All right, we take that point. Thank you so much, Vibha, for joining in, giving us your view on the year ahead. You expect, some growth to be lower than last year, but fairly range-bound when it comes to margins as well, even though slightly lower. We'll watch out for, how growth comes by for this year, how margins are. But as we take that short break, just pull up the intraday chart of SBI. It's a big up move that we're seeing on that counter. And alongside SBI, we have Asian Paints as well. A good, move is what we've seen on the stock from the lows. It has seen a fair amount of recovery. In fact, the stock had made a low of closer to 2,200, around that amount where, the JSW AkzoNobel paint deal was announced. And from there on, the Asian Paint stock has moved higher. There have been a couple of brokerage upgrades as well. Asian Paints and SBI stocks of the last 20 minutes. Take a short break. On the other side, Pritesh Mehta of Yes Securities joins in with trading ideas.
for investment.
Welcome back. Absolutely flat for the frontline indices, mildly lower for the frontline Nifty and Sensex, but that's largely, off lows led by some of the stocks that we earlier mentioned. SBI, one of them, Infosys. Reliance too reports its numbers towards the end of this week, has recovered a fair bit from the lows. The broader market is doing a lot better, the Nifty Bank as well. So let's pull up all the major indices for today, take a look at how FNO is playing out in today's session so far. We have the Nifty Bank, which was outperforming on Friday and Monday along with Tuesday, currently holding with gains of almost 0.25%, even as the frontline indices are flat. We have the broader markets where more number of stocks are advancing than the number of stocks that are declining, even though the lines are close to each other. The green line is above the red line. What does all of this mean for expiry tomorrow? The street believes that maybe there could be some sort of range that would be playing out. What is this range? Ahead of expiry, you have the straddle, which is a call and a put together, seeing extremely active bids in trade. So you have 25,150 call, premium of 80 rupees. 25,150 put comes up for you. That has a premium of roughly 40 rupees. So 80 plus 40, 120 rupees is the premium that you pocket if you sell that 25,150 straddle. Then you are playing for a broader range. On the way up is close to around 25,270. On the lower level, you are expecting some support coming by just around that 25,000 mark. If you want to broaden that range, then a 25,200 call, which has a premium of 55 rupees, and a 25,100 put, which has a premium of 28 rupees. Again, playing for that range between 25,050 to 25,250 itself. The 20-day moving average on the Nifty, that's the most crucial number to track on the way up if there is a recovery. Closing above that would, signal further short covering from these call writers. The other thing we are looking at are a bunch of individual stocks. So you have, stocks like Patanjali Foods and Biocon, both of them seeing high moves or up moves and fresh long build-up. Ekta told us why Biocon. And for Patanjali Foods, remember the board meets tomorrow to consider a bonus issue as well. And Angel One, that's fairly excited in today's trading session with a lot of open interest jump. The stock may enter FNO ban, so keeping an eye out on that one.
Okay, all right, Mangnam. Thanks very much for that. So that's on the entire FNO space. We have Pritesh Mehta joining in from Yes Securities to tell us what he's tracking on the technicals today. Pritesh, hi, welcome to the show. Well, it is turning out to be a day where we are fairly, you would say, resilient as compared to at least what the US markets did overnight. What's your approach today?
Yeah, good afternoon. Now, see, the weakness that we saw from last week's trade, rather, I would say, cool off that we saw from the top, it has reached an exhaustion point. Even when we look at our customized breadth, it has stabilized at lower levels. So I think breadth is yet to confirm bullish crossover. So till the time the breadth is not participate on the upside, I think market is going to consume time at lower levels. We are not likely to see any meaningful rally from here on. But if we keep the index aside and look at the broader markets, they are outperforming. Nifty is far away from July peak. But that's not the case with mid-cap index. That's not the case with small-cap index. They're outperforming. So I think keep the index aside, focus on the broader markets. This is the place where we're going to make money.
Okay. And what are your top bets that you're looking at right now?
So there are a couple of ideas on the buy side. The first one is buy on Manappuram Finance. Now this stock went through a corrective phase from second week of June. Then it found support around 10 column average, and from that it has seen a reversal. It is trying to break, provide a bullish ABC break. So buy for a target of around 330. The support will be of around 250. The second one is buy on Canada Bank. Now see, this particular stock is outperforming the PSU Bank basket, PSU Bank index. It is trying to surpass the peak of April 2024 on the relative strength chart. So when I look at the standalone chart, it is providing a bullish follow through to the anchor column. So buy for a target of 145. The stop loss would be around 105.
Okay, Pritesh, thank you so much for joining with us on the show, giving us an idea in terms of what to watch out for in terms of markets as well as stocks that you're watching out for as well. We have DB Corp that's reported its numbers as well. Revenues down 5%. We're seeing ad revenues are down by 7% as well, and margins seeing a sharp contraction this time. So yes, after that, we've seen the stock see a sharp slip coming in, post the numbers down almost 3.5% in the trading session right now. But let's get you an exclusive, and this is what we're picking up from our sources who are telling CNBC-TV18 that further consolidation of PSU banks may be on the cards. Sapna is joining in with us to give us details on this front. Sapna?
Yeah, hi. So absolutely right. This is what we are picking up as of now. And this basically aligns, with the government's thinking of having large banks. I think that's the stated aim. So, merging the smaller banks together is something that the government may possibly explore down the line. Nothing isn't firmed up as such, but this could be part of broad thinking. Similarly, there are voices that given the push for credit growth and the fact that we need to achieve a certain, we need to achieve certain financial sector goals, at least by 2047, if not earlier. Then probably, an increase in the FDI cap or rather the foreign investment cap of the banks, which has been at 20% for a very, very long time. I think that also needs a review and a relook. So possibly there could be some action on that front as well in the coming months. Last but not the least, similarly, in terms of consolidation in the banking sector, similarly, in the PSU space, as far as the insurance companies are concerned, there too, some talks are on. I mean, these are discussions which have happened earlier also. So they may be coming back on the drawing table in terms of forming up a consolidation plan for your public sector insurance companies as well. A broader thinking also could be in terms of allowing some kind of corporate entry into the banking sector, but that's extremely tentative as of now. So what looks possible is further consolidation in the PSE space and possibly increasing the foreign investment cap beyond 20%.
Okay, all right, Sapna. Thanks very much for bringing us all of those details. So possibly PSU bank consolidation ahead. We need to take a short break on that note, but we'll get you a lot more on the market, specific stocks once we're back. Stay tuned.
fully.
Welcome back. Well, picking up a little bit of pace for the Bank Nifty, so up around 0.3% currently for the Bank Nifty. Do watch out for a couple of stocks. Nestle India is your top gainer, however, on the Nifty at this point, up around 2%. Wipro ahead of its numbers this week is up around 1.6%. And SBI is doing well as well. So State Bank of India is gaining on the news of a possible QIP. So that stock is up around 1.5%. But let's shift focus to the metals making headlines on account of tariffs and increased safe haven buying. As investors continue flocking towards silver, what remains to be seen is whether the yellow metal prices are poised for consolidation, and if not, then how soon can the yellow metal scale those levels of around 4,000? Hear out Francisco Blanch of BofA Global Research as he gives us a rationale on the metal pricing and triggers going forward.
We have been pretty bullish on gold for some time now, and earlier this year, as tensions rose and we saw gold breaking, just getting very close to $3,500 an ounce, we started advising people that it was time to diversify away from gold and look at other metals. The metals that we preferred in the precious space are silver and, of course, platinum. We don't like palladium as much. I mean, of course, it will rise in sympathy with the other metals, but we think platinum will outperform palladium throughout the next few months. And there's a number of reasons for that. But our favorite metals in the precious space right now, particularly going to the second half of the year, remain silver and platinum. And there is an industrial element to this, but also remember there's a big jewelry element too. When this thing started, when platinum started rising, platinum was trading at a third of the price of gold. And gold jewelry is down 20% year on year around the world. So even a small rotation away from gold jewelry, 1% gold jewelry rotation into platinum doubles the platinum deficit because platinum is such a small market compared to gold, same as silver. So that small trickling out effect is starting to bid up other precious. So we remain constructive. We think silver will go to $40 per ounce, and we had a 1,400 target for platinum, but it keeps rising. So maybe we'll just keeps going higher.
I clearly get the sense that you're quite bullish on platinum and the other couple of precious metals. But what about gold? Has it run its course?
Well, so gold is a little more challenging, right? Because remember, one thing about gold is that it needs investor support. I told you jewelry demand is down a lot. And we need to see more investor money coming in. And the investor money can come either from the private sector or from the public sector. Public sector money is, of course, central banks. Central banks have been the ones driving the rally. If you go back to 2017, 2018, we didn't see central banks buying 1,000, 1,100, 1,200 tons of gold every year. We saw them buying 300, 400, 500 tons every year. So we've seen more than doubling, tripling in some cases, central bank gold purchases. And that continues. But in order for gold prices to rally beyond 3,500 and into 4,000, you need a lot more investor buying. And what drives investors into gold? Basically, it's uncertainty, right? Remember, one thing about gold that's very important to realize is that it's already a very big market. I mean, this is not some obscure cryptocurrency or anything like that. And this is a market that's over $20 trillion, right? The U.S. Treasury market is $28 trillion in the hands of the public, and just about $20 trillion in the hands of the U.S. public, with the remaining being in the hands of foreigners. So gold and U.S. Treasuries are really getting very close in size. And in fact, if you look at central bank reserves, gold has overtaken the euro already as a central bank asset. So we remain bullish. We have a $4,000 target over the next 12 months on gold, but we think you need to see continued shocks. And as you probably have seen with this news on tariffs, renewed, you mentioned it earlier in your show, this is what's driving the uncertainty and pushing investors to accumulate more yellow metal, in our view.
Francisco, also coming on copper then, and it has been a very, very volatile year for this one metal. All-time highs in the U.S. markets, not so much on LME and Shanghai, but the kind of disparity in prices that we're looking at, even premiums that the U.S. seems to be commanding right now, that 1st of August is not too far away. What are you reading into on what really could conspire, one? And second, what is your sense now on the prices, especially when the three exchanges really seem to be doing very, very differently in that?
Yeah, this copper has been a fascinating story. I mean, last week we saw massive movements in the copper price. We were bullish U.S. copper and advising people to be long U.S. copper because obviously that's where the pressure point was going to come. But I don't think anyone expected 50%. I mean, that was very, very high. The market ripped on the news, and as the 50% tariff became confirmed, copper kept on rallying. So U.S. copper. Of course, LME copper not so much, and so on, and Shanghai not so much. But the U.S., right, for quite a long time, we've seen copper flowing into America. We've also seen gold flowing into America, by the way. I mean, it's been a common pattern because we've seen 50% tariffs applied on aluminum and on steel. So people have been rushing to bring stuff into the U.S. Commodities have been effectively at the center of some of that front loading that I was discussing earlier. And I think with the case with copper, to me is kind of fascinating because the real issue in the copper market is that there is a shortage of copper ores. And the differential between the copper ore price and the price of refined copper, once you've processed the ore and turned it into that refined copper, is very very minimal, right? I mean, there is almost no value in refining that copper. So the tariffs are effectively going to encourage potentially more refining of copper in the U.S. But I don't see refineries being built on these tariffs.
So Francisco, what's your sense then on prices going forward? And do you see this disparity continue in case of copper?
Well, the disparity continues because the tariff is there. But I think in terms of demand, right, we told people like in the short run, prices will spike. But if you look out into the next few months, there's going to be demand destruction because suddenly if you're an industrial in the U.S., you got to pay 50% more for that copper, right? And you're becoming less competitive. That's the challenge with tariffs. If you're a producer of sophisticated aluminum cast parts, for instance, your input cost went up 50%. So you're less competitive in the global market.
Oh, absolutely.
It's the same thing. So I think ultimately we'll see demand destruction and eventually that will feed into somewhat lower prices, particularly in the LME and in China depends a little more on what the dynamics of the Chinese economy are. But I think the LME price will struggle to keep going higher. The U.S. price, of course, will remain high.
All right, so that's about the commodities action, but let's tell you something that we're very thrilled to share. The next chapter in CNBC-TV18's journey, the launch of CNBC-TV18 Prime, which is our premium subscription-based platform designed to deliver world-class insights and in-depth global coverage to India's decision makers. To mark this milestone, we're hosting a special evening of dialogue and connection with a curated gathering of leaders and change makers. With the likes of Bain & Company's Manny Makeda, Delphi Capital Management's Robert, and market veteran Ramdev Agarwal, HDFC Life's Dheeraj Relly, former Foreign Minister of Singapore George Yeo, and former Foreign Secretary Shyam Saran, along with Brookfield's Ankur Gupta, will be a part of this landmark celebration. Join us on CNBC TV18, 5 p.m. onwards. All right, when we started the show, two of the indices were mildly in the red, two of them mildly in the green. Now, the ones that are in the green have increased their greenness, and the ones which were in the red have moved into the green. So 23 points higher for the Nifty, led higher by the banking stocks, led higher by the IT stocks, and also Tata Consumer. A couple of these consumer names doing well. So we had Nestle, which was doing well all through the day, along with Asian Paints. Now Tata Consumer too has moved to the high point of trade. But the broader markets, no problems, continue to do well, and Dixon Tech is one of them, trading in the green. A trifecta of positive news coming in for Dixon Tech.
Absolutely. So, what we're watching out for in terms of the news flows. Firstly, let's talk about the main news flow that came in overnight. Acquisition of Q-Tech. Now, what is Q-Tech? Q-Tech is a camera module supplier. Globally, it's among the top 5. In India, it's the largest. So this acquisition, 51% stake is what Dixon will be acquiring in Q-Tech. And obviously, this will give value addition to its backward integration that the company has been following, right? So in terms of backward integration for its smartphone business, now this is the camera module side, which is also they are acquiring this part of the business. Other than that, there's a JV that they have signed. This is with Chongqing Yuhai, which is a precision component manufacturer. Now, this is a JV, so where Dixon will have 74% and the company will have 26%. That is, Chongqing will have 26%. This company is into mainly precision components, which are used in mobile phones, whether you look at it and also in terms of laptops, automotive devices as well, and applications. So, yes, a lot of segments of Dixon get covered here. So, these are positives that are coming in here. And do not forget that, Dixon has been focusing a lot more in terms of backward integration. The last one also came in from HKC as well, which was a JV that they had for backward integration of display modules. So smartphone backward integration is a thumbs up that is given by analysts. And today also, when they look at the brokerage notes that came in this morning, CLSA, they maintain the outperformance rating here. Target price of 19,000 rupees. They're saying that this acquisition will add value to Dixon's smartphone side of the business, where value addition was 15 to 17%. It could move up to 45 to 55%. Improvement in terms of margins by 150 to 200 basis point. Revenue stream also seeing an improvement there. And overall, additional revenue will come in from this front. Even JP Morgan highlighting similarly that, this could lead to an earnings upgrade for the company, given the backward integration has been so strong. They're assuming that, this acquisition and JV and everything would be completed in Q2 FY26, and that would start yielding benefits for the company in the second half of the year. So FY26, 2% additional revenue is what one could watch out for here, as well as for FY27, revenues also could further see an increase of around 3% as well. So interesting to watch out for here, especially in terms of margins, additional revenue that we're watching out for as of now as well.
Okay, all right, Vinny, that's on Dixon Technologies. But TechM is in focus. It will be reporting its Q1 FY26 earnings today. Reema's here with details on what we can expect from TechM.
Well, expect the second consecutive quarter of a revenue drop. So on the top line, dollar revenue is likely to go up by 1%, but constant currency, that's expected to drop by nearly 0.7%. And as I said, this will be the second consecutive quarter of revenue weakness. Where Tech Mahindra has been improving has been on margins. Margins have been steadily going up now for the last 6-7 straight quarters. In fact, margins may have bottomed out in Q2 of FY24. That's about 7 quarters back, and margins were at 4.7%. And since then, they've been steadily inching up. 10.9% is our poll for Q1, but the company's aspiration is to hit 15% margins by the end of FY27. So we still have some time to go. So how does the company get to those margins? And they'd also said, as a part of Mohit Joshi, who is the CEO, as a part of his turnaround plan, he also wanted to get to industry-leading growth by the end of 3 years, which comes to an end in FY27. So, the path to that, this turnaround progress, will be tracked very closely by the street.
Right, Reema. Stay on, but L&T Tech Services also reporting its numbers. What's the street expecting here?
For LTTS, it's expected to be a muted quarter. Revenues for the company are seen down 2% on a quarter-on-quarter basis. Constant currency revenue growth is likely to fall even more, down close to about 3%. This is an account of weakness in one of the businesses, Smart World SWC. Even high-tech has been a bit subdued. Automotive has been under pressure. So the outlook for mobility has been weak too. Margins are likely to remain flattish, so 13.4% versus 13.2%. Now, here the big question is, last time time, the company did acknowledge that, Q4 didn't pan out as we were expecting. We thought we would grow, we didn't. But we still hold on to a double-digit revenue growth in FY26. Now, does the company maintain that? Because Q1 is going to be soft. So that is going to be the crucial part for L&T Tech. That does the company hold on to its double-digit revenue aspiration? Back to you.
Absolutely will be important to watch out for whether they hold on to that aspiration of double-digit revenue. Thank you so much for that, Rima. But on that note, we're going to slip into a very short break. But remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m.
Welcome back. Well, a little better for the advance decline ratio this afternoon. So around 2,200 stocks advancing to around 1,700 stocks declining. From the broader markets, just watch out for a couple of stocks. So Unichem Lab seems to be showing a lot of traction today. It's up around 8.5%. Good going for that particular counter. And Metropolis has had quite a choppy week, year you'd have to say. But Metropolis is now showing a good up move of around 6.5 to 7%. But that's what's taking place in terms of a couple of specific stocks. Consumer, IT and financials are the three big pockets to watch out for, says Samir Arora, who's the founder and fund manager at Helios Capital. He also adds that India has a strong case with favourable readings on inflation, interest rates and more. Listen in to what he had to say.
First big goof up is that not to invest in any new technology, helping others. You have to guide the world a little bit every day to only focus on what is, to delay. I have delayed my hikes because this quarter margin will be lower, higher. I mean, this is overdoing. If you have to give it now, how does it matter that this quarter my margin will look 10 basis point lower, but next quarter I will save something on travel, so I will give a hike. I mean, this is just over catering to the market, which otherwise I like, but they are disappointing on many levels, philosophically and on a day-to-day basis. India has a strong case. India has a case in terms of inflation and interest rates and liquidity. And so even if we just don't get outflows, and plus the currency, dollar is depreciated, so that's another reason why people don't like that much US. So if that happens, then just by not having outflows will be a big positive compared to what we have seen in recent 6-8 months. Overall, market growth is about 13-14%, which is sort of normal. Right now, it's below normal. In financials, we expect that the growth rates will go back. That is in the banks and all. In terms of the portfolio, we are still in the same old, which is financials and discretionary consumer a little bit. And then a few here and there you can see in different places, but no, because there are three big pockets: consumer, IT, financial. And if you don't have IT, that leaves a big gap. And therefore, you have to cover some other angles to spend that money or invest that money.
Stocks trade in a range but recover from the lows of the day, awaiting a clear signal on the India-US mini trade deal. FMCG and IT eke out some gains, while autos and metals are the big drags.
State Bank of India is expected to launch its 25,000 crore rupee QIP today. The offer, CNBC-TV18 learns, is likely to be at a small discount to the current market prices and could see strong subscription from insurers led by LIC.
HDFC Bank's board will consider issuing bonus shares and declaring a special dividend on Saturday. The move follows the bank raising 10,000 crore rupees after divesting some of its stake in the HDB Financial IPO.
A draft notification of the Karnataka government looks to cap prices at theatres and multiplexes at Rs 200 per ticket. The move, if implemented, can significantly dent revenues for PVR Inox and impact profitability.
Good afternoon. You're with us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormis Patakia. With me, as always, is Vamakshi Dhuria. Vamakshi, good afternoon. Well, the morning didn't look pretty pleasant, but there has been a recovery from the lows of the day, and you have PSU banks to thank for that.
Well, absolutely, Hormaz. Today is turning out to be a very interesting day because we are finally seeing some green on the screen. Even though if it's not a lot, it's at least like a 100-point recovery from the day's lowest point for the Nifty. The mid-cap end of the market is also looking quiet today in today's trading session. It's up only 0.05%. The small cap end of the market also not doing too much in today's trading session. So therefore, the indices look very quiet today, but stock specific action continues to be very loud. Look at the moves that have come in on the back of some results. Network 18, Hathway Cable, HDB Financial, these three stocks are in focus today. Network 18, of course, is gaining higher, up almost 14% or so. Hathway Cable is the next one on our radar. That stock is also flying high in trade today. On the other hand, what's also doing well is the PSU bank, like Hormaz was mentioning. There have been some sources which have been indicating that the government may consider further bank consolidation. So that is something that we'll be clearly watching out for.
Interesting indeed. The top sectoral gainer, the PSU Bank Index, at the highest point of the day, still building on to those gains, almost 1.75% higher now is the index. But of course, there are plenty of other movers in the broader markets today. Metropolis is one of them. It's still 7% higher on that stock, and at one point was up almost 8.5%. And of course, some of the reports suggesting that there has been a spike in the cases of dengue and malaria in Mumbai, and that could possibly have a bearing on Metropolis as the stock has surged in today's session. Thermax is the other one, 5.5% higher in today's session. Cera Sanitary Ware is the other one. And just pull up Angel One as well, reporting results today. Remember, it's already come out with its business update. So some of the other operating metrics will be keenly watched out for. Well, slightly off the highs of the day. Still 1.5% higher is Angel One. But putting the spotlight on some other stocks that are in the news, Ria is joining in with more details. Ria, what's on your list today?
Well, yes, Hormuz, first up, we're looking at Biocon. Biocon Biologics has expanded its diabetes portfolio with the US FDA approval for a drug called Kirsty. And this is the first and only interchangeable rapid-acting insulin aspart in the United States. So the stock has been trading higher on the back of this. The next one is Dixon Technologies, up around 2% after acquiring a 51% stake in QTech India via a combination of primary and secondary investments. And further on Dixon Technologies, they've also partnered with a Chinese firm to form a JV in India for the manufacturing of precision tech components. The next one that we're keeping on our radar is Network 18, of course, up over 14% after reporting their Q1 FY26 numbers. The EBITDA has jumped up by around 72% on a year-on-year basis, and the company has also posted a net profit of around rupees 516 crores this time around versus a net loss of 74.6 crores in Q1 of FY25. But remember, there was an exceptional item of around 587 crores in this quarter. The next stock is HDFC Bank. The board is set to consider a bonus issue and a special interim dividend along with their Q4 results on the 19th of July. So the stock has been trading higher on the back of this positive news flow. PVR Inox has also been in focus, down about 1% after the Karnataka government has proposed in a draft notification that movie ticket prices should be capped at rupees 200. And remember, around 10 to 12% of the box office collections for PVR are driven by the state of Karnataka. The last stock that we're keeping on our radar is Premier Explosives, up about 2.5 to 3% after the company has received an export order worth about rupees 105 crores for the manufacturing and supply of defense explosives, and this order is to be executed within a period of 12 months.
Well, thanks so much for that, Ria. Comprehensive list as always. We'll be watching out for all of these counters. But let's focus in on SBI. Sources tell CNBC-TV18 that it is likely to launch its 25,000 crore QIP as early as today. My colleague Vivek joins in with all of the details. Vivek?
Well, that's right. The mega QIP coming in from SBI, almost 25,000 crore is what the bank is looking to mop up. This fundraising, has been on the anvil for quite some time. In fact, our colleague Ritu had highlighted this, that it could happen quite soon within the month of July itself. So today what we are learning from our sources is that the QIP could be launched as early as later today. In fact, today evening is when we understand that the QIP would be launched. 25,000 crore is what SBI is looking to mop up. We understand that there will be a very slight discount to the current market price that SBI is willing to offer to the interested buyers. We understand that LIC will be one of the key anchor investors. We understand that LIC has already put its interest in placing bids over 5,000 crore rupees in this particular QIP. We also understand that interest from domestic mutual funds is quite high. Remember, we've reached out to both SBI as well as LIC to get a comment on this particular development. We are yet to hear back from them. Just to remind our viewers, remember our colleague Ritu earlier had pointed out that SBI had gone ahead and appointed 5 bankers for this particular transaction. And the main purpose of going ahead with this particular fundraise is to augment the capital of the company. So it'll be interesting to see how SBI and what will be the kind of response that this particular QIP garners.
Oh yes, the mother of all QIPs, if you could call it that, Vivek. Thank you for that information. But stay on because you have another exclusive, and that is another QIP, and that is from Veranda Learning. Tell us more on that.
Well, that's right. Veranda Learning company, as far as the education space is concerned, that we understand that that particular company too is looking to raise funds. We understand that one of the main reasons that the company is looking to go ahead for a fundraise is to go ahead and replace some of the high-cost debt that it has. We understand from our sources that the company is looking to raise close to 380 crore, of which 340 crore will be used to go ahead and replace high-cost debt. We understand that HNIs as well as family offices are the ones that are being reached out to for this particular fundraise. We understand that equity dilution in this particular case, given the market cap of the company, would be quite high, and we also understand that there could be quite a steep discount to the current market price that the company was willing to offer to go ahead and complete this particular fundraise. We reached out to Veranda, we yet to hear back from them for this particular development.
Well, thanks so much for that, Vivek. So 2 QIPs to watch out for, one from SBI, one from Veranda Learning. But as we slip into a short break, here's a quick note for our viewers. We are thrilled to share the next chapter in CNBC-TV18's journey, the launch of CNBC-TV18 Prime, a premium subscription-based platform designed to deliver world-class insights and in-depth global coverage to India's decision makers. To mark this milestone, we are hosting a special evening of dialogue and connection with a curated gathering of leaders and change makers, where the likes of Bain & Company's Manny Makeda, Delphi Capital Management's Robert Rosenkrantz, market veteran Ramdev Agarwal, HDFC Life's Dheeraj Reddy, former Foreign Minister of Singapore George Yeo, former Foreign Secretary Shyam Saran, and Brookfield's Ankur Gupta will be a part of this landmark celebration. Join us 5 p.m. onwards.
Welcome back. You're watching Business Lunch on CNBC-TV18. The US inflation data for the month of June showed an increase from May levels despite the headline numbers matching expectations. The consumer price index increases 0.3% on the month, putting the 12-month inflation rate at 2.7%. Excluding food and energy prices, core inflation picks up 0.2% on the month, with the annual rate moving to 2.9% in line with estimates. On that note, let's also listen in to some reactions coming in from market experts and economists on the inflation print for the month of June.
If you look at particular categories like toys, furniture, etc., you are seeing a little bit higher inflation than we'd seen in the past. But if you look overall, it's hard to see a big impact yet. And that's the big debate. Is it coming or is it not coming? It's been, this is likely to be a one-off. If you look at, all imports are about 13% of GDP. The tariffs are, they're on, they're off, there are exceptions. And so it's hard to see that it's going to have this enormous impact. And in particular, it's hard to see an ongoing impact. Fortunately, the short-term inflation expectations came down from the elevated levels that they were earlier. And that's really where you have to worry. Does this get into something that is longer term, more into all the cracks in the system? And at least so far, we're not seeing that.
We saw some signs of tariffs in there. I mean, things like, toys and apparel and furnishing, they all moved up more. Those are kind of the things you would associate with being imported from China. What offset that were some other service things and used car prices that had a seasonal adjustment down. So within that number, you saw the beginnings of some moving up in tariffs. But you're right. It wasn't that the overall number got pushed, but that might be coming in the months ahead. You could see sticky inflation. Be clear, we're not talking about, huge inflation here, but in a world of 3%, that's enough to get the Fed not to move rates. That's enough to keep the funds rate at 4%.
Now, U.S. President Donald Trump's criticism of the Fed chair, Jerome Powell, continues. He said that the Treasury Secretary, Scott Bessent, is an option for the next Fed chair. Listen in to what he said.
Scott Bessent, your Treasury Secretary, your number one option whenever Jerome Powell leaves, or...
Well, he's an option.
Is he your top?
And he's very good. Well, he's not, because I like the job he's doing. Right. That's why he's not been developer. I like the job. I don't know if he was on the plan. Was he not the plan? Maybe he wasn't. But I do like the job he's done. Right. So in that sense, probably he's not that much of an option. Right. Scott's been great. He's been terrific.
Meanwhile, India's CPI came in at a 6.5-year low of 2.1% and could dip to 1.8% in July. CNBC-TV18's Lata Venkatesh exclusively spoke to RBI Governor Sanjay Malhotra and asked him if benign inflation and growth concerns could spark further rate cuts from the RBI. Let's listen in to what he had to say.
One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Well, it's time to take a short break here, but just as we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that's introducing CNBC-TV18's all-new app, where you get in-depth news, breaking news, in-depth articles, and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen. Take a short break, back on the other side. Welcome back. Now, US President Donald Trump has announced a trade deal with Indonesia. Meanwhile, the US is also in talks with a few more countries for a prospective deal, according to the president. Take a look at this report.
Donald Trump says more trade deals are coming soon.
We're working on probably 5 or 6. Of the 5 or 6, I'm not sure I really want to do them. You know, you want somebody that knows how to negotiate. But we'll probably have 2 or 3. You know, we insist on opening up the country, which is a big deal. India basically is working along that same line. We're going to have access into India. And you have to understand, we had no access into any of these countries. Our people couldn't go in. And now we're getting access because of what we're doing with the tariffs.
The US president spoke to reporters on Tuesday after agreeing one deal, this time with Indonesia. That will see the country's goods hit with a 19% tariff, down on the 32% that Trump had said the country would face from August 1st. US goods will be able to enter Indonesia free from all duties.
So we made a deal with Indonesia. I spoke to their really great president, very popular, very strong, smart. And we made the deal. We have full access to Indonesia, everything. As you know, Indonesia is very strong on copper. But we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing.
Trump said Treasury Secretary Scott Bessent and Commerce Secretary Howard Lutnick were now keen to land more deals. But he said he was happy just sending out notices telling countries their rate.
But I have to tell you, for the most part, I'm very happy with the letters. You know, the letters are a deal.
Trump said letters would soon be going out to many smaller countries, which would face a rate of a little over 10%. Meanwhile, the EU is preparing to retaliate against the 30% tariff threatened for its goods. It's drawn up a list of US imports worth about $84 billion that could be targeted. That includes Boeing jets, bourbon whiskey, and cars. The list was sent to member states and seen by Reuters on Tuesday. It predates Trump's weekend move to ramp up pressure on the bloc, instead being a response to his earlier duties on cars and car parts. Like other places, the EU has until August 1st to negotiate a deal. European officials say the 30% rate would end normal trade between two of the world's biggest markets.
Well, in addition to that, Trump has also announced that tariffs on pharmaceuticals will come soon. Let's listen into that bite.
Pharmaceuticals will be tariffed probably at the end of the month. And we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build. And then we're going to make it a very high tariff because we got to move them in. Look, there's 2 ways you do it. You make money or you have them move here so they don't have to pay the tariff. Those are the 2 ways. The pharmaceutical companies are moving back to America where they should be.
Meanwhile, the Secretary General of NATO, Mark Rutte, warned that countries such as Brazil, China and India could be hit very hard by secondary sanctions if they continue to do business with Russia. Listen into that.
Listen, if you are the president of China or the prime minister of India or the president of Brazil, and you are still trading with the Russians and getting the oil and the gas in, and you sometimes even resell it for a higher price, know that if this guy in Moscow doesn't get serious about peace talks, I will slam secondary sanctions on you of 100%. So I'm sure they don't know yet what hit them. This will take some time to sink in, and I think you guys making this clear in the media, the senators maybe also discussing this with their counterparts in Brazil, India, China, will be very helpful to put maximum pressure on Russia.
Well, moving on then, back home, the government, as part of its renewable energy push, is urging coal PSUs to invest in renewable energy. Sources are telling CNBC-TV18 that NLC India is likely to be given approval to invest further into renewable energy infrastructure. My colleague Abhimanyu joins in on the phone line to tell us more. Abhimanyu?
Well, NLC India is already the first PSU of the country to generate 1 gigawatts of renewable energy, and it aims to increase its renewable energy production to 10 gigawatts by 2030. And as part of these plans itself, the Coal Ministry has proposed support from MNRE to expedite its foray into renewable energy by coal PSUs. And the cabinet approval, if and when granted to NLC India, will allow it to exceed the allowed investment threshold in a joint venture. The company is already working on solar power in the Rann of Kutch, and it wants to expand the ambit of its production. The cabinet nod, which has been sought by the Coal Ministry, wants to coordinate with other central and state agencies to increase the overall renewable energy production, and a cabinet nod will allow NLC India to further invest in renewable energy for diversification into solar and wind power, and it's also likely that other PSUs may also join in. So any approval from the cabinet in this direction is likely to help not just the Coal Ministry, not just NLC India, but all other PSUs also, which are working under the aegis of the Coal Ministry, which may get a shot in the arm as far as further investment into renewable energy is concerned.
Abhimanyu, thanks a lot for that update. NLC India currently trading with gains of around 3%. Now, cab drivers have gone on a strike in Mumbai demanding rationalization of fares along with other reforms. Rachna is joining in with more on this. Rachna, tell us, what are their demands?
Right, if you have been struggling to book a cab on Ola, Uber, Rapido in Mumbai for the last 24 hours, then you're not alone, because these cab drivers are on strike. And even if you get a cab by any chance, either the rides are taking too long to confirm, or the fares are sky high, or it's just exorbitant prices that you have to put through. Well, all of this is because the drivers are on strike, as you mentioned. Yesterday, in fact, there was a massive gathering at Azad Maidan where all the drivers came together and listed out a charter of demands. Now, these demands include fare rationalization, parity with meter cabs, a ban on bike taxis with a white plate that, according to them, have been operating illegally, and an urgent implementation of Maharashtra Gig Workers Act and the formation of Drivers Welfare Board that was directed in the recent MVA guidelines that were issued just this month. Now, the MVA guidelines, the Motor Vehicle Aggregators guidelines, were issued just on 1st of July. This strike comes just days after that. Now, according to the guidelines, what is changing is that state governments will now will set the base fare for Ola, Uber and Rapido, and below 3 kilometers, the dead mileage cannot be priced in. Now, the demand here is that there should be a uniform policy and not just a state-based policy. So, when I spoke to some drivers, they said that the same policy that is taking place in Maharashtra should be applicable in Telangana or Karnataka, for instance. Another thing is that driver payouts should be standardized. A major point of clarification that these drivers need is on insurance, because the MVA guidelines did mention insurance to come in from the aggregators, but there's no clarity so far. So that is one of the demands that they have listed out. Apart from that, they want that there should be no surge beyond reasonable limits. Now, one would think that these surge prices are actually good for drivers, but they're not, because they think they exploit customers, and because of that, customers are not trusting enough to get in an Ola, Uber or Rapido, so in turn breaking customer confidence when it comes to surge price instead of benefiting them. So these are their demands. Another one is that gig workers should immediately be recognized under the labor laws. Now, definitely we saw that the MVA guidelines were a step forward, but what these drivers are looking for is more clarity on ground than just in policy.
Well, thanks so much for all of those details, Rachna. But with that, it's a wrap on this edition of Business Lunch. From Hormaz, me and everyone who put the show together, thanks for tuning in. Don't go anywhere. Midcap Radar comes up next.
Good afternoon and welcome to Mid Cap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Vivek Iyer and with me is Sonal Bhutra. Well, when you're looking at the market, all of the indices continue to trade with gains, and especially when you look at the mid-cap end of the markets that continues to do quite well. The PSU banking pack today clearly seeing significant buying interest led by SBI, some of the other names like Bank of Baroda, PNB, Canara Bank, all of these stocks doing quite well. We have a lot lined up on the show, so let's start off with the top headlines. Stocks trade ranged, awaiting a clear signal on the India-US mini trade deal. FMCG and PSU banks eke out some gains, while auto and metals track with caps in line.
Just Dial under pressure after reporting their Q1 numbers. Revenue growth slows while margins remain flat sequentially.
Veranda Learning in focus after sources to CNBC-TV18 suggest that the company may look to raise up to 380 crore rupees via the QIP route. The fund raised by the company is mainly aimed at reducing high-cost debt. HDB Financial share fall as profit and disbursements dip in the first quarter. AUM growth remains modest while asset quality was hit by the commercial vehicle segment. And Biocon in focus after the company expands its diabetes portfolio after the US FDA approval of Kirsty. The drug is the first and only interchangeable rapid-acting insulin aspart in the United States.
Okay, those are the top headlines that we are tracking for you. We'll speak about mid-caps in greater detail in just a bit. But if we talk about the headline index, as Vivek mentioned, all four of them are the major indices. They are in the green currently. We've seen the decisive recovery which has come by as well. Nifty is just at the 25,200 mark. We'll have to see whether that sustains those levels or not. For the mid-caps, it's a 50-point uptick. And Bank Nifty is lending a lot of support as well today. So we have a 0.3% gain on Bank Nifty as well, led primarily by the PSU banking index. The IT space has made a comeback after numbers that we've been seeing. We also have the FMCG space. A lot of these consumption names doing really well in trade today. But the major action today can also be seen in the mid-caps, as you were mentioning, Vivek.
That's right. The mid-cap space, especially the mid-cap PSU bank, led by SBI, of course, the large-cap name, but the whole host of other mid-cap PSU banks definitely doing very well in the session. There are a lot of news flow regarding there could be an increase as far as the FDI cap is concerned, and that, if happens, will clearly signal a positive sentiment for the entire PSU banking pack. As you can see on the bottom of your screen, SBI board has approved raising up to 20,000 crore via bonds in FY26. Well, earlier we had done a story stating that SBI is also looking to raise close to 25,000 crore rupees via the QIP route. But this is our special segment, Mid-Cap Movers. Today, Vamakshi is standing by the wall to take us through all of the mid-caps that are moving around in the session.
Well, good afternoon to you, Vivek. It's a quiet session as far as the indices are concerned, but lots of stocks that are buzzing in trade. It's quite loud in the broader markets. Take a look at some of the stocks that are gaining in today's trading session. Metropolis Health is up almost 6.4%, trading close to the day's highest point. So is Cera Sanitary, up almost 5.6%. Thermax as well as Aadhar Housing Finance seeing gains in excess of 5%. Lots of earnings reactions then. Let's also have a look at that. Take a look at Network 18, up almost 15% today. HDB Financials is one other counter. That stock is down almost 3%. Just Dial also reported a weak set of numbers. The stock taking a hit in today's trading session, down almost 3.5%. And Geojit Financials as well, down and out in trade today. But on the flip side, let's take a look at some of the newsmakers. Mass Financial up almost 9% in trade today, trading close to the day's highest point. Patanjali Foods, there's a board meeting scheduled. They will be considering their first ever bonus issue. So the stock is vibrant on the back of that news flow. And Dixon Tech, of course, on the back of that acquisition, up almost 2%. Let's also take a look at some of the stocks that are buzzing on the back of very strong volumes. BKG is one such counter. It has cooled off marginally from the day's highest point, nevertheless trading with gains of almost 2.9%. NCL Industries as well, 1.5% higher. And Zensar Tech as well, up almost 3.3%. Let's also take a look at some of the stocks that have managed to perch at a 52-week high. This includes KIMS, which is Krishna Medical. That stock trading at the day's highest point. RBL Bank as well as Strides Pharma also at a 52-week high.
All right, so a lot of interesting names there. RBL Bank, of course, we saw that story coming in from Sudarshan as well. We'll keep revisiting that one. But for now, let's welcome Jay Thakkar from ICICI Securities for a technical check on the markets. Jay, good afternoon. Thank you so much for joining in. We have seen a recovery in the markets, Nifty at the 25,200 mark. Will we add on to this, build on to this? And what about your individual picks?
Very good afternoon to you, Sonal and Vivek. Well, as far as Nifty is concerned, I mean, since yesterday we have seen a good, comeback in Nifty. I mean, it managed to hold on to 25,000 levels, Sonal, and that's very critical. I mean, in this entire, consolidation, 25,000 psychologically too acts as a very crucial support. If that gets broken, then I fear it could slip towards 24,800 or maybe the previous range could be tested. The lower end of the previous range was 24,500. Hence, 25,000 levels was important, and it did manage to hold on to those levels, made a comeback. And now, if you see, the PCR has also improved quite significantly from 0.53 to now at 0.8 approximately. And 25,000 to 25,200 range has seen a good put additions as compared to that of calls. In fact, we have seen rather some unwinding of the calls as well, making it a stronger case for a Nifty to bounce back till the levels of 25,350 to 400 in this weekly expiry, that is until tomorrow. In fact, Sonal, I would like to highlight that the IVs are pretty low at this point of time. I mean, between 10 to 11, the IV percentile is at 1.22. I mean, that's pretty low. It's at the extreme. So maybe tomorrow or after that, or maybe post the weekend, wherein we have good amount of results as well from the Nifty 50 stocks, I think the volatility is likely to expand. And generally, 70% of the times, markets react negative to IVs rising, but 30% of the time it has happened so that markets have gone up as well when the IVs are expanding. But IVs are likely to expand. That's very much likely looking at the Bank Nifty data as well. The banking and financial stocks are doing good, so probably it's the case that IV may expand as well as the prices may also expand on the upside. Hence, I have 3 buy recommendation, all of them from the financials only, of course. So the first buy recommendation is on LIC Housing Finance. I mean, this is trading at 636. The stock has seen a good long build-up after a good unwinding, and the futures are quite at a lower levels. I would say the open interest. So this is a buy for a target of 655 to 670 positionally, and one can place a stop loss at 625. The second buy recommendation is on Bank of India, and in this stock too has seen a good long build-up now lately, Sonal, and it's trading around the levels of 117, 118 now. So one can expect 125 to 128 levels in the short term. One can place a stop loss at 114 and go long on Bank of India. And second, third, last stock would be, it's not from the financial, sorry, it's from the consumption, and it's on VBL, Varun Beverages. The stock, since the entry in FNO, Sonal, has seen a good short build-up, and now it seems to have formed a good base, good bullish crossover, as well as the shorts are likely to cover from these levels. So trading at around 479, 480 range, one can place a stop loss at 465, and one can target 500 to 515 in the near term.
Okay, thank you so much, Jay, for joining us. You've given us both your view on the markets as well as your individual trading bets. Well, before we slip into a short break, here's a quick note for our viewers. We are thrilled to share the next chapter in CNBC-TV18's journey, the launch of CNBC-TV18 Prime, a premium subscription-based platform designed to deliver world-class insights and in-depth global coverage to India's decision makers. To mark this milestone, we are hosting a special evening of dialogue and connection with a curated gathering of leaders and change makers, where the likes of Bain & Company's Manny Makada, Delphi Capital Management's Robert Rosenkranz, market veteran Ramdev Agarwal, HDFC Life's Dheeraj Israeli, former Region Minister of Singapore George Yeo, former Foreign Secretary Shyam Sarin, and Brookfield's Ankur Gupta will be a part of this landmark celebration. Join us 5 p.m. onwards.
Welcome back. You're still tuned into Mid-Cap Radar on CNBC TV 18. We've been talking about how broader market participants, they've been doing really well. Premier Explosives, that's one of the names that we are focusing on. It's trading after receiving an order. Ria is joining us now with the details of the order and what it means for the company. Ria.
Well, yes, Sonal, Premier Explosives has been trading higher in today's session after receiving an export order worth $12.24 million or approximately 105 crores. And this is for the manufacturing and supply of defense explosives. And the order is going to be delivered within the next 12 months. Now, remember, in Q1, the company has also received other export orders worth cumulatively about rupees 22.6 crores. And these orders were for defense products and commercial explosives as well. The current order book of the company stands at about rupees 750 crores as of the end of FY25. And going forward, the company has said that for FY26, the order book is to be maintained at about rupees 800 crores, with that implies inflows of about rupees 500 to 600 crores for the year. The revenue is expected to be in the range of rupees 500 to 600 crores and EBITDA margins in the range of 18 to 20%, although they may come down to 15% as well.
Thank you so much, Ria, for joining us and giving us a sense of what exactly this particular order means as far as Premier Explosives is concerned. Well, Just Dial is under pressure after reporting its Q1 results. Rima joins in with more details.
Thanks so much for that. So the reason why Just Dial is under pressure today is because revenue growth for the company is slowing down. Revenue growth about 4 quarters back was high single digits. It's come down to mid-single digits, 6.2% in the current quarter. Also, the paid campaign revenue growth has further slowed down to 4.3%. So that's the key negative. Now, in the numbers, margins are still very resilient at 29%. But the question is, are they sustainable? Ambit believes they're not, because they're saying the company has started investing in Salesforce hiring, etc., in ad spend, and therefore margins are not sustainable. In their own assessment, last year's margins were 29.4%, but by the end of FY28, margins will come down to 25%. So the silver lining in the numbers were margins, but according to Ambit, they're not sustainable, which is why they have a sell rating, and they believe the growth margin trade-off will continue for Just Dial. The good part is, for Just Dial, it's always been the case, is the cash on the books, which is nearly 4,500 crore rupees. So therefore, valuations X of cash are fairly undemanding. According to Citi, the PE X of cash, if you strip out the cash from the market cap, would be at sub 8 times FY27 PE. So that's a positive. And secondly, with that huge kitty of cash of 4,500 crore, you always have that buyback, dividend, M&A opportunities. So which is why Citi is bullish with the target price of 1,100 rupees per share on Just Dial. But the reason it's under pressure today is on the back of slowing revenue growth, and that needs to be arrested. Back to you.
All right, slowing revenue growth, that's a concern for Just Dial. Thank you so much, Rima, for joining us with that analysis. Gaurav is joining us now, and he's going to be talking to us about HDB financial results. Recent listing, how did the numbers look, Gaurav?
Well, when we talk about Q1 numbers, they actually look a little weak, and there are two aspects to that. First is when we look at disbursements, they have come down almost by 8.5% on a year-on-year basis. And second is credit cost has inched up, and that is the reason when we look at the profitability, there also we have seen a decline on a year-on-year basis. On the other hand, when we talk about net interest margins, there we have seen an uptick, which is actually positive for HDB Financial. So first, let's look at the numbers. Net interest income has increased almost by 18% on a year-on-year basis. This is again reflected in its net interest margin, where we have seen an expansion. Let's not forget that management has also said that there will be another expansion because the 100 basis point of fall in the repo rate is yet to get picked up in the results, and that is the reason they are actually a little optimistic about net interest margins. On the other hand, PPOP growth was also healthy. What happened is that the credit cost actually inched up almost by 10 basis point. It is now at 2.5%, which actually puts some strain on the profitability, and that is the reason when we look at profitability, it has declined almost by 2.5%. Another reason for management to believe that the ROAs can go up is that they believe from Q2 onwards, the credit cost is likely to ease up. We may see stable credit cost in Q2, and from thereafter, we will see credit cost coming down. Let's not forget for FY25, we have seen credit cost somewhere in the range of 2%. So again, management has not given any kind of guidance, but that is the optimism that management is building in. And on back of that, they believe that ROAs will also improve. But for now, on the back of weak results, we are seeing the stock is actually struggling in trade today.
Thank you so much, Gaurav, for joining in and telling us why exactly HDB Financial Services is under pressure today. Well, moving on, Network 18, the stock rallies over 14% in trade, post its Q1 FY26 numbers. The margins have improved for the company, while its viewership share has risen too in the quarter gone by. Let's listen into what the company's Managing Director, Rahul Joshi, has to say on the performance of the company as well as the road ahead.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If you look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments, maybe in areas like First Post or in money control. So overall, I am hopeful that the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We have only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
Okay, all right. That's the word coming in from Network 18. Of course, a disclaimer that the channel that you're watching is owned by a trust of which Reliance Industries is the owner. The stock is up around 17% as we speak. We'll slip into a short break. When we come back, we'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back to Mid-Cap Radar. Well, the broader end of the markets continue to see some buying activity. First on our list, to have a look at Indian Hotels. That particular stock doing quite well. In fact, at the bottom of his reel, another hotel company, remember it's the demerged entity of ITC Hotels. That particular company has seen its profit surge by over 50%. So net profitability is higher by 54% at 133 crore versus just over 86.5 crore last time around. That particular stock trading has recovered a little bit from the day's lowest point, now up close to 0.6%. Along with that, Indian Hotels too is now spiked up to the day's highest point. Another stock from the auto pack that's doing very well in the session today is M&M. That's seen a very strong spike, Mahindra & Mahindra. That particular stock is now closer to the 3,200 rupees per share mark. That particular stock doing very well in the session today. Well, moving on, RBL Bank is on our radar after the shareholding pattern for June reveals that mutual funds have increased their stake in the stock significantly since March 2025. Sudarshan joins in with all the details.
So RBL Bank has been in focus today because June shareholding pattern has been released by the company, and it shows that all the mutual funds either have entered in the first quarter of 2025 or they have increased the stake in the company. So first of all, the mutual funds as of March 2025, their stake was of 15.3%. Now in June, as of June 30th, their stake has increased to 29.2%. Similar pattern was seen for FPIs as well. Their stake as of June has increased to 17.6% from 14.4% as of March 2025. Now, where exactly the stake has increased from? Because the holding of retail shareholders has come down. So retail shareholders as of June 2025, their holding is at 28.7%. It has come down from 38.7% that they held as of March 2025. Foreign companies too have reduced stake because British International Investment had exited the company, which had held 3.8% stake as of March 2025. So now foreign companies are holding 3.5% as of June against 7.4% as of March. So which are the major mutual funds which have entered into the company in the first quarter of Q1, basically Q1 FY26? So SBI Mutual Fund now holds 3.3%, Tata Mutual Fund 2.1%, HDFC MF 1.6%, Aditya Birla Mutual Fund 1.3%, ICICI Prudential Mutual Fund 1.2%, and Mirai Mutual Fund 1.1%. So these mutual funds have entered into with their investments in Q1 FY26. Two mutual funds, Nippon Mutual Funds, as of June 2025, it holds 4.3% and has increased from 3.1% that it held as of March. And Quant Mutual Fund continues to hold around 6.6% stake. Now, if you take a look at the return of the company's stock, in 2025, it has given the returns of almost 70%, and even this month, it's up almost 10%.
All right, makes sense. Thank you so much for explaining that to us. The stock is up 2%, and that is the analysis that Sudarshan shared with us. L&T Tech Services, that is the company which will be reporting its numbers as well. Rima is joining us to tell us more.
For LTTS, it's expected to be a muted quarter. Revenues for the company are seen down 2% on a quarter-on-quarter basis. Constant currency revenue growth is likely to fall even more, down close to about 3%. This is an account of weakness in one of their businesses, Smart World SWC. Even high-tech has been a bit subdued. Automotive has been under pressure. So the outlook for mobility has been weak too. Margins are likely to remain flattish, so 13.4% versus 13.2%. Now, here the big question is, last time the company did acknowledge that Q4 didn't pan out as we were expecting. We thought we would grow, we didn't, but we still hold on to a double-digit revenue growth in FY26. Now, does the company maintain that? Because Q1 is going to be soft. So that is going to be the crucial part for L&T Tech. That does the company hold on to its double-digit revenue aspiration? Back to you.
Thank you so much, Rima, for joining us and giving us what exactly the street is anticipating as far as the results of L&T Technology Services is concerned. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in. As always, the markets have moved to the green territory, and we're seeing the Nifty as well as the Sensex as managing to hold on to gains of almost 0.1% right now. So let's watch out for that, right? Because it opened up in the green, went to the red, and now we've seen that recovery coming in. Now, recovery, what is it led by? Let's pull up that Nifty PSU bank chart as well, because that's buzzing in trade today, and all these PSU banks are managing to hold on to gains, and this is coming in post-12 that we're seeing this run up further coming in for the PSU banks. And we're done. My colleague Sapna had done a story around this as well. So keep an eye out on PSU banks. Other than that, we have Nifty Media, which is managing to hold on to some bit of a gain as well. So that is something to watch out for in terms of the trading session. So yes, an interesting day coming in where we're seeing broader markets also right now managing to hold on to a slight bit of a gain, but the small cap, that's flip-flopping between the red and the green right now. So that is something to keep an eye out on, whether, it actually moves back to the green territory, the small cap, and does it manage to sustain to those gains now in the second half of the trading session? That's what we're going to be watching out for. But this is a show where we solve all your stock related queries, and that's what we're going to be doing today as well. We have Asta Jain of Hem Securities joining in with us, as well as Saumil Mehta, head of alternate research, capital market strategy at Marai Asset. Sher Khan. Saumil as well as Asta, good afternoon, and thank you so much for joining in with us as always. Let's get started with all the stock related queries. Now, the first query for today is coming from Rajan Nayyar, who's writing to us from Chennai. He's holding 200 shares of IREDA, and this is at a price of 140 rupees per share, making some bit of a profit on this one. He's a long-term investor, wants to know whether he should continue to hold or look to sell this one. Asta, IREDA, what's the view coming in for this stock on the fundamental?
Hi, good afternoon to all of you. Talking about the fundamentals of this counter, we all know that it is one of the green financing NBFC in India, and now they have started diversifying towards RE, battery storage, etc. So now we have seen that they have shown a very strong growth in their AUM of around 28%, and now their AUM stands at somewhere at around 72,000 crore. So their AUM has seen a sharp increase. And in fact, what we are liking now about this counter is the valuation, because now it is trading at a price to book multiple of around 4.4x of FY26 book value. So we believe that it is an attractive at this point of a time from the valuation perspective as well. So looking after all these factors, we believe that this counter continue to gain more momentum from here, and hence we are recommending hold on this counter with a price target of 185 to 200 in the short to medium term.
Okay, so positive on this one, and this is despite those numbers also that we saw coming in this week as well in terms of QY FY26 for the company, but positive on the outlook for the company going forward. So yes, the hold is coming in on IREDA on the fundamental fund. Saumil, what's your view coming in for IREDA, right? Like this was a stock where, post that listing, we've seen that run up coming in, very, very sharp run up, and it didn't stop. It reached even that 280, 300, I think approximately that level. And then since then, we've seen that bit of a decline coming in slowly and steadily. Every time over the last year, the decline has come in. Now, what are we watching out for? Should we expect a run up again coming in here?
I don't think so, Vinny. I'm a little negative on the stock. It's been struggling. The stock has been struggling to go above the 200 daily moving average for a little while now. Struggling to go above 20 and 40 daily moving average, making low tops, low bottom. In fact, I think three trading sessions back, a weekly low has been breached as well on the downside. So negative in the short term, negative in the medium term outlook as well. Resistance is around 170 for the stock, and I'll be expecting this stock to retest the previous swing lows of 137, 140 levels.
Okay, keep an eye out. Not too positive on the technical front for IREDA. Next query for today. This is on ICICI Lombard. They reported their numbers as well just yesterday. Asta, overall in the numbers seems like there are some positives and negatives that come in for the stock, especially in terms of obviously positive side in terms of the premium growth that we saw coming in. But other than that, there's a bit of a negative surprise that's coming in on the motor segment for the company. Now, Saharsh Reddy is saying, who is from Hyderabad, is wanting to know, I beg your pardon, whether to enter ICICI Lombard for the short term, given that we're seeing these numbers also coming in. What's your view here?
So my view is positive, but if anyone wants to make entry, I would believe that it's not the right point. Maybe at the lower level of somewhere around 1950 or 1980 odd levels, one can make a fresh entry into this counter. Now, talking about the number, we have seen that there was a growth in the profit after tax. This solvency ratio is also looking to be very strong to us, and in fact, ROEs have shown a very strong growth. So overall, solvency ratio is on the right path, and ROEs, sorry, I beg your pardon, ROE is also showing very strong growth. It is at around 20%. So my idea here is, in the short term, it is better to wait for some more dip to come in and then make an entry into this counter. So 1950 is a good level to enter into the stock, and then the price target which can be set for this counter is somewhere around 2200 to 2250.
Okay. And Soumya, on the technical front, what are the levels that one could look to enter? And it's a short-term view that they want. So if you could give us a short-term target as well.
I totally agree to Asta. Actually, in the medium-term outlook, I'm definitely positive on the stock. But in the very short term, this is not the right time to buy into the stock. There's a lot of consolidation going on at these levels, and I think 1950, 1900 would be a correct level to buy into the stock. I'll give you the levels. 40 daily moving average is 1965, which is a very crucial level to watch out for, and 200 daily exponential moving average is at 1870. So these are the two levels to watch out for, and buy on decline should be the strategy for a medium term outlook, not in the short term. Short term does not look that great.
Okay, short term does not look that great. It's better to look at it from a medium term point of view. That's the word coming in on the fundamentals and technical front. Let's move on to the next query for today. We have Bala Subramanian, who is writing to us from Bangalore. He's holding 30 shares of ACC. This is at a price of 2,561 rupees per share, and this is since June 2024. So obviously right now they're making a loss on this one. He wants to know if he should continue to hold this for another year, expecting a turnaround on the industry that they are in, and obviously given there are a lot of conditions, but should he book out his profits or book his losses, I beg your pardon, or continue to hold this for a time period of 1 year? Asta.
I think it's better to wait for this stock to show a good momentum again in the near future, and then exit from this counter, not at the present moment of a time. Maybe 2250 to 2260 are the good levels where this stock can reach. Now, talking about the fundamentals of this counter, we believe what we have seen in the revenue gain in the last quarter was mainly due to the volume gains, and hence we have seen a good revenue gain. In fact, the capacity expansion is also on track. And the most important point is the green power share, which has now increased to 22%, and the company is aiming to increase it to more than 60% by FY28. In fact, we have seen some sort of EBITDA margin gain also, and maybe due to the cost-saving initiatives taken by the company. So overall, I believe in the long term, this counter is not such a counter where one can take the losses and make a exit. It's better to stay invested in this counter, and we believe that it has a potential to move till the level of 2250 to 2260. So right now, a hold is recommended from our side.
Okay, 2250, 2260 is still below the buy price, but at least, not the loss that they're making right now is what we're watching out for. But so wait out right now, wait for the levels that Asta is mentioning. Soumya, your view also coming in on ACC, the buy price is 2,561, and they're just saying that 1 year time period, can they extend to hold it in that time period? Could it reach there? Is there any hope on the technicals?
I think this stock basically is the downtrend, a low top, slow bottom formation on the monthly charts as well, struggling to go about 200 daily moving average. But this stock has taken multiple supports around 1800 levels. So this level will remain a very crucial level to watch out for. I think for a long-term perspective, I'm very positive on this stock because 1800 levels has not been breached for a little while now. And I'll be expecting a breakout of this range, which has been forming in the last 3 to 4 months. I'll be expecting this range to break on the upside. And the targets for a medium to long-term outlook would be around 2400, 2500 levels. So I think hold is a suggestion from my side for a medium to long-term outlook.
Okay, hold as a suggestion from the medium to long-term outlook. Let's move on to the next query, and this is coming from Balaji, who's writing to us from Coimbatore, holding 3,200 shares of BEL. This is at a price of 425 rupees per share. Wants to know whether to hold or sell this one. Asa, I've spoken a lot of times about defense names, BEL as well. Does it continue and merit holding the stock, sell, or should they add more? Is that also an option right now?
So I think right now hold is a strategy which one can apply for this counter, and buy on dips can be a strategy if anyone wants to make a fresh entry also, but not at the current point of time. With a price target of 440 at the initial level. Now talking about the fundamentals of this counter, fundamental seems to be strong because we know that they have a strong order backlog. They have got industry leading position, and with the growing demand of the electronics in the defense space, definitely this company is getting very strong order inflow. So we believe that this company is well poised to show more upside from here, maybe not in the short term. So it's better to wait for the medium to long term perspective with a price target of 440. And if anyone wants to make a fresh entry, I think anywhere 390 or 385 are the good levels to make a fresh entry also in this counter, but not at present moment of time.
Okay. Fresh entry can be made at those levels that Asta is saying, but right now just hold on to the counter. That's the word there. On the technical front, what are we watching out for? Last 14 days, the stock is down 5% almost. Last 1 year also, not much of a overall return that we were not seeing coming in. BEL, what are we watching out for now, Somil, on the technicals?
BEL, one of the best counters in the defense space since February 2025. In last 4 months, it has gone from 240 to 436 on the highs. I think great rally. We've seen a very good rally. It has just been, I think there is small retracement going on in the very short term. And I think medium-term outlook still remains very positive. So buy on decline should be the strategy. If somebody is holding on to the stock, hold on would be my suggestion. Buy on declines would be my strategy. If somebody wants to re-enter or wants to enter at probably the levels would be 380 or 360 levels. That would be a great time to buy the stock. So buy on declines should be the strategy for a medium to long-term outlook.
Buy on declines is strategy coming in there. I beg your pardon, I was talking about 1 month. When I said the returns was not much, that was 1 month return, was not much in terms over there. 1 year, 25% gains. Keep an eye out on those levels. Buy on dip strategy coming in for BEL. But on that note, we're going to sip into a very short break. And as we sip into the break, remember that you can tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to your stocks on CNBC TV18. We still have with us Asta Jain of Hem Securities as well as Somal Mehta of Mirae Asset Sharekhan. A quick look at just the markets before we get to the stock-related queries, because the market has moved to the day's highest point, 238. Sorry, I beg your pardon. 25,238 levels is what we are watching out for. But yes, at the day's highest point is what the Nifty is trading at as of now. Let's move on to the next query that we have coming in. This is from Sivanandan Devi, who's writing to us from Chennai. She's holding 100 shares of Sudarshan Chemical. This is at a price of 668 rupees, making a profit on this one, while 20 shares of Pidilite also is what she's holding. This is at a price of 2,220 rupees per share. On this one, she's making a loss. Now, she has been holding these for more than 5 years. Wants to know the outlook on both these companies. Asta, your view coming in, Sudarshan Chemical and Pidilite.
So Sudarshan Chemical, if I talk about this counter, they are the largest pigment manufacturer in Indian space with a 33% market share. In fact, in the global industry also, they hold third position. Now, what is a major attraction of this counter is that they have got an increase in the market share. They have various new products which they will be launching in the coming future. And in fact, they have concluded one capex also. And their go-to-market strategies seems to be very strong, which will work in favor of them. So overall, and the industry tailwind is also there, because what we are seeing from last few months that the chemical space is in the real flavor right now. So overall, I think this is the counter which is well poised to move more upside from here. 1350 is the target which we are setting for this counter, and hence I'm recommending hold. Now, talking about Pidilite, Pidilite is also hold from our side. If we talk about their UVG, that is underlying volume growth, they have posted underlying volume growth of around 9.8% in the Q4 numbers. And in fact, now they are looking into the entry of adhesives and the specialty chemicals for the EV semiconductor space. So I think that can also help the company in posting good numbers. Overall, Pidilite is also looking good to us, and we are setting a hold on this counter as well with the price target of 3150 at the initial levels.
Okay, interesting. Keep an eye out on those levels over there for both the stocks. Your view coming in on this, Somal, on the technical front as well, both for Pidilite as well as Sudarshan Chemical. What should the viewer do?
Sudarshan Chemicals definitely looks good. Every time it takes support at 40 and 20 daily moving average, it resumes the uptrend. So right now it is just consolidating in a small range between 1300 and 1200 levels. I think this consolidation will break on the upside, but this stock is for a positional trade or an investment. In the very short term, not much happening. It is just consolidating in a range. So you can go long on the stock. On a positional side, 1200 would be a very crucial support for the stock. Pidilite, definitely same situation. In the very short term, range-bound trade happening. 2900 is the lower end and 3130 is the upper end. I'll be expecting this entire range to break on the upside. So positive in the medium-term outlook. Buy on declines should be the strategy, but a crucial support at 2870.
Okay, keep an eye out on those levels over there. For Ashok Leyland, price is 150 rupees per share. She's a long-term investor. She is willing to hold the stock for the long term as well from here on. What is the view coming in on this one, Astha?
View is positive, definitely. And here the buy price is 150. So why not to remain invest in this counter, at least to see come at the break-even levels. Now, talking about the fundamentals of this counter, I mean, the EV expansion is on the track. What we have seen in the margin is due to the cost-saving initiatives by the company. The margin has also shown some sort of improvement, and volume gain was also there in this counter. So let's wait for the result and don't book losses into this counter. My idea is that this counter can move till the level of 135 to 150 in the near future. So hold is recommended from my side.
Hold is recommended from your side, and Somal, your view?
Absolutely positive on the stock in the medium-term outlook. The support should be 40 daily moving average, which is 121, and 200 daily moving average, which is 113. Positive on the stock. Buy on decline should be the strategy. 140, 150 should be on the cards for the medium-term outlook target.
Okay, keep an eye out on those levels over there for Ashok Leyland. But that was the last query for today. So Asta as well as Somal, thank you so much for joining in with us as always and helping our viewers solve all their stock-related queries. And viewers, thank you so much for sending us your queries. Remember, you can always email us your queries. The email ID is at the top of the screens for you all. So email us your queries here and we'll solve them on Monday, Wednesdays and Fridays at 2 p.m. But with that, we're going to wind down this edition of Your Stocks Today. Thank you so much for tuning in. The last round of trade is still left, so you have closing bell up next to take you through all that market action.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
What's doing well, on the other hand, is Taiwan. That index is up almost 0.6%.
Working along that same line, we're going to have access into India.
25,001 should not be broken. 25,200 on the Nifty bank is up about 0.25%.
There has been a soft commitment from LIC to put in bids for as high as a little over 5,000 crore rupees.
Mid caps are flat, but there is some positive bias to that.
our revenues are very stable over the last few years because we are a large group. We have large number of television channels.
As far as retail is concerned, the stake is reduced to 28.7% from 38.7%.
51% stake is what Dixon will be acquiring in QTech.
The headline index, as Vic mentioned, all four of them are the major indices. They are in the green currently.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel D'Souza. And at the day's high. In the morning, things looked a little shaky. Yeah. We were never in the, under the risk of a collapse. So things never got, weak or ugly. But just look at that intraday chart. From the day's low, it's been a recovery more than 100 points. And now back above that 25,200 mark.
Well, I'll tell you, Reema, the PCR at 0.7 and FI net shorts at 1.2 lakh contracts has normally been a winning theme. We have seen that in the past as well. So the markets may not bounce very much from here, but there's always that scope to see bounces, because the shorts are in the system. So as you get the bounce, the call writers run for cover, the shorts as well run for cover. And if you look at it, Reema, the bounce has been good on the Nifty. The few factors that are played out is your tech companies, they've not delivered great numbers. But those dips are getting bought into. So the tech index, in fact, is rallying today. We have Tech Mahindra that will be delivering its numbers, 0.8%. That's doing the heavy lifting today. Pull up the Nifty Bank. That's been in fine form. It's protected the 20 as well as the 50 DMA. That continues to do well. So good move is what we're seeing on the Nifty Bank. In a bit, we'll pull up the Nifty as well as the 20 DMA. But the third part of the Nifty that I'm going to pull up is the Reliance Industries stock. That one has recovered close to around 0.5% from the low point of the day. And most of that has come in the last 20 to 30 minutes. And because of that, we've seen a good bounce. You have all the participants of the Nifty, that's the IT index, the Nifty Bank, as well as Reliance Industries. Just 1 point, the Nifty 50 needs to get past the 20 DMA. Beautiful. Just take a look at that. That's the one that we're looking at. Around 40 points away from these levels. If you can get past that, then you're bracing for a further bounce from here on. But that buy on dip has worked out perfectly well, Reema, today. And overnight, you had the Nasdaq actually that did a relative outperformance.
Record high on the Nasdaq.
Record high out there. And Nvidia, leading the way out there. And today, the tech index has done quite well. So I think it's a very good looking screen going by the uncertainty you're seeing on the globe.
Okay, so how should you position yourself in the last hour of trade? What would be the stock calls you should be taking? Mitesh is now joining in. Mitesh, would you take comfort from that intraday recovery? Or do you think we have some more ground to cover before you turn constructive?
Good afternoon. I think, what is the most comforting part is the Nifty PSU banking index, which is given a breakout. Last time we saw a high of around 7,230 and then 7,250. And today we saw a high of around 7,300 plus, and we are just trading about 7,270. So I think the PSU banking index, which is stocks like State Bank of India, Canara Bank, Bank of Baroda, they are doing well. And that's why I think the Nifty is not turning weak. My sense is that I think the Nifty, could even suggest that this bounce back could extend to about 25, 300, 320, 330 zones. But only once we start getting past those levels would I turn aggressively bullish. Till then, I think it's more of stock-specific trade, though, on the long side. I do have a buy on Canara Bank. I was just discussing that stock. That's a buy with a stop at about 115 or 114.75, and a target of 122 can be looked at. And the other one is Bajaj Housing Finance, which I would recommend buying with a stop just below levels of 120 for a target of 129.
Okay, got that. Any IT stock on your radar? They've bounced back, despite the bad news in the last couple of days. First, it was many of these ER&D companies like a Tata Elxsi, a Tata Tech. But now even Wipro is higher in trade ahead of numbers tomorrow. Tech Mahindra reports numbers today post-market hours, and that's showing you a gain of about 2%. Infy up 1.5% ahead of numbers next week. So market seems to be believing bad numbers may come, but at least, the negative reaction could be in the price.
In fact, yes, I think a lot of these IT stocks didn't come out with any kind of, the ones which have announced their results. Nothing encouraging over there, but I think, the price action is slightly on the positive side. With that, a disclaimer that I have long positions in Tata Technologies, looking at a target of around 760, 780 to begin with, then maybe even higher. But that apart, what is also looking very interesting is Tata Elxsi. I think, that's the stock which had a big breakout in the last 2-3 days. Today is giving a pullback. So this could give you a good entry point. If you get the stock closer to about 62.50, 62.40 zones, buy there with a stop below 61.80 and I think the stock could top 6,600 levels.
Got it. Okay. All right. Thanks a lot for that, Mitesh. Well, let's get to discussing a couple of stocks then. HDB Financial, that's in focus, post its Q1 numbers. Gaurav is here to help us out with more details on that. Gaurav, the stock is coming for some profit taking.
Well, yes, when we talk about the numbers for HDB Financial specifically, we have seen some kind of weakness, and there are two reasons behind it. First is that the disbursement has gone down almost by 8% on a year-on-year basis. And second disappointment came from the credit cost. Now that has inched up almost by 10 basis points. And as a result, when we talk about profitability, we have seen a dip of around 2.5%. So first, let's understand the numbers. Net interest income has gone up almost by 18%. We have seen NIMS expansion of around 10 basis points, which was actually positive. When we talk about pre-provisional operating profit, there also we saw a good growth. In fact, the cost to income ratio for the stock and the company has actually come down, which is again a positive thing. But credit cost has inched up, and as per company's overall commentary, they have highlighted that the CV, which is commercial vehicle segment, is something which is going to be a pain point for the company, at least for this quarter. And that is the reason why the cost to income and specifically the credit cost has increased. When we look at the commentary going ahead, they believe that in second quarter there will be some stability, and going ahead from second quarter onwards there will be credit cost which will stabilize and come down, and that is the reason why they believe that ROAs can go up. Let's not forget that for Q1 ROAs has come down to 1.9%, but it also includes the fundraise. So if we exclude that part, ROAs have been at around 2%, which is again a little lower than the street's expectation. But management commentary suggests that ROAs can go up. But at least for now, in this quarter, because of the weak numbers, specifically increase in credit cost, we are seeing a negative reaction in the stock price.
Okay, all right, got that. Thanks a lot for that, Gaurav. And the other stock actually that's in focus in today's trading session is actually Shriram Transport. Shriram Finance, I think we should get that stock as well up for you. From the word go, the stock has been under pressure. That's because I was reading a couple of notes as well. In Macquarie states, they're expecting some kind of trouble in the CV space because HDB, in their commentary, they said that they did see stress in the vehicle finance, particularly in the CV book. And the CV book is largely for small truck owners and not large fleet. So because of the comments that came out from HDB Financial on the CV space and the kind of stress that they're seeing out there, Shriram Finance is a little bit under pressure. Let's pull up Chola as well, because that as well was mentioned in the Macquarie note that I read earlier this morning. That as well could be a little bit tepid. No, that's holding up in the green. But Shriram Finance is the one that from the word go has been down close to 3%, and it continues to remain under some pressure. Prakash, what's your view? HDB Financial, from the issue price, it's still much higher. These numbers are a little bit weakish. And if you have any kind of read-through for Shriram Finance.
No, so Nigel, I think HDB is still too fresh, too new for people to kind of take judgmental calls in terms of whether these numbers are good enough for an entry. And of course, the higher issuance price becomes a bias of sorts. But if you take that out and not kind of, if I didn't know the issuance price at 810, 15 watt, is HDB a buy? The answer is you'll still have to give them a couple of quarters to start coming into the reckoning in terms of the competitive environment that top NBFCs today play in. It's no mean feat for a Shriram, for a Chola, for a Bajaj Finance to kind of have clocked these numbers. They all have their own strengths. HDB will also have to kind of start standing for some sort of a USP, some sort of a strength, and that's going to take a couple of quarters. So I'll wait. Shriram, of course, I think is one of the best in breed NBFCs that you have. They've consolidated. The balance sheet has got ever stronger. And my sense is that he'll probably continue to acquire certain portfolios which will help them scale up much more faster than the competition, because organic growth is definitely coming at a cost in terms of time and money. And that's something which most NBFCs are aware of. So anybody who gets to carve out a decent acquisition, a decent portfolio, if not the whole company, they are the ones who will do well. And I think from that perspective, Shriram Finance stands a very good chance. They've proven in the recent past, that they're up to it, and they could probably continue that strategy. So quite positive, but again, it's a long-term secular comment. It's got nothing to do with the move today. Today, the day has gone to PSU Bank. So, everything else will probably get eclipsed given the way they've outshone most other subsectors in the BFSI space.
HDFC Bank started with strength. As soon as that bonus announcement came through in the morning, it was a positive tick, but now has completely flattened out. So first ever bonus for HDFC Bank, and plus that special interim dividend. Now, the bank has been paying dividends regularly, but this time, what would you expect in terms of a special interim dividend?
So, Rima, I think the money that they've got through the HDB Financial Services float, that's something which makes sense to pass on to shareholders, given the fact that they cannot increase their book till their credit deposit ratio starts getting into that tolerance zone. So, I think they're very consciously going slow on that, making sure that quality is not compromised, but the book grows in a very calibrated way because of the fact that, when interest rates start coming down, there is a rush towards deposits, and HDFC Bank ends up getting that by default. So, it's probably the go-to place, and SBI and HDFC Bank, these are very strong recipients of all the inflows. So I think the dividend, the bonus announcement probably doesn't make a material difference to the stock in any case, but the dividend could probably be more of returning the money that's come in from the float of the HDB Financial Services IPO. So if you do the math, it'll probably be slightly more than what they've been paying off all these years, and it could be a bit more generous. So that's the advantage. But of course, it has its own tax implications, and hence people will probably see it as a post-tax effect in terms of what comes home. So that's why you didn't see the stock hold on to that momentum that was there when we heard the announcement in the morning.
Okay, all right. Got that. Thanks a lot for that, Prakash. Well, let's hop across to Nimish. RBL Bank, that's on our radar to offer the shareholding pattern for June, reveals that mutual funds have increased their stake in the stock significantly since March 2025. Nimesh joins us to tell us more on that front. Nimesh?
Thanks, Nigel. So as you rightly pointed out, RBL Bank is in focus. A big update in terms of the shareholding pattern. And mutual funds combined has increased the stake in RBL Bank in just one quarter from almost 15.3% to almost 29%. So nearly 14% is what the mutual funds have added into RBL Bank in just one quarter itself. That's not the case. Even FPI, which is the foreign portfolio investors, even they have increased the stake from 14.4% to 17.6%. So these are the two large holders, mutual funds as well as foreign investors. They have significantly increased the stake in RBL Bank in just one quarter. The insurance holding is pretty much flat at nearly 3%. So who sold out? The one big entity which is sold out is part of the foreign company's portfolio. Their holding has come down from 7.5 to almost 3.5. And within that, British International, they seem to have completely exited out of RBL Bank. This is according to the shareholding pattern as of June. They were only holding close to 3.8% as of March. That doesn't exist in the June filing. So it looks like British International has completely exited, selling the 3.8% in RBL Bank. The other big stakeholder who've reduced the stake dramatically is the retail shareholders. Their holding has gone down by nearly 10% in RBL Bank in the last one quarter itself. Now, coming to the mutual fund, which is the most important part of that piece, which is wherein the mutual funds have added nearly 14.5% stake in just one quarter. In that, the significant stake addition has come from SBI Mutual Fund. In the June filing, SBI Mutual Fund owns now close to 3.3%, which was not there in the March quarter. So that's one big addition within the mutual fund, which is SBI Mutual Fund. Tata Mutual Fund now owns close to 2.1, which was not there earlier. Same is HDFC Mutual Fund, 1.6%. Aditya Birla Mutual Fund owns nearly 1.3 now, and Mirae and Nippon are the other ones who've added. Nippon, in fact, was owning close to 3.3%. Now they're up to 4.3%. So clearly, among the mutual funds, the biggest investor in RBL in the last one quarter has been SBI Mutual Fund. But the big story is basically at the headline level, the mutual fund holding in RBL Bank has gone up by nearly 14% in just single quarter, from 15% to almost 29% now.
Thank you very much for that. That's doubling, Nimesh, the increase in just one quarter. So MFs have doubled, FPIs have shown interest, so their stake has gone up. But on the other hand, retail investor interest seems to have declined. So Prakash, who's got it right in the case of RBL Bank?
I wish we know of this at this stage. But remember, it's a bank that's been quite sought after by a lot of other suitors as well. We had, apart from the couple of banks from the Middle East that spoken about in terms of having immense interest. You also had the Mahindras looking at it at some point in time, and they happen to have a significant corporate ownership of this bank. What's happened is the opportunity to buy this bank, which was just kind of at the cusp of repair, came in when in March or April it went almost as low as 160. And that was on the back of a lot of the issues that it faced, starting with the credit card bans and all of that. But the recovery from that has been so significant that you'd probably see most of this buying has happened because you are getting great value. Now, if there's a turnaround in the bank, and if you have a new, management coming in or a new owner wanting to kind of capitalize the bank and start growing it, it has everything going for itself. So I think that seems like the case. A lot of people, so many people can't go wrong. And the consensus seemed to be that this will deliver and will become probably a very leading private sector player in the space that's been vacated by Yes Bank, to some extent by IDFC Bank. So there's this vacated space that needs to get filled. RBL probably has that this thing. I mean, just conjecture at this point in time. I have no empirical data to support it, but I'm sure evidence will keep coming as we go along. So from that perspective, definitely makes for a very good risk-reward opportunity.
Okay, all right. I think Nimesh wants to make another point on this.
Yes,
Nimesh?
Nigel. So Rima, one point from my end. So, Rima asks us to who is basically right and wrong. Especially in case of retail investors, I guess it's just a transfer of ownership from individual to mutual funds. Ultimately, mutual fund is also, in a way direct, in a way retail only. So it's good in a sense that it's been concentrated now. Instead of one or two individual investors owning, the mutual funds are owning a big chunk of RBL Bank. And this was part of my chatter yesterday as well. For RBL Bank, the next big trigger is going to be the fundraising. Now remember, they have an enabling provision which gets over, I believe, in August end to raise up to 3,000 crores. So that fundraising is lined up. And as what even Prakash was highlighting too, there were media reports which suggest that one foreign bank, the Middle East bank, is eyeing a big stake in RBL Bank. So whether that will require an RBI approval, but nevertheless, there is a fundraising lined up in RBL Bank, and I think the board meeting is scheduled for results on 19th. So after that, there could be a potential fundraise as well. So that would be the next big trigger as far as RBL is concerned. But from a shareholding point of view, it's very clear that now it's getting concentrated within the mutual funds as well as the FPIs to a larger extent, and most of the retail investors seems to be out of RBL Bank.
Okay, got it. All right, Nimesh, thanks a lot for clarifying on that front. Well, it's only Wednesday, but Prakash, I'm coming across to you. What about a few drinks? Tilak Nagar Industries up more than 10%. Everyone's been talking, I was at a bar over the weekend, and they were saying that they're going to be having this band on Monday because the way the duties have gone up. But it seems the street, seems to be thinking that maybe the government will give some kind of a leeway, either increased, licenses or maybe larger number of timings to party. That'll be good, moving the deadline from 1 a.m. to 3 a.m. Let's see how that goes. But, a few days ago, I think on Monday, we had Allied Blenders that ran up. Today, Tilak Nagar Industries, the bulls are drunk on that. Stock up more than 10%. What's your pick from this pack?
So, Nigel, I think essentially what's happening is there's a rotation within the sector. The Maharashtra-focused players are probably something to get out of, and markets are people are looking at allocating more money to, businesses which are agnostic to the Maharashtra decisions. And you have Tilak Nagar, which gets primarily a lot of its business from the south. They are one of the biggest presence in terms of brandy. They're distributors for Old Monk, so Mansion House and all of that. And there's a lot of issues that got sorted out in terms of the brand ownership between Allied and them for some time. It's been going on. So with that clarity, you'll see some expansion in both these names in the distribution networks. But these are a bit of a flash in the pan kind of stories. They don't see sustained buying because it's yet to kind of prove itself. It's not like a Radico that moved from 130 to wherever today it is in the last 7 years. You will only find that in some opportunity, which one of them, of course, is United Spirits. But whatever drawbacks and weaknesses and triggers it has had, it's been so resilient. And my sense is that it will probably be, once the UK, India FTA starts kind of getting digested and gets into implementation mode, at these levels, it offers great risk reward. But you'll have to be extremely patient. There's nothing which is going to happen like what you're seeing in Tilak Nagar today or Allied last week. But it's going to take a while. But if you're willing to wait, it'll probably be a very robust presence in the portfolio.
Okay, all right. Well, let's focus at the bottom of your screen as well. If you wanted to buy a DLF apartment here in Mumbai, then that's your chance. They're coming out with flats of around 1,200 to 1,500 square feet approximately. And the rough cost, if I saw that correctly, was around 4.5 to around 7 crores or thereabouts. And the cost is going to be 38,000 to around 48,000 rupees per square foot. So DLF will be in focus both from a market perspective and for a client's perspective here in Mumbai. But let's talk about something related to real estate. Cement companies and South-based cement companies, well, they are firing away in today's trading session. What are the factors at play? Well, one is that the street is bracing for an improved performance in the first quarter of FY26, as in the South, we saw very, very sharp price increases. The other hope is maybe there could be some kind of consolidation, just maybe. And that explains why if you pull up this stock of Deccan Cement, the stock is up close to around 20%. So the street is speculating whether or not it's a consolidation candidate, we don't know. But let's focus on the fundamentals because that's what we are best at, right? Deccan Cement's total capacity is around 4 million tons, out of which 2.2 million tons expansion was in the works. The EV very, very roughly, at current reckoning, it's around 2,200 crores. That's putting the debt together with the market capitalization. However, analysts estimate that maybe around 400 crores of capex could yet to be incurred to get to that 4 million tons because they had a capacity of 1.8 million tons and they had 2.2 million tons that was coming on stream. So the total number will come to around 4 million tons and the rough EV will be around 2,600 crores very, very roughly, which means, the company is finding buyers or, for the stock, not for the company, at an EV per ton of around $70 to $75 on a per ton basis. The valuation is attractive in comparison to replacement cost, but for a South-based company, $75 actually is a tall ask. That said, we have a couple of large names that are going to be delivering numbers in the next few days. JK Cement, all of a sudden, they're coming out with their numbers very, very early on a Saturday itself. So we'll keep an eye out on that. Then the big boy Ultratech Cement and Dalmia Bharat. Just in the next 4-5 days, just thought I'll put an alert with regard to the results. But if there is a possible consolidation taking place in South-based companies, then maybe focus on a couple of other names as well that are trading at a very sharp discount in comparison to replacement cost. Case in point being a Sagar Cement. You pull up the chart, you'll see it's been buzzing all through the trading session. NCL Industries, small asset as well over there. That one, in fact, is trading at around $45 to around $50 on a per ton basis. But the one that has an immense value is KCP. I'll tell you why. Because the total EV is at around 2,100 crores. That's netted of the cash of around 500 crores that they have. The cement capacity that they have is around 4.3 million tons and they have adequate limestones for the next many, many years. So in case they want to expand, they have that. They also have a sugar business in which the listed entity holds close to around 67% stake. That's in KCP Vietnam Industries. So we can't do a vanilla EV per ton out here. But if you only value the total EV and take into account the 4.3 million tons capacity, then the asset is at around $60 per ton, which means effectively that you're getting the sugar business free. So that one, in fact, as well is buzzing. You pull up the intraday chart of all these stocks. Deccan has jumped up. We'll have to see what exactly is the reason for that. But it seems, all these names, all through the trading session, there is that speculation that maybe, in fact, there could be further consolidation. We don't know about that. But fundamentally, we thought we'll explain to you what's going on out there. And also, these quarters' results will be very, very good. So let's see how that goes. Prakash, what is your take? Some of these companies, they've had value for very, very long. KCP, Sagar Cement, Deccan Cement, I've heard it many times actually in the last many years. But the street is speculating maybe that's, this time around is going to take place. And in the recent past, whether you look at Orient or you look at the other assets as well, Kesoram, deals that we saw didn't take place in the previous 10 years. Suddenly, they've taken place in the last 12 to around 18 months. So what's your view on the South-based companies?
No, I mean, thanks for making it so interesting. In fact, the next week or so, till the numbers start coming through, I think this is going to be a center of attraction of sorts, because it's one pocket that probably is close to the bottoming out of the cycle. Okay, post-monsoon, I don't think cement companies will be talked about in the same breath as what they're being talked about now, because they've been a bit of sideways movers, but things are looking very different from whatever updates that we are getting, whether it's pricing potential, whether it's capacities, cost control, all of that. So I think it's a wonderful space to allocate more capital to if you don't have it yet. The names that you mentioned, we've discussed Sagar sometime back, about a year plus back, and then Deccan just about a month back, and it's also rallied from there. The problem is that consolidation in the south has been a bit tricky because you have very small assets. Unlike assets in the north and the east, where some of the larger acquisitions have really been very, very fruitful. So if you're adding 4.5 tons, it's not empty. It's not something which is very dramatic for anybody. But consolidation is the need of the hour if you want to really build scale and efficiency, right? So the larger players will have to continue fighting each other out in terms of that metric and bring their overall efficiencies higher and the cost lower. From that perspective, they continue to be suitors, but I really don't know whether pricing is conducive at this point in time. Especially Deccan doesn't really have much in terms of your pricing power or distribution or anything beyond this capacity expansion that's happened after so many years. So I would still go with the larger players. I would go with the acquirers rather than the being acquired names. And from that perspective, ACC continues to be Sri Cement, continues to offer tremendous opportunity from where they are in terms of organic growth purely. So I have a slightly different view. It's more cautious, more low on risk reward, but I'm fine with that.
All right, got it. Prakash, what would you make? What if someone is buying this Deccan Cement, and we don't have, it's a very, very grey picture. We don't have the proper details. We don't even know how much more capex they need to incur. We've just taken a ballpark 400 crores. Suppose there's an acquirer at $75 per ton. What would you think? Will they be overpaying? Because there's plenty of capacity in South India. Utilization levels are, very, very low. Pricing has improved, which is good, but still utilization levels very, very low.
No, absolutely. So, if you and you very rightly mentioned KCB, which comes with, a very high support or comfort of raw material supplies. Now, what happens is the moment you look at a KCB, it's always been muddled or a bit of a mixed bag because of the sugar business also coming along. If they were to demerge the two, the cement business could definitely fetch much more value beyond that $60 per ton. So, I'm not sure whether they're willing to pay, they're willing to sell at this level or this point in time. But if that was available, I think it makes for far better economic sense and then hive off the sugar business at some point in time at an opportune moment whenever you get that. So I would believe that Deccan, there could be some other reason why it's probably being, it's seeing that action. But I don't think it's just a pure acquisition play at work at this point in time.
Yeah, and we've heard that in the past as well. Just in the last 1 month, the stock is up 50%. But we are here to explain the fundamentals to our viewers. And Prakash, thanks a lot for analyzing that for us. As you said, you need to be a little bit cautious on the smaller names, whether or not there's a deal or not. But he'll be preferring the larger cap names that are trading at decent valuations. Appreciate you joining in, Prakash. Thanks a lot for that. Well, also, as we slip into that break, remember to tune into our all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m., the Big C, where we focus on currencies, commodities, and cryptos, and the Global Lens at 8:30 p.m. Welcome back. You're tuned into Closing Bell here on CNBC TV18. Well, as promised, let's get chatting with Pramod Gubi, co-founder of Marcellus Investment Managers, who joins us on the show. Hi, Pramod. Good to speak to you after a while. How are you all feeling about the markets? You know, as of now, things are looking pretty okay. We have inflation that's cooled off, and people are quite excited about that, you know, because it's only around, I think it's the lowest we've seen in the last 6 years or so. However, part of the street is a little bit concerned, because the nominal GDP will not even be 10%. And that's after many, many years. You know, you put together 6.5% growth with 2% inflation or thereabouts. We're falling short out there. What's your take on the markets? Do you believe that in the near term there could be some kind of problems because urban demand is not picking up? Or do you believe the RBI is growth focused? Things are going to recover in the second half of the year. So this is the start of the next leg of the up move.
Yep. Thanks for having me here. Like we've been saying over the last few quarters, I think we're coming off a period of pretty strong growth, driven by government capex and the consumer spending post-COVID. At some stage, both of these drivers had to cool off. I think the government is clearly on the fiscal consolidation path, although the first 2 months of this fiscal public capex has been strong. But I think going by government tax collections, that has only so much upside and perhaps could even cool off going ahead. The consumer piece as well is cyclical. Part of it is cyclical. You had a revenge spending boom. At some stage that had to cool off. In fact, the revenge spending was accentuated by retail borrowing. Most banks were flush with funds. They supported personal loans, microfinance, which accentuated that boom. That had to cool off as well. We are in the middle of that cool down. But there's a small element of a structural issue around job creation and recovery in consumption, given automation and AI is pervading all aspects of life. And company after company we speak to are talking about being skeptical of hiring. That's a big structural issue to be concerned about. Hopefully, we'll figure out other avenues to create jobs. For example, manufacturing is picking up, but that remains a concern. That also means that this slowdown and drop in inflation is expected, right? The inflation has dropped because naturally demand situation is cooled off quite significantly. At the same time, companies or corporates' pricing power is also cooled off significantly. So it's the other side of the demand cool off, which is the lower inflation. That also means that the RBI has a little more leeway in terms of loosening monetary policy, either by pumping in more liquidity, which is done quite a bit already, or cutting rates perhaps in the August round as well. Now, these effects will not by itself translate to demand creation. Maybe at the margin, certain projects become more viable because the cost of funding comes down. Hopefully towards the second half, we can see that come through. But we'll also need some uncertainty driven by the whole trade and tariffs things to go away for corporates to feel comfortable and start spending, both export demand as well as domestic demand. That is anybody's guess as of now. So for now, I reckon the market situation will be driven by a fairly modest demand environment, with a lot of hope in terms of monetary policy triggering a recovery. That will also mean that earnings slowdown that we've been through over the last 4 quarters is likely to sustain at least for the next couple of quarters, which in the midst of where market valuations are, I reckon investors should be prepared for muted returns going forward, unless and until we see either a sharp correction or a recovery in the demand situation.
So how would you play all this, Pramod? The stress in the job market, tech companies are already, sort of flashing warning signs, no wage hikes. Hiring has slowed down. They're only doing specialized hiring. What about tech? If consumption is going to get hurt, because there is that ripple effect, as you spoke about, so till we get, and RBI has also sort of front-loaded the rate cuts. How do you play this in terms of an investment theme now, this muted phase return?
Like I said, for investors, the best approach is through asset allocation. At the end of the day, you have real, tangible financial goals, and you get your asset allocation right in terms of equities, fixed income, gold, and real estate. And within that, you get your allocation to large caps and small caps, quality versus value, and be systematic about rebalancing about this. As far as we are concerned as asset allocators, as asset managers, we're at the end of the day trying to position ourselves to give our clients better returns than what the index would give, which is their opportunity cost, by buying into a low-cost index fund so that we justify our fees. From that perspective, we are less concerned about the absolute returns in the market, right? Given we've got, 25% returns from the market in the last 4-5 years, that's unlikely to repeat. In fact, the next 5-year returns will be significantly below average, the long-term average for the Nifty being 12%. I reckon if the market gives 10%, to beat the market, you need to be positioned to give 12-13% on a post-fee basis. There'll always be opportunities from that perspective. So if you're relatively positioned to do better than the market, but at the same time being realistic about absolute returns, I think there are still opportunities in the market. Private banks, for example, is an opportunity where we think that while growth may not be significant, we reckon on a 5-year basis, you might still get 15% earnings growth. But at least valuations are reasonable. I won't say compelling or attractive, but compared to several other pockets of the market, they are not giving you potential downside risk from a derating perspective. So pockets like that do exist if you do manage your expectations in terms of absolute returns.
Pramod, how are you all feeling about the pain space? That's been a big pain point. Pains has been a pain point. But some believe that deal that was long awaited, that's out of the way. It's not a new player that's taken that stake in AkzoNobel. And maybe, India is bound to recover in the second half of the year. All that, the better prices will play out, discounts could hopefully go away, and things will look up. Are you in that camp?
Absolutely. I think the pain in the pain space that you're alluding to happened together because of both reasons coming, which is the macro slowdown in demand. Overall paint demand hasn't been this weak ever in India's history. I'm talking about decorative paints. At the same time, you saw competitive intensity coming up with a large new player coming in. Hopefully, like you mentioned, with the rate cuts playing through, there is a pickup in housing, and therefore paint demand recovers, at least from a statistical base effect perspective at some stage through the next 12 to 18 months, demand should recover. And we've seen the capital cycle play out. From a competitive intensity perspective, we've seen an exit of an existing player. And that capacity is bought in by an existing player as well. So to that extent, we're seeing competitive intensity actually get more benign compared to what we've seen in the last 3 years. So both demand recovering and competitive intensity becoming more stable, I would reckon the next 3 years should look good for paint companies, both in terms of growth and margins.
Thank you, Pramod, for joining in and providing that insight. Time to get into a break. But before that, let's talk about Network 18, because that's rallying post the Q1 numbers. Margins have improved for the company, even as viewership share has risen too in the quarter. It's been a tough quarter. Listen in to what the company's managing director, Rahul Joshi, had to say about the performance in the road ahead.
If you look at the last 2 quarters, they have been incredibly tough for the media industry. The operating business environment has been soft. Clients are not spending as they used to. That earnings have been under pressure. I don't need to tell you all of that. In this environment, we have managed to post a 5% dip in revenues. That has to be seen in the context that in the first quarter of last year, it was an exceptional quarter because of election results. It was a bumper quarter for us. So if you were to compare it from the quarter before that, we have grown a healthy 9%. But from last year, it is a dip of 5%. But at the same time, we have kept a tight, very sharp eye on costs. We've been able to control costs considerably. So that is what has reflected in this somewhat improved margins. So I'm very happy with the operating team's performance this quarter. I think it was a tough quarter in which they really came out tops. I think that, in this first quarter, we are EBITDA positive. If we look at the next 3 quarters, I'm hoping that, the overall outlook will improve as we head towards the festive season. I am hopeful that since our channels and our digital properties are all in commanding leadership positions, we will be able to not only drive revenue, but we will keep costs under control in our existing businesses. Costs are mildly likely to go up only in our new investments. maybe in areas like First Post or in money control. So overall, I am hopeful that, the next 3 quarters would be better. We are seeing some green shoots, but early days, I would say. July is looking slightly better. I wouldn't be very excited yet. But I think as we hit the festive season, I think we will see some impact on, higher revenues. And you have to see it in the perspective that we are the #1 media company, broadcaster, news broadcaster and digital media company. We have a commanding position in the market. All our channels are #1 by a wide margin. We've only increased the gap with our #2 player, whether it is our news channels or it is our digital property. So much so that News 18, for instance, has beaten the Times of India, in the recent ComScore numbers. So that gives us a lot of reason to cheer, and that gives us also a lot of hope for the future.
Welcome back. Well, let's get straight to our favorite segment, D-Street Chatter, where Nimesh will get an insight into dealing room. What is he picking up? Nimesh, take it away. Tell us.
Hi, Nigel. Another flat day in the index, but there are a lot of opportunities, or for that matter, a lot of mid-caps and the small-cap stocks have been buzzing and outperforming in the last couple of days, and so is the case today as well. From a flow perspective, I've been saying for the last few days that there is buying the PSU names, and within that, the PSU bank stocks is where there is a lot of FI interest and local interest as well. So that's one space which is well bid. Again, in today's market, overall in general, banks have done well and have relatively outperformed in today's market. Technically, 25,500 is a level to watch on the upside. But the next big trigger seems to be a lot of M&A transaction is what the market is anticipating, and there is a lot of buzz as well in terms of a lot of M&A picking up. So that's something to watch out apart from the earnings. But broadly, it's flat on the Nifty, but there is a lot of outperformance in the broader market names again today.
Okay, all right. Let's get to individual stocks then. What are you picking up, Nimesh?
Well, the first stock on my list, Nigel, today is Edelweiss. That's been buzzing in trade today, up 5-6% last I checked. The volumes also are on the higher side. I understand there could be a large block in Edelweiss very soon, so that's something to track there. So that's the first name. The second stock is Patanjali. It's a little low liquid stock, but big move on that name. It's part of the FNO now. It's up 7%. Essentially, the stock is going up because I understand the selling pressure from one leading domestic AIF is largely over. That AIF was a seller because there is a change of guard at the fund management level, and hence you've seen a bit of churn there. So that's completely sold out, is what I understand in Patanjali. So that's the second stock. The third stock is BPCL. Well, HPCL is buzzing in trade today. From a flow perspective, it's BPCL where there is very strong delivery-based buying from large institutions. In fact, a very large long-only fund seems to be an active buyer in BPCL of the last few days, and today is the case as well. So I expect high delivery volumes there. And the last one is Dynamics Technologies. It's been consolidating in a narrow range of late, but I understand even there could be a large block. A potential clean-out is very likely in Dynamics Technologies very soon.
Thank you very much for that interesting list as always. Counting down to the market close, 15 minutes to go, and the Nifty is absolutely unchanged. 25,200 on the index. Mitesh is back with us for a few BTST calls. Mitesh?
Patanjali features on my list as well. Buy here with a stop at 1835 for targets of 1880. And Tata Power is the other one. That's also near the day's high. Just a bit off. So Tata Power, I would recommend taking a BTST position with a stop at about 411 for targets of 419.
By the way, IT is going into the next set of results with a fair degree of optimism. The Nifty IT index is up more than about 0.5%. That will come up for you on your screen. Not at the day's high, but virtually there. But look at a Wipro, look at a Tech Mahindra. So right on top, Tech Mahindra should be on your radar because it reports numbers post-market hours. Again, not expected to be a great quarter. In fact, for Tech Mahindra, it would be the second consecutive quarter of a revenue decline. Constant currency revenue is likely to fall by 0.7%. But here, the story in Tech Mahindra is that of turnaround on the top line and even on the margins. And margin recovery is, the low-hanging fruit. So margins have been on an uptick for the last couple of quarters. It would have bottomed out in Q2 of FY24. That's about 7 quarters back when margins went down to 4.7%. It's not showing in the trend chart, but the low was 4.7%. And since then, margins have been steadily recovering. And this quarter, we're anticipating 10.9%. Profits, according to our poll, should be 1,170. So the key is that is Tech Mahindra, on the right path of turnaround? Is that, bearing fruit? Is that progressing well? Because the company wants to hit 15% margins by FY27 and achieve industry-leading revenue growth. So all signs which help the company achieve that goal will be tracked very closely this time.
Okay, all right. Got that, Rima. Thanks a lot for that. Well, let's welcome Sid Khemka from Motilal Oswal Financial Services who joins us on the show. Sid, how are you feeling about tech? Rima's companies have given us a couple of howlers, but that dip is getting bought into. The bullish argument is they're trading at a discount to some of those, the 5-year, 10-year PAs. You'll get some yield out there. And hopefully, in the coming quarters, things pick up. You want to buy that argument or you want to say, no, too much of uncertainty. Rather wait, buy. When the time is right, that time you'll get in. Your take?
Good afternoon, Nigel. Yeah, I think if you look at the entire IT pack, we have been hearing the uncertainty for last couple of quarters. So I think market is no longer buying into that logic. Some of the companies have definitely upgraded the lower end of their revenue growth guidance. So that also gives confidence that the downside is limited from here on. And as you rightly said, valuations are trading at a discount to to their respective 10-year averages. So within that, you cannot put the same paintbrush across the sector. Definitely, you'll have to pick and choose companies with a much more diversified business model, companies which have invested into the new age businesses, digital, Gen AI, where they are likely to reap those investment benefits in the next couple of quarters. So I think if you look at even Q4, TCS and Wipro painted a weak picture, bearing that some of the others showed some signs of strength in the sense that they were expecting some recovery. I think once the tariff trauma goes away, whenever that happens, IT will be a sector which will see significant buying interest. Yes, near term, number-wise, I think one more quarter of weakness could be there, but from Q2 onwards, I think the earnings growth recovery will happen. Some of the stocks we like, HCL Tech, we believe a very diversified business portfolio growth is there, and I think valuations are comfortable at 22 times on a one-year forward P. Definitely growth improving, valuations should pick up, so that's the top pick within the large caps. Within the mid-cap space, I think earnings growth continues to be pretty strong, both Coforge as well as Persistent. We are forecasting about 20-23% CAGR earnings growth over the next 2 years. Valuations a bit high, but for the growth that they are delivering, I think we are expecting another 20-25% upside in both these stocks. So prefer to be with tier 2 players like Coforge, which is our top pick, followed by Persistent. Their investments in Gen AI, digital, and the next gen business segments are proving to be more defensive in this environment.
Vishal Mega Mart, that's a story that you'll like. It listed last year. The issue price was 78. The stock is up 80% from that level. It hit a fresh high today of 140. But you see more upside even from these levels.
Yeah, Rima, I think if you look at Vishal Mega Mart in that value retailing segment has consistently done well. Market has rewarded them amply, and we just initiated coverage today. Definitely, we are looking at a 25% earnings CAGR over the next 2 years. The company is a unique retailer with strong presence in the tier 2 cities, well-diversified exposure to some of the key consumption baskets, and a key differentiating factor that apparel forms about 44%, which are generally a higher margin compared to your staples or your perishable goods. So that gives a strong foothold in overall business. It provides unique moat in terms of competition to both online as well as offline stores, given its presence across India, especially in the tier 2, tier 3 towns. And the balance sheet continues to remain strong, debt-free balance sheet, robust cost control, and hence we believe that even at current valuations, we believe with this kind of growth, there could be further upside to the stock.
Siddharth, do stay on. We just want to quickly talk about PVR. PVR share price is down 1.5% today. And these stocks are in focus because remember the Karnataka government has issued a draft notification whereby they plan to cap ticket prices at 200 rupees per show across the state. Now, we spoke to Karan Taurani, EVP at Elara Capital on this, and his view is that while the revenue, if it gets implemented, while the revenue and margin impact, EBITDA impact may be 2 to 3%, it could result in derating. And Karnataka does account for about 12% of the overall pan-India revenues. Listen in to his views. We'll come back after the short break.
PVR Inox has got a reasonable amount of exposure in Karnataka as a state, largely because of Bangalore being a metro city. If you look at the screen share, around 12 to 13% of the screens are in the state of Karnataka. And if you look at the overall box office market in terms of revenues, if you put regional Hindi languages put together, it is anywhere in the range of 10 to 12% of box office revenue coming from there. So I think this news will definitely have a negative impact on the overall ATP for PVR Inox. And in terms of EBITDA, you could see a downgrade of anywhere in the range of 2 to 3%. I think exhibitors will try to lobby hard for this move not to happen. Now, in the past, when it happened, they had gone to the court and appealed. And that time around, this order was rolled back. This was, I think, in 2017.
Welcome back. So markets look like ending flat. We did recover from our early losses, but we gave up those gains towards the close of trade. So the Nifty is ending at that 25,200 mark. So that ITC Hotels, pretty good set of numbers. The stock is up nearly 5% as we speak, 15-16% top line growth, but the bottom line has come higher by 54%, aided by a higher other income. Any thoughts on this entire hotel space and in this Juniper, Samhi, Lemon Tree, Chalet? Which ones would be your, or even an ITC, your preferred bet would be?
Definitely, I think, Rima, if you look at the entire hotels or the tourism space, I think they have been consistently doing well last couple of years. Even Q1, I think, where you have the summer vacation, a lot of domestic travel has happened. So Q2 is where you have a lean period, and then again you start with the festive season, so travel will again boom, and the sector should benefit. Overall, what we have seen is that the supply has been limited, and that has led to improvement in both average occupancy, average room rates. Both have gone up. Costs have remained under control. So the entire sector has definitely benefited. We have two hotels in under coverage. One is Indian Hotel, which is the market leader in India. I continue to like it in the premium segment. That's the best play to look at from a Indian hotel sector. In the tier 2, or you can say the mid tier space, we like Lemon Tree, very focused on the business travel as well as tier 2, tier 3 towns where they are consistently expanding and looking at newer. So religious tourism has been the new trend there. They have added a lot of new properties, and what they have done is that these newer properties are mostly taken on an asset-light lease model or a revenue share model where your growth comes by without putting much of a stress on balance sheet. So I think the overall sector looks good. ITC results are pretty strong, and that should have a positive impact on the other hotel sector stocks as well. So as I said, we like Lemon Tree, which we have a buy rating and a target price of 185. We even like Indian Hotels, where we have a target price of 900.
Okay, what about the cement pack? That's catching everyone's attention today. Deal or no deal, we don't know. But things are looking up, at least in the interim. What's your take out there?
Nigel, if you look at again from a quarterly perspective, cement sector has kind of remained a pretty strong resilience in this environment. Q-on-Q prices have gone up about 5%. Demand remains pretty strong. Raw material prices as well as fuel cost has remained benign. So overall, expect strong volume growth of about 10% for the industry, with the realizations also being strong. We believe EBITDA per ton is likely to improve for the entire space. Yes, monsoon season little lackluster, but once the monsoon season ends, I think most of the players are likely to take even further price hikes that should be profitable. We have also seen that government capex in April, May has been front-loaded and have seen strong growth. That is also supporting the demand. So we remain very positive on the cement space. Ultratech within the large cap space and JK Cement in the mid cap space are our preferred bets within there. Some of the other stocks that we like is Dalmia Bharat. We believe that can be a tactical play given the lower or a comfortable valuation and strong earnings growth over in FY26.
Thank you very much for joining in. It's an absolutely flat close. 0 points on the Nifty. That's the final tick, ending below the 25,200 mark. Metals and defense dragged. Pharma index also ending in the red, a cut of nearly about 0.4%. But on the way up, PSU banks led the rally. IT supportive. Auto realty also gaining some traction. In individual stocks, the top gainer is M&M today, crossed the 50-day moving average after it rallied 2.5%. Wipro, Tech Mahindra, the two IT companies yet to report numbers this week, ended with gains of nearly about 2.5%. Wipro up more than 2. SBI in the back of that fundraise. DLF plans to enter the Mumbai market. Their launch is tomorrow, and stock ending up nearly 1.5%. On the way down, Shriram Finance, Eternal, Sun Pharma, Cipla, Tata Steel were some of the stocks with cuts of more than 1%.
Well, that's right. From the broader markets, Tilaknagar Industries, that was dancing away a little bit high, I think, for the bulls. That stock was up more than 10%. So solid move is what we saw on that one. Coffee Day, the other end of the spectrum, that stock as well was up close to 10%. A couple of influential names appeared in the shareholding pattern, I think. So explains why Coffee Day, in fact, was higher as well. Tilaknagar Industries, Coffee Day, Vascon, EPC player that's now entered the Mumbai market as a redevelopment, as a real estate player. And they've seen some traction on ground in various parts of the suburb. So Vascon as well in the last few days, well, that's moved very, very well. Big delivery-based buying as well. DLF will be coming to Mumbai and they'll be opening up for bookings. So the street did like that as well. So quite a few movers and shakers from the broader markets, though the Nifty ends more or less flattish for today. But on that note, we'll wrap up on this edition of Closing Bell. You don't go anywhere. Markets Forward comes up next.
Markets end near the flat line after a range-bound session. The Nifty manages to hold levels of 25,200. Banks lend support with PSU banks taking the lead while metals and pharma decline.
HDFC Bank gains after its board says it will consider issuing bonus shares on the declaration of a special dividend on July. SBI soars as it's expected to launch its 25,000 crore QIP today. Sources say that it is likely to be at a small discount to the current market price.
PVR Inox under pressure after the Karnataka government issues a draft notification capping rates at theatres and multiplexes at 200 rupees per ticket. ICICI Lombard, ICICI Prudential Life Insurance under pressure after reporting Q1 numbers. HDFC Life flattened trade.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is Rima Tendulkar. Well, it turned out to be a session where we did see just about a range-bound session. We ended absolutely flat in today's trading session, but the banks did support.
Banks were supportive, IT was not bad, but on the whole, markets ended absolutely flat. You pull up that intraday chart from the low of 1230, we managed a recovery of close to about 100 odd points plus from the day's low. But just towards the end of trade, those gains moderated. And by the end of it, the Nifty closed absolutely unchanged, above the 25,200 mark, but no gains to boot for itself. So 16 points up on the Nifty, Sensex up 63 points at 82,634. Mid caps and small caps, which had a good run over the last 2 days, also consolidated today. That said, the mid cap index is still up 1.6% so far this week. Advanced decline ratio positive. Well, on the way up, as I said, broadly, it was a lot about the auto names. Auto names did well. You had PSU banks, that was the leader. IT names higher. The Nifty IT index ending with a gain of about 0.5%. Though individual stocks like a TCS did close in the red, but you had strength in Tech Mahindra, Wipro. And on the way down, also cuts in metals, pharma, a couple of defense stocks. These were the laggards today.
Okay, yes, absolutely. Well, maybe we are still waiting and watching and seeing what could possibly take place, when it comes to the tariffs from the US for India. That's probably one of the biggest variables. But let's also tell you what we have lined up in this on the show for you. We'll start with the top movers and shakers of the day with Vivek. A slew of stocks was surging in trade. SBI gained following the bank's 25,000 crore QIP announcement. Dixon Technologies also saw an uptick after the firm announced its 51% stake acquisition of Q-Tech, while Biocon gained momentum post-approval of its diabetes drug Kirsty by the US drug regulator. Last but not least, we delve into the key market events to watch out for in tomorrow's trading session. All right, well, let's get to our first segment of the day. Vivek now joins in from the wall with all of the top movers and shakers for today. Vivek.
Well, thank you so much for that. Another session where in the broader end of the market, you did see the advance go ahead and outpace the declines. Quite a lot of movers in today's trading session. And the biggest set of gainers today was actually the PSU banking index. And all of the PSU banks did very well in the session. SBI, of course, in focus, the likely announcement of the QIP. But along with that, the whole host of other PSU banks doing quite well on the back of hopes that there could be a hike as far as FDI ownership within the PSU banking space is concerned. The next stock in focus has to be one from the pharma space. Biocon, very important approval coming in there from the US FDA. And on the back of that, the stock opened up significantly higher, cooled off a little bit towards the end of the session. Dixon, again, the street was really enthused by the fact that the company has made an EPS accretive acquisition and also the announcement of an important JV. Network 80, now this particular stock from the broad end of the markets, very strong results, good volumes throughout the trading session, the top NSE 500 gainer. And Patanjali, this particular stock continues to move higher. It's a gain for almost all of the trading sessions of this particular week, higher by 6.5%, top mid-cap gainer in the session. Amongst the laggards, HDB Financial stands out. Weak asset quality is something that the street did not like, almost 3% lower on that name. Newland Labs today, after a strong run-up, saw a bit of a sell-off today, profit booking in that particular stock. Just Dial, while the results were okay, weak collections growth is something that the street didn't like, almost 5% lower over there. And lastly, ICICI Prudential downgrades coming in as far as EPS is concerned post Q1, and that stock ended lower by almost 3% today.
Thank you very much for that. Let me welcome Shrikant Chauhan, EVP at Kotak Securities on the show, and Siddharth Khemka of Motilal Oswal Financial Services has also been with us. Shrikant, let me start with you. I mean, how does one find any sort of a direction, trend? What do you do with the Nifty? And what's the expectation over the near term?
Good afternoon, Rima. Good afternoon, Pooja and Siddharth. Well, for Nifty, it is in the range. It is finding difficulties to cross the level of 25,300, 25,350, where it has resistance of moving averages. But if we consider the entire setup of the market, then at 25,000, the market is having excellent support. And today's formation is suggesting us that we are heading towards this weekly expiry. If we consider option statistics, then based on that also, today we saw a good amount of put writing at 25,200. So based on overall setup of the market, I am of the view that market is going to surpass its immediate resistance of 25,300, 350. And eventually, maybe in next 1 or 2 days of time, we may even see the levels of 25,600 again. Even if we consider Bank Nifty, there also we saw a good amount of buying interest. And in fact, Bank Nifty is on the verge of breakout. So there we may see some more action in the near term. That's my view, because State Bank was doing well today. And even if we consider other banks like HDFC Bank and ICICI Bank, they also participated in the overall move of the market. So broadly, I am of the view that we should look for taking some contra bets of going long if there is any correction in the market.
Okay, all right. Well, Shrikant, welcome to the show. What's your sense in terms of how we close today? Absolutely flat, no real direction.
So, see, like based on the closing of the market, we may see some maybe early weakness tomorrow. But because it's a expiry day and today we saw good amount of put writing, we are of the view that if there is any lower opening, there we should look for taking contra bets. Eventually, we are going to see the levels of 25,500 or 25,600. But we need to focus more on banks this time because PSU banks are participating and private banks are at their important resistance level. So in case if there is any furthermore buying interest in the market, we may see the market crossing its previous immediate highest level of 25,600.
Got that. Let's talk about the PSU banks, and right on top of State Bank of India. This is after sources indicate that the bank would launch its 25,000 crore QIP as early as today. What we've also learned is that they're likely to offer a slight discount. Vivek is joining in with the details.
Well, when you're looking at SBI, the company had indicated, or the bank had indicated, and had taken an approval from the board to go ahead and raise up to almost 25,000 crores. In fact, our colleague Ritu also had indicated at the end of last month that the company had gone ahead and appointed 5 investment bankers for this particular issue. What we understand from our sources is that most likely SBI would be launching the QIP to raise close to 25,000 crore rupees. Now, what we understand is that, number one, there's going to be a 3 to 4% discount at max for this particular QIP. Demand has been quite strong. In fact, we also understand that LIC has already gone ahead and given its interest or placed its interest to bid for more than 5,000 crore rupees out of this large QIP. We also understand that domestic mutual funds have indicated very strong interest. We also understand that this particular QIP, post which the company would be looking to go ahead and augment its capital base, and that would be one of the main reasons for the fundraise. It will be the first QIP from SBI since 2017. So the first share sale from SBI since 2017. So it's an important trigger, especially as far as this particular space is concerned. We reached out to both SBI as well as LIC for their comments. They are yet to respond to our queries.
Okay, all right. Thanks, Vivek, for that. So that's on State Bank of India. Siddharth, any views on SBI?
Yeah, good afternoon, Ekta. Good afternoon, Rima, and good afternoon. So I think if you look at last few years, SBI has seen strong growth in an impressive 37% earnings CAGR in the last 4 years. FY25 has been phenomenal in terms of growth. They've crossed 70,000 crores in profit. And if you see, they have maintained a leadership in the digital banking, almost 88 million users. So I think it was a good time for them to look at capital raise. In FY25, again, the loan book grew at about 12%. And we are expecting about 12-13% credit growth in FY26 with a credit pipeline of 3.4 lakh crore. So overall, I think we have a positive view. Valuations are comfortable compared to some of the private players. While the overall earnings for the banking stocks are likely to a little bit subdued in Q1. I think as we progress during the year, earnings would pick up. Good part is that deposits growth have started doing well for the industry, and that is a good part for bringing down the costs for the large banks, especially the likes of ICICI, SBI. So we are seeing a good ROA of about 2%, ROEs of 16%, and as I said, valuations are comfortable. We have a positive view and a buy rating on SBI. We have a target price of 925.
925 on SBI. Let's talk about Dixon, that gained nearly 2% after the company said it's all set to acquire 51% stake in QTech India through a primary and secondary investment. Vinny joins in with the details.
Hi, Rima. Yes, so we are seeing a couple of news flows. One is that 51% stake that they're acquiring in QTech, which is a company that is making camera module. So they are suppliers for these camera module. Now, when you look at QTech, they're among the top 5 globally, and India, they're the largest supplier. So positive coming in there because this further value adds to their smartphone backward integration that the company has been focusing on in the last year as well. So positive on that front. Other than that, the company has also signed a JV with Chong Qing UI, which is a precision component manufacturer. In this JV, 74% is Dixon Tech and 26% is the other company. Now, what is precision component manufacturing? So they make these components which are used for laptops, mobile phones, automobiles is what they use as well, automotive applications. So a lot of segments of Dixon get covered here as well. Again, one more part that comes into their backward integration. Now, on the back of this, brokerages are giving it a thumbs up. Whether you look at CLSA, JP Morgan or Nomura, all of them have given it a thumbs up. CLSA is highlighting, that given this addition, this will help margins improve going forward by 150 to 200 basis points. Also will provide an additional revenue stream to the company. JP Morgan too is highlighting that this is a positive there in terms of revenue as well, and they expect the revenues to start coming in terms of synergies in the second half of FY26. So for FY26, they're expecting the revenue could increase by around 2% and FY27 by around 3 to 4%, and increase means additional revenue is what we could expect here, and positive move coming in on the stock on that front.
Okay, all right. That's on Dixon Technologies. Thanks very much for that, Vinny. Well, Siddharth, views on Dixon Technologies?
So definitely, I think EMS is one segment which has been consistently pretty strong numbers, and even Q1 will see that. And within the pack, Dixon is likely to report the highest revenue growth of 80%, followed by the others of the likes of Keynes, Data Pattern, and Cyan DLM. But definitely, what the strategy for Dixon has been that they are actively pursuing partnerships across segment to not only boost volumes but also to improve margins. And as we saw today's tie-up there, they are backward integrating into this into the technology and climbing up the value chain. So that only leads to growth avenues, but also, as I said, profitability growth. So very positive view there on Dixon. Expect strong earnings in Q1 as well. Have a positive view and a target price of 20,000, a strong upside for even from current levels.
Okay, got that. Shrikant, a quick word on Dixon, Amber, any in this EMS space?
We like both these stocks. We are specifically bullish on Amber. We also like Dixon, but currently it is very close to its resistance level. And in the month of April 2024, the stock was very close to 17,000 levels. So there the stock is having good amount of resistance. I am also expecting upward activity, but we are expecting gradual upward activity and it will take some more time. So eventually, again, it will come back to the levels of 18,000, 18,500, but it will take time. So if there is any correction, then there we should look for taking long bet on the particular stock. We also like Amber, and there also we are of the view that it is very close to its immediate resistance level. But eventually, I think the stock is heading for the levels of 8,500. So it will take again some time. Again, the strategy should be to buy on dips.
Okay, all right. Well, one stock which I was looking at was Biocon, which was in focus in today's trading session. That is because they've received US FDA approval for insulin aspart, which is basically this biosimilar version of Novolog, a drug, a biologic drug in the US markets. Now, the size itself is expected to be around $1 billion, and Biocon could actually benefit quite significantly from it, considering that there are not many players which are left in the insulin market, or that's becoming a space which is opening up a little bit because of the different type of diabetes drugs which are entering the landscape. So Biocon could probably, on a conservative estimate, make around $100 million, and that could go up to around $300 million if in case the entire competitive dynamics really do benefit them. But let's get Siddharth's view on this. Siddharth, any view on Biocon, and how exactly could they benefit from another launch in the biologic space, and that too in the insulin space now?
Yeah, I think Biocon has been now getting a lot of approvals, not only for the plant. So the US FDA sometime back approved the Malaysian plant. We believe that that was a big trigger because a lot of product pipelines are there from that plant that are going to come up. And with US FDA approving Biocon's biosimilar Christie, I think it's a big positive for not only Biocon, because it gives us a big support to its player Novolog, where they were facing some of the product shortages, especially for the insulin drug, with the production capacities as the Novo Nordisk towards the other potential, where they're shifting the capacity to other potential drugs like Ozempic and Wegovy. So I think once Biocon takes the product into formulae, I think there we can expect, as you rightly said, about $100 million of annual sales with an upside potential of somewhere between 200, 300. That could be the potential product. Overall, we are seeing that a lot of product already approvals that have taken with the rising global demand for insulin and especially with the biologics leadership that Biocon has shown. That is only expected to improve the overall profitability going forward. We see strong earnings growth in Biocon, and FY26 we are seeing a strong earnings growth in excess of 100%. So see huge upside potential for Biocon next few years.
Okay, let's quickly get a recap of all the insurance numbers that have come through. We had numbers from HDFC Life, ICICI Lombard and Pru. Yash joins in with the review.
Well, so of course, 2 life insurance companies and 1 general insurance company has reported its first quarter numbers so far. The 2 life insurance companies include HDFC Life as well as ICICI Prudential Life Insurance. The numbers, quite different from each other, quite divergent in that sense. ICICI Lombard numbers are very strong. To speak about specific numbers, for HDFC Life Insurance, a new business premium that missed CNBC-TV18's poll but managed to grow by about 11%. Total APE or annualized premium equivalent, that was a beat as compared to CNBC-TV18 poll, growing by 13%. Retail APE was a beat to CNBC-TV18 poll, growing by 13%. Value of new business, again a beat to CNBC-TV18 poll, up by 13%. And margins, they were flat at 25.1%. Largely, except for the margin performance, the numbers were quite decent for HDFC Life. But the problem really came as far as the management commentary itself is concerned. Vibha Padalkar, the MD and CEO of the company, told CNBC-TV18 that she expects FY26 growth to be lower than last year, that is FY25. She expects second quarter to have sluggish growth, and this is largely because of the drop in consumption and the macroeconomic situation. She expects FY26 APE growth to be between 16 to 18% as compared to 18% in FY25. ICICI Prudential Life Insurance, the numbers were largely in line to a beat as far as poll is concerned. New business premium came in line, growing at 6%. Total APE, that was also in line, but that on a year-on-year basis saw a contraction of 5%. Value of new business saw a contraction of 3%, and margins, they were up by 50 basis points at 24.5%, and also a beat to what the street was working with. ICICI Pru Life Management in their earnings call said that they aim to achieve growth through, though they acknowledge that there will be a strong base effect that would play out. Also, they would focus on building top-line growth, which will drive sustainable value of new business. Finally, coming to the general insurance company, that is ICICI Lombard, very strong numbers from the company. Net earned premium growing by 14%. Underwriting loss, that dropping by about 15% to 293 crore rupees. Operating profit, that growing by about 30% at 654 crore rupees. Finally, combined ratio largely flat on a year-on-year basis at 102.9 versus 102.3%.
Okay, all right. Yash, thanks very much for that. Well, we need to take a short break, but up next, we'll get you the top corporate voices along with key market events to watch out for on the other side. We also want to thank our guests for joining in and taking us through all of the key questions for today, Siddharth as well as Shrikant. Thanks very much.
Welcome back. Let's get the key corporate voices then. First up, Bank of Maharashtra, the management expects NIM's impact of 19 to 20 basis points, considering the 100 basis points repo rate change. The management added that NIM contraction is expected, but they are focused on keeping it minimal. They're also targeting low-cost deposits and moving away from high-cost deposits. 40% of the bank's loan book is linked to repo.
Next up is Network 18. The management expects outlook for the next 3 quarters to improve due to upcoming festive season, as the company is hopeful of a steady revenue growth and keeping costs in check. The management is optimistic about growth since all channels and digital properties are in commanding positions, adds that July is looking slightly better in terms of business.
And before we wrap, we'll bring you some of the key market events to watch out for tomorrow. Ria standing by with that.
Well, yes, let's take a look at the key events to watch out for tomorrow. First up, a lot of economic data on the global front. In the US, we have the core retail sales as well as the initial jobless claims coming in. Watch out for the CPI data coming out of the Eurozone. In the UK, we have the employment rate as well as jobless claims. And in Japan, the trade balance data will be coming out tomorrow. Some global earnings as well to keep your eye out on. We have TSMC, Netflix, Novartis, Abbott Laboratories, PepsiCo and ABB that will be reporting their numbers tomorrow. For India as well, a lot of earnings to watch out for. For Nifty, we have Wipro, Axis Bank and Jio Financial Services, and some other names like 361 Ramsiat Limited, HDFC AMC, Indian Hotels, and the list goes on. We also have some board meetings lined up for tomorrow for Hudco, Inox Wind and Tata Communications. All of these will be holding board meetings to consider a fundraise. And for Patanjali Foods, this one will be considering a bonus issue tomorrow. Some other events to watch out for as well. The India-US trade deal, US-India bilateral trade agreement talks are currently being held in Washington, and the 4-day talks began on Monday and will be ending tomorrow on the 17th of July. We also have the G20 finance ministers and central bank governors meeting happening in South Africa. And the last event to keep your eye out on, UK and Germany are also looking to sign a mutual defense pact tomorrow. So keep your eye out on all of these events.
Okay, all right. Thanks very much for that. And on that note, we're going to wrap up on the show. Thanks very much for watching. More news and updates on the other side.
Hello and welcome to Business 360. I'm Arundhati Ramanan and these are the top headlines that we're tracking for you this evening. Sensex and Nifty end with minor gains after a range-bound session. Financial stocks lead with gains. 3 stocks advance for every 2 declining stocks. US President Donald Trump announces a trade deal with Indonesia and says a deal with India is progressing along the same lines. US will impose 19% tariffs on Indonesian goods and Jakarta will not impose any tariffs on American goods. US Treasury Secretary Scott Bessent is a very good candidate, but not the top choice to replace Jerome Powell as chairman of the Federal Reserve, says President Trump. JP Morgan's Jamie Dimon becomes the first top banker to speak out against Trump's attacks on the Fed, saying central bank independence is absolutely critical. The SBI board might approve launching a qualified institutional placement offer to raise up to 25,000 crore rupees. Sources say that LIC is likely to bid for shares worth over 5,000 crore rupees if approved by the board. Government likely to consider increasing the foreign direct investment limit for public sector banks. Sources say Indian banks need more capital and consolidation of PSU banks is not ruled out. That's an exclusive. Ola, Uber and drivers of other cab aggregators go on strike in Mumbai, demand implementation of aggregator rules and pay parity with regular taxi drivers. Prices rise on taxi apps as lack of drivers lead to surge pricing. Karnataka government issues a draft notification to cap prices at movie theatres and multiplexes at 200 rupees per ticket. If implemented, the move could dent the revenues and profits of PVR Inox. Hamas-run Gaza Health Ministry claims 21 people were killed at a food distribution site in southern Gaza after tear gas firing, which led to a stampede. The aid center is run by US-Israel-backed Gaza Humanitarian Foundation. President Trump says US Attorney General should release credible information on convicted sex offender Jeffrey Epstein. US House Speaker Mike Johnson calls for the release of all Epstein files as Republicans face a rare backlash from their supporters. Those were the headlines that we're tracking for you this evening, but straight to the day's market action. The Sensex and Nifty ended with minor gains after a range-bound session. Nifty managed to remain above the 25,200 levels, while Sensex ended above 82,600. The market breadth favored advances. Nigel D'Souza is here with those highlights. Nigel, over to you.
Well, the buy on the dip strategy did work yet again in today's trading session. So the Nifty ended above the flat line, mildly in the green, but at one point of time we were down in today's trading session. So the Nifty more or less flattish. The outperformer in today's trading session, though, was the Nifty Bank. That did well, and surprise, surprise, even the other pillar of the market did well. That's the Nifty IT index. So both of them did well. But in the last few days, you've seen an outperformance coming from the broader markets. Even in today's trading session, you had a fair bit of winners. In fact, the number of stocks advancing outweighed the number of stocks that were declining. Though the broader market indices, both the mid and the small caps, they took a bit of a break today, both of them ending more or less flattish in today's session. From the Nifty pack itself, Wipro was one of the big gainers. That, in fact, was up more than 2% in trade. Mahindra and Mahindra, I'll tell you what, the street is sensing something on this particular name. Because in the last few trading sessions, we've seen continuous accumulation on this particular name. And SBI could very well be raising some money by the QIP route. That explains why that one as well was quite strong, up close to around 2%. However, there were a couple of stocks that were under pressure. HDB Financial, the numbers looked a little bit softish, and they sounded a little bit cautious on the CV sector. And because of that, Shriram Transport was under the weather. That ended with a cut of close to around 2%. So some kind of rub-off out there. On the flip side, you had strong numbers and strong outlook coming in from Network 18. Do note standard disclosure with regard to that, but that stock was up more than 10%. South-based cement companies, they have been buzzing around on expectations of a better than expected showing in Q1 FY26 because prices have moved up the steepest out there, and also there is buzz of some kind of consolidation. So that pack did well. The other buzzers from very different sides of the spectrum. Tilak Nagar, well, that was dancing away. That was up more than 10%, and Coffee Day was locked up close to around 10%. So both of them did pretty well. So there is a fair bit of action in the broader markets, but I think in the near term, the Nifty continues to remain in that band. On the downside, we're closer to that range, 24,950, which is around the 50 DMA. It's closer to the recent lows as well, while on the upside, the 25,500. It seems you're in a band. Results will be important, and what goes on in terms of the global cues, particularly on the tariffs front, as well as what the Fed has to do from here on.
Absolutely, Nigel. Many thanks for those details. Now, US President Donald Trump has hinted at a deal between India and the USA that would grant American exporters access to India's markets. He also said that the deal would be similar to the one with Indonesia. Washington reached a trade deal with Jakarta, which will see US impose 19% tariffs on Indonesian goods, down from the earlier 32% threat. Trump has said that Indonesia will charge no duties on American goods under this deal.
So we made a deal with Indonesia. I spoke to their really great president, very popular, very strong, smart, and we made the deal. We have full access to Indonesia, everything. As you know, Indonesia is very strong on copper, but we have full access to everything. We will pay no tariffs. So they are giving us access into Indonesia, which we never had. That's probably the biggest part of the deal. And the other part is they are going to pay 19%, and we are going to pay nothing. I think it's a good deal for both parties. But we will have full access into Indonesia.
NATO Secretary General Mark Rutte warned Brazil, China and India that they could be hit very hard by secondary sanctions if they continue to do business with Russia. Rutte told the leaders of the three nations to call Russian President Vladimir Putin and push for serious peace talks with Ukraine. This after President Donald Trump threatened secondary tariffs of 100% on the buyers of Russian exports unless there is a peace deal in 50 days.
Listen, if you are the president of China or the prime minister of India or the president of Brazil, and you are still trading with the Russians and getting the oil and the gas in, and you sometimes even resell it for a higher price, know that if this guy in Moscow doesn't get serious about peace talks, I will slam secondary sanctions on you of 100%. So I'm sure they don't know yet what hit them. This will take some time to sink in, and I think you guys making this clear in the media, the senators maybe also discussing this with their counterparts in Brazil, India, China, will be very helpful to put maximum pressure on Russia.
US President Donald Trump has also said that he may impose tariffs on pharmaceutical products as soon as the end of this month. The president added that US will start with a low tariff and give pharma companies a year to bring manufacturing back to the US. He will then announce very high tariffs. Trump also said his timeline for implementing tariffs on semiconductors was similar.
Pharmaceuticals will be tariffed probably at the end of the month. And we're going to start off with a low tariff and give the pharmaceutical companies a year or so to build, and then we're going to make it a very high tariff because we got to move them in. Look, there's two ways you do it. You make money or you have them move here so they don't have to pay the tariff. Those are the two ways. The pharmaceutical companies are moving back to America where they should be.
US President Donald Trump has said that Treasury Secretary Scott Bessent is among the people who are being considered to replace Jerome Powell as the chairman of the Federal Reserve. However, Trump added that he likes the job that Bessent is doing currently, and hence he is not among the top choices. Yesterday, Bessent had confirmed that the process to appoint the next Federal Reserve chair has begun. President Trump has repeatedly criticized Powell and pressurized him to cut interest rates.
Scott Bessent, your Treasury Secretary, your number one option whenever Jerome Powell leaves, or...
Well, he's an option.
Is he your top?
And he's very good. Well, he's not because I like the job he's doing. Right. That's why he's not been developer. I like the job. I don't know if he was on the plane. Was he not the plane? Maybe he wasn't. But I do like the job he's done. Right. So, in that sense, probably he's not that much of an option. Right. Scott's been great. He's been terrific.
And speaking of the Fed, JP Morgan CEO Jamie Dimon has defended the independence of the Fed chair, saying that is absolutely critical. He said, and I quote, "Playing around with the Fed can often have adverse consequences, the absolute opposite of what you might be hoping for," end of quote. Dimon became the first leader of a major U.S. financial institution to address the Trump administration's attacks on Powell. Speaking during the bank's earnings call, Dimon also warned that Trump's tariff policies pose significant risks to the U.S. economy. Take a look. Time now from a CNBC-TV18 exclusive. The government is likely to consider increasing the foreign direct investment limit for public sector banks. Government sources tell CNBC-TV18 that Indian banks need more capital and a consolidation of PSU banks is not ruled out. Sapna Das joins us now with the details. Sapna, what are you picking up from your sources?
Well, I think the intent of the government is pretty much clear. They want to have larger and bigger banks, and
Probably one of the ways to do that is to look at the next round of public sector bank mergers. Now, that may be feasible among some of these smaller entities in the PSB space. We are aware of the fact that the last merger round took place in 2019, and looking at the massive changes that have happened in the banking ecosystem, probably PSB merger round 2 is something that the government is likely to mull on. That's one. Second, they may also look at consolidation among the 100% government-owned insurance companies. There had been a lot of talk and discussion, a few years back. Probably that concept is back at the drawing table. We'll have to wait and watch and see how this works out and what are the timelines that the government is talking about. Last but not the least, and probably one of the most significant, that is basically to attract more foreign capital. It may also be likely that the government could look at revising or raising the foreign investment cap of 20% for public sector banks. Now, since time immemorial, this cap has really not moved, and irrespective of the fact that there could be enough threshold available even currently for FIS to invest, but the fact remains that as a signal and also in an attempt to garner more capital, something may be possible on that front. Some kind of tweaking, some kind of raising of the limit is something the government may look at. So these are big steps which are part of a financial sector reform agenda to prepare India for a Viksit Bharat. We'll have to wait and watch and see how this really works out.
Right, Sapna, many thanks for those details. Now, shares of RBL Bank continue to rise amid reports of potential investment from Dubai-based Emirates NBD Bank. Yesterday, the RBI governor told CNBC-TV18 not allowing foreign banks to own a 26% stake in Indian banks defies logic. In an exclusive interview, governor said RBI will examine cases if any requests are made. Governor was answering a question in the context of RBL Bank and others which have seen interest from foreign investors. Mutual funds and foreign portfolio investors have been steadily increasing their stake in RBL Bank. From 15% stake in March, mutual funds now own more than 29% stake. Foreign portfolio investors own more than 17%, while the shareholding of retail investors has declined from more than 38% to 28%. Here is the governor on allowing FDI into Indian banks.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission. Right. Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%. Yes. All right. And the foreign banks can actually start business in our country 100%. As even up to 100%. So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah. So, Indian promoters are already allowed up to even more than 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. Mm-hmm. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop, and case by case Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. Okay. So if you don't allow them even 26%, that kind of seems to defy logic.
HDFC Bank's board will meet on July 19 to consider issuing bonus shares and a special interim dividend for FY26. If approved, this would be the bank's first ever bonus issue. The decision will also be subject to regulatory approvals. The HDFC Bank stock has surged more than 23% over the past year. The SBI board might approve launching a qualified institutional placement offer to raise up to 25,000 crore rupees. Sources say that LIC is likely to bid for shares worth over 5,000 crore rupees if the QIP is approved by the board. The banker is expected to offer a slight discount to the current market price for the issue. The Cabinet Committee on Economic Affairs is likely to allow coal PSU NLC India to invest further in renewable energy. Sources tell CNBC-TV18 that the approval will allow NLC to exceed the permitted investment threshold in a joint venture. NLC India's shares surged following the news. Shares of Network 18 rallied as much as 15% after the company posted strong numbers in the June quarter. Net profit standalone stood at 516 crore rupees. However, revenue saw a dip due to a high base from last year's election-linked advertisements. June quarter EBITDA increased by 69%. A standard disclaimer, CNBC TV18, the channel you are watching, is a part of the Network 18 group. Jio BlackRock has secured approval from SEBI to launch 4 passive index funds. These include 3 equity-linked funds tracking Nifty Midcap 150, Nifty Small Cap 250 and Nifty Next 50. The 4th fund is a debt-focused fund that will track Indian government bonds with 8 to 13 years maturity. Earlier this month, the AMC had also raised nearly 18,000 crore rupees across its debut debt schemes. Uber and Ola drivers and other gig economy workers across Maharashtra staged a flash protest at Azad Maidan. The drivers' demands include pay parity with taxi drivers. Rachna Dhanrajani joins us now with more details. Rachna?
If you've been struggling to book a cab via Ola, Uber, Rapido in Mumbai in the last 24 hours, then you're not alone. Because either the rides are just available or the wait time is too long, or even if you manage to get a ride, the prices are way too high. Now, all of this is because the drivers are on strike of these cab aggregators. They started on Tuesday, that was yesterday, where there was a gathering that was held at the Azad Maidan, and these drivers got together and listed out a charter of demands. Now, these demands include rationalization of fares, a blanket ban on bike taxis operating on a white plate, urgent implementation of the Maharashtra Gig Workers Act and the activation of the Drivers Welfare Board. Now, all of this was already notified under the MVA guidelines that were issued earlier this month. So, while these associations are happy with the guidelines, what these drivers are demanding is more clarity. One major thing that they're asking for clarity is about the insurance bit that the MVA guidelines came with on 1st of July. The MVA guidelines suggest that the aggregators are supposed to provide insurance to these drivers, but how and what would be the amount and how would be the payout, how would the drivers access it, all of that remains in the unknown, and which is what the clarity is being demanded for. Another major point that these drivers have demanded is uniform policy centrally and not just state-wise, because the MVA suggests that the states come up with the base fare and that's how the fares would move forward. But what the drivers want is a central policy than a state-wise policy. What they're suggesting is what the policies in Maharashtra should be similar to what it is in Telangana or Karnataka. So while they welcome the new guidelines that the MVA guidelines came from the Department of Road and Transport, but what they want is more clarity and clarification than just policy on paper.
All right, Rachna, thank you so much for those details. On that note, it is time for us to head into a short break. But coming up next, Karnataka government proposes to cap prices at movie theatres and multiplexes at 200 rupees per ticket. Details in just a bit. Stay tuned. Welcome back. You're still with us on Business 360. At least 21 people were killed, including 15 from a stampede and suffocation due to tear gas being fired at Palestinians seeking food. The incident took place at one of the Gaza humanitarian foundations and distribution hubs. This as the Israeli army's attacks killed over 90 Palestinians in the last 24 hours. Ukraine has said that Russia launched 400 missiles across cities overnight. Ukrainian President Zelensky said that the large-scale long-range attacks targeted energy infrastructures. Local officials have said that at least 2 people have been killed in the overnight strikes. U.S. President Donald Trump's top ally, House Speaker Mike Johnson, has urged the Justice Department to release documents related to the Jeffrey Epstein case. Johnson is the latest addition to conservatives who have been calling for full transparency in the high-profile case. The U.S. Justice Department ruled Epstein's 2019 death a suicide and refused to release his alleged clients' list last week. Reacting to it, the U.S. president said that he doesn't understand why anyone would be interested in the case, calling it sordid but boring.
The credible information's been given. Don't forget, we went through years of the Mueller witch hunt and all of the different things, the Steele dossier, which was all fake. All that information was fake. But I don't understand why the Jeffrey Epstein case would be of interest to anybody. It's pretty boring stuff. It's sordid, but it's boring.
The Karnataka government has issued a draft notification proposing a cap on movie ticket prices across the state. The draft rules set a maximum ticket price of 200 rupees per show for all films, inclusive of entertainment tax. The government has invited public feedback within 15 days from the date of publication. Shilpa Ranipeta is here with all of those details. Shilpa, how will this move sort of impact multiplex chains?
Well, the big screen might be getting more pocket-friendly in Karnataka, but it's not such a happy ending for multiplex chains like PVR INOX, which is the largest in the country. Now, the Karnataka government, like you mentioned, has proposed a 200 rupee cap inclusive of taxes for movie tickets at all movie theatres and multiplexes, and that move could impact both revenues and margins for India's largest cinema operator, PVR INOX. Now, let me explain why. Now, if implemented, this cap could bring Karnataka in line with other states like Tamil Nadu, where ticket prices are already capped at about 150 rupees, excluding GST and other taxes. In Andhra Pradesh, where regular seats are priced and capped at 177. Meanwhile, Telangana also is slightly on the higher side, allowing tickets up to 295 for regular seats and up to 350 for recliners. Now, Karnataka, though, is a key market for PVR INOX. It contributes about 10% to its revenues, with about 215 screens, that is 12.3% of its total footprint currently. Now, the average ticket price also, or the ATP in Karnataka, stands at 260 rupees. Now, the proposed cap could slash this by nearly 30%, triggering a 3.7% dip in PVR INOX overall ATP and potentially also cut revenues by about 2.2% and EBITDA by about 1.8% over FY26 to FY28. Now, analysts say that this could also impact PVR INOX's expansion plans, especially for premium formats like IMAX and 4DX in Bangalore, where weekend ticket prices often cross, 600 rupees and more as well. Now, a flat cap might also delay returns on these high investment formats. Now, as a result of this, PVR may lean more on food and beverage sales, which is a high margin business for it, even more to make money. Now, if you look at the larger context also, the move comes at a time where PVR INOX is increasing its focus on South India. Currently, 33% of its total screens and roughly 25% of its revenues are from the entire region. Now, it's a key market for expansion. In FY25 alone, 35 out of the 77 new screens that were opened in the south. Now, why? Because this is one of the regions that delivers higher occupancy, especially at a time where occupancy is still limping back post-COVID. And not to forget, some of the biggest hits, think Bahubali, RRR, Pushpa 2 and more, and KGF, all of these are from the south. Now, the Karnataka government has opened the draft notification for public feedback for about 15 days, after which the final call might be taken. Now, if implemented, definitely good news for consumers, but you will still have to shell out a lot more for that popcorn and Coke. Back to you.
All right, Shilpa, many thanks for taking us through those details. Now, a team from international fashion brand Prada visited Kolhapur to learn about the tradition of making Kolhapuri chappals. The Italian fashion house's designers met the Kolhapuri chappal craftsmen to learn about the nuances of the tradition. This visit comes after Prada faced backlash for showcasing sandals resembling Kolhapuri chappals in its spring-summer 2026 men's collection. Meanwhile, Bombay High Court dismissed a PIL filed by 5 advocates over the alleged unauthorized use of the design. Lotus beds have reappeared at Kashmir's Wular Lake 30 years after a devastating flood had wreaked havoc on its ecosystem. What you can see on your screens are a carpet of lotus beds in full bloom. The flood deposited a large quantity of silt in that lake that buried the lotus vegetation over the years. However, owing to the conservation efforts, the lotus buds have reappeared. Located in Bandipora, Wular is Asia's second largest freshwater lake. And with that, it is a wrap on this edition of Business 360. More news and updates continue right here on CNBC TV 18.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alekh Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns, just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news, and you don't know, tariff, and Mr. Trump is telling you that the whole world has to be reset, and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah, so I think there's a little bit of concern that is there amongst investors as well, So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So it's like, twin fears working together.
Exactly.
But in generally, I mean, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while, for actually the last 2 years. Actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should putting in their money. What else, just in terms of asset classes?
So that's one. Gold, we still have some allocation. We're not fully taking out. How much? Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold. And on the debt side, we are saying that maybe it's time to book out money from duration and add to conservative debt like corporate bond funds, and using income plus arbitrage as tax efficient vehicles to take allocation to debt.
Okay, so that's the overall thought process with respect to where the money should be parked. That's the sanctum view. But now I want to get to the exciting part. Because the way Alek has done this is that he's going to encapsulate all the mistakes we end up making in a panch ka punch. So the 5 to avoid. Take it away, Alek.
Yeah, so I think the first one, that we typically see in client portfolios is over concentration or over diversification. So generally investors who have been investing for a long period of time, HNI investors who have a larger portfolio, they tend to end up accumulating too many mutual funds. We've seen in client portfolios with 40, 50 mutual funds as well. And as we know, each of these mutual funds have about 50, 60 stocks. So you overall end up owning like 1,000 odd stocks, almost the entire market. That's too much of diversification. On the other hand, newer investors who started new, they end up doing 2, 3 mutual funds, maybe 4, 5 mutual funds, and have a concentrated portfolio. There again, what happens is that if there is a good experience with one fund, you got it at the right time, you end up owning 20-30% in that one mutual fund. So that's too much concentration. Our ideal thing is anywhere between 5 to 15% allocation to one single mutual fund, which means around 8 to 12 mutual funds on the equity side is more than enough, and that should cover for you.
8 to 12 funds. Because this is something that people always grapple with, and sometimes people have multiple advisors. So you have one portfolio with one and another with the other.
Exactly.
So you're saying no more than 8 to 15 funds.
Yes, that's right.
Okay, so that takes care of the over diversification part of it.
Yes.
If someone does have a big portfolio right now with 20-25 funds, and they need to basically clean it up and come down to what you're saying. How do you start? How do you prune it and get it all together?
So the second point comes in, which is the diversification across market cap as well as style. We'll talk about both of them. But here, what we should look at is that you should have funds in each category. Some flexi cap, some mid cap, some small cap, some large cap mutual funds, and then diversification across style is also what you need, and we'll talk about that.
All right, so mistake number one to avoid, do not be over diversified in too many funds. That's number one. So what's the second mistake to avoid?
So second one is market cap, and that is very pertinent right now because we've seen a stellar run for mid and small caps. They've outperformed large caps almost, like small cap index has done double of large cap in the last 5 years. So and investors look at past returns while taking decisions. So one may be a little more skewed towards mid and small cap at this point of time. And we know mid and small caps also have their cycle. So that periods where they do extremely well and periods where they underperform as well. As a thumb rule, what you could look at is the overall market cap for India. If you were to break it in large cap, mid cap, small cap, about 70-75% would be large cap. 20-25% would be mid cap, and the balance 5-10% would be small cap. So that could be your guiding tool. And depending on if you're aggressive, then you could have, say, maybe 40% in mid and small cap, and if you're balanced in less.
But that's the thing, because the last couple of years, large caps have not been delivering great returns. Therefore, people have wanted to go to mid and small caps in search of better returns. So what do you say to that? Because it's a valid argument, right? Because foreign investors are not coming in, so you're not seeing big moves in big large cap stocks. So if you're stuck there, you're forever going to be underperforming.
Yes. So I think the right way to take that large cap allocation is through flexi cap funds. And flexi cap funds will have about 50-60%, 70% large cap exposure. They'll do their picking up of the right stock, which will add a little bit of alpha. And then they'll use the mid and small caps to also deliver good returns. And if you look at flexi cap funds, they've done really well. Some of them have done really well in the last 5 years. So that is, I think, the way to go ahead rather than just doing pure large cap mutual funds.
Okay, so maybe flexi cap funds could, give you that edge because ultimately it's the portfolio manager, the fund manager who's going to decide whether it's time to load up on some additional well-performing mid caps or not. So second mistake to avoid, don't get carried away by the market cap classification and design your portfolio only as per the particular class of stocks that's doing well at that point in time. So that's two. Mistake number three.
So the third one is style diversification. We just talked about that. And this is a little tricky because, it's not very intuitive. So I'll just briefly maybe take 1 minute to explain what these styles are. One is growth investing, which is basically investing in companies where earnings growth is very strong. Valuation is not as relevant because the earnings will make up for it. Other is the exact opposite, which is value-oriented investment, which means you invest in companies which are cheap in terms of valuation. Earnings growth may not be as important, so that's growth value. Then you have something in between, which is called growth at right price. That means you still buy growth, but at a reasonable valuation. And then you can have either a quality bias or a momentum bias as well. And there again, these styles also see cycles. So, there could be time periods where, like for example, last 3 years, quality has underperformed significantly. And investors may completely be away from quality. They may not pick any of these funds. But quality could come back. So having a little bit of allocation everywhere makes sense, but you can have a bias towards what is working right now at that point.
So, I mean, in the practical sense, how do you apply that? Because Indian mutual funds don't necessarily advertise themselves as, okay, I'm a growth fund or I'm a value fund. And that portfolio could have a mix. It could have certain high growth stocks. It could have certain underperformers, which the fund manager feels could turn around. So how do you practically implement this?
So the way to do that is having diversification across AMCs. AMCs generally have a style. For example, Axis as an AMC was doing really well up to one period of time because quality bias was helping them, and now they've underperformed because quality has underperformed. So having not being concentrated in one AMC can actually help you. And AMCs tend to have their own style. So if you, our thumb rule is that in any AMC, nothing more than 30% of the portfolio. And if you do that, then you will have...
give us, since you mentioned that some AMCs tend to have a certain style characteristics. So the ones where the style is pretty clear or evident, give us some examples.
So for example, HDFC, in their flexi-cap and focused this thing, they are a little more value-oriented fund house.
They're like value stocks.
They're value stocks. Prashant Jan was managing it. It was completely value.
Totally
and
value,
with Roshi, it's a little more GAR, but still value-oriented. So they're on that side. Motilal, as a fund house, is a little more momentum, a little more earnings growth-oriented. And then you have Invesco, which is a little more balanced. It does a little bit of growth, a little bit of value in their funds. As we said, Axis, has a little quality biased. They've had quality bias historically. In UTI, while the fund house doesn't have a style, but something like a UTI flexi cap has been a quality biased mutual fund throughout.
Okay,
and
that
that's why it's
helps. So we can keep that in mind. That's the inherent nature of some of these funds of the fund houses.
Yeah.
And then you can do a mix and match when it comes to your portfolio. So that covers the third point, three mistakes to avoid.
Yeah.
What's the fourth mistake to avoid?
Yeah, so the other thing is NFOs, new fund offers. So new fund offers, at new fund offers, you don't have a past track record. You don't have past portfolios that you can look at or the current portfolios that you can look at to take decisions. So the decision is based on themes or narratives that the AMC is talking about. And there you could, and so there one should be a little more selective. If it's a theme which is not there is no other investment option available in that theme, then you can go ahead and do the NFO still. But if it's a theme which is well played out, like a mid cap, small cap, there are multiple other options, then maybe it's best avoided, wait for some time, look at how the fund does, and then participate in that NFO.
Okay, so don't get carried away with NFOs. That could be mistake number 4. But let me ask you about this, because in the last year or 2 years, every time a sector has done really well, you'll definitely see AMCs coming out with funds.
Yes.
So defense, we saw that.
Yes.
Manufacturing, we saw that.
Yes.
Now, maybe the long-term narrative cannot be denied. Maybe there is a long-term opportunity
Exactly.
there. So, for instance, on defense, what is your house call right now?
Yes.
To be in these defense funds or to completely steer clear?
Sure. So I think right now defense stocks have rallied a lot. The whole India-Pakistan issue also, sort of helped these stocks do well. Some of them have run ahead of their fundamentals. So our view right now is to sort of book profits from defense.
Okay.
Back when HDFC had launched the fund, I think it was a very good time. It's done well, since they launched.
Okay. Is there any thematic or sector fund that you like?
Sure. So right now we are a little more biased towards financials. I think banks right now are trading at valuations which are lower than historical averages. So any fund, funds which are biased towards banking and financial services, BFSI funds are funds that we are positive on right now.
Okay. All right. Otherwise, not getting too carried away with the hot sectors that are, the top trending, so to speak. Okay, so that's 4 mistakes to avoid. Which is the 5th one?
Yeah, so 5th one is similar. This is sector and thematic funds. Even if they're not NFOs, they are funds which are ongoing. Investors may be overexposed to thematic funds. Generally, when by the time it becomes popular, by the time it's there in the narrative, it's already run up, and that's probably not the best time to enter. So. Limiting your thematic exposure to maybe say 10 to 15% of the portfolio and keep the balanced in flexi cap, whatever categories you want to invest in, is probably more prudent, and just have like 10-15% in sector thematic funds.
Okay, all right. So 5 rules to keep in mind when you're looking at your portfolio, evaluating your portfolio, either yourself or with your advisor. Let's quickly do a recap. 5 mistakes to avoid in your portfolio plan.
Yeah. So the first one is too much concentration or diversification. As we said, the right balance is between say 8 to 15 mutual funds. The second is market cap allocation, not being biased towards one market cap, having a balance between large, mid, small cap is the second point. The third point is style diversification across growth, value, and quality. The fourth point is NFOs and being selective about NFOs. And the final point is thematic and sectoral funds, being selective about thematic sector funds and limiting exposure there.
Okay, all right. So remember these 5 pointers when you're looking at your portfolio plan. We do have to take a very quick break on that note. On the other side, as promised, we're going to do a quick dipstick on hybrid funds. Why perhaps you may want to use these funds to diversify beyond equity as well. Are there some good funds out there that you should consider? We'll discuss this after the break.
Let's talk money. Let's Talk Money.
Welcome back. You're with us on Let's Talk Money, and we're discussing the portfolio mistakes to avoid with Alek Yadav of Sanctum Wealth. One of the mistakes to avoid, obviously, is being too skewed towards any one particular asset class and not have a well-balanced portfolio. Now, something that can perhaps help us stay away from this is the category of funds known as hybrids, where you have a mix and match of various asset classes, and all of them are offered by the mutual fund world. In fact, if you look at the returns of some of the hybrids, returns have been looking pretty decent in the last couple of years, though, of course, we must remember that past returns are not an indication of future performance. But nonetheless, I mean, look at that table. It's pretty self-explanatory. Double-digit returns coming in. And many of these funds, by the way, are fairly tax-efficient as well. They have better than FD taxation. And that's why, Alek, I wanted to, draw you in.
Yeah.
Which of these categories makes sense to you?
Sure. So for a conservative investor, two categories to look at. One is equity plus equity arbitrage, which is basically investing in stocks which are, you buy some in cash, you sell some in futures. Overall, you're hedged. You get debt-like returns and debt-like risk, but they are taxed as equity mutual funds, so you get a much healthier post-tax.
So that's the arbitrage category.
That's the arbitrage.
And that's been getting a fair amount of funds last
Exactly.
2-3 months. In fact, I've noticed this. The arbitrage category has been drawing in almost 15,000 crores from investors over the last two odd months or so.
Yeah.
So arbitrage is a category, something that you like.
That's right.
And what else?
Yeah, so that is the most safest one. Then slightly, if you can take a little more risk, then there is a category called equity savings, where the fund will take about, say, 30% odd exposure to equities. The balance, 30-35%, would be in arbitrage, and the rest would be in debt. That could be for somebody who can take a little bit of risk, has slightly a longer time horizon, say 1 year plus. You get slightly higher returns, as you can see here.
8%.
Yeah. And the taxation is again equity taxation, so that also helps in this case.
Now, this category of dynamic asset allocation, or the balanced advantage funds as they're called, this and the multi-asset allocation category, this has been getting a lot of flows. In fact, we'll just pull up the bars as well. I think we have the data as well. Over the last couple of months, systematically, there's a lot of money that's flowing into the balanced advantage fund category, as well as multi-asset funds. So yeah, arbitrage is what we were speaking of. So even like I said, last 2 months on arbitrage, the flows have really picked up. Look at other categories like balanced advantage, very steady sort of number of funds coming in. And multi-asset, look at that, about 3,000 crores, more than 3,000 crores in some months coming in this category as well. So they're clearly gaining in popularity.
Yeah.
Do they make sense to you?
Yeah. So especially for people who don't have access to advisors or wealth managers, for them, I think this is a beautiful category. What multi-asset and balanced advantage fund do is they move between equity and debt if it's a balanced advantage fund, depending on the fund manager's view on the market. In a multi-asset, the movement would be between equity, debt, gold and silver as one category. And that allows you to get exposure to all the three categories. They're tax efficient because most of them are taxed as equity mutual fund. And if like in current markets where you're uncertain, then the fund manager takes the call of deciding which asset class to.
Okay, so arbitrage, multi-asset, balanced advantage and equity savings. A couple of categories that perhaps one can consider. Within that, the choice of funds. Give us some names, some ideas, some AMCs that you like.
So I think in the arbitrage, the clear sort of preference that we have is for Kotak Equity Arbitrage Fund. That's the most consistent arbitrage funds that is out there. It generally does like 10-15 basis point higher, like 0.1, 0.2% higher than other arbitrage funds. The model, the technology that they've built in allows them to get a slightly higher premium than the rest of the funds. So that is the preference there. In the equity savings category, there is a fund by ICICI Pro Equity Savings Fund. They are a little more conservative fund manager. What they look to do is they look to buy only 20% equity, and that also mostly large cap. And the rest is arbitrage, and then there is a little bit of debt. They're more conservative compared to the other ones, and they've been fairly consistent. So you may not get the upside, but at least the downside is protected with ICICI Pro Equity Savings.
Okay, so that's the equity savings category.
Equity savings.
More conservative approach.
Yes.
What else do you like?
Yeah, so in the balanced advantage category, the dynamic asset allocation category, the HDFC balanced advantage fund is something that one can look at. It's a little more aggressive. What they look to do is they also take a little bit of mid cap and small cap exposure in their equity. The equity portion is managed very similar to the HDFC flexi cap focused strategy, which is a little more value oriented. And the debt is simple, plain vanilla debt. So I think that's one category that one can look at. A little more aggressive, but fairly consistent.
And what would be a fair return expectation from, let's say, an HDFC Balanced Advantage fund?
Yeah, so the fair return expectation there should be about, say, 11-12%, so
which is not bad.
Which is not bad, so you get maybe 1-2% lower than equity over a longer period of time. In the last 5 years, it's done 20% plus because markets have done well. But yeah, generally, I think that should be the expectation.
And what about multi-asset? Because they have to, by definition, invest at least 10% in every asset class, right?
Yeah.
So do you like anything here, or would you rather do it separately? I mean,
so for HNI investors that have access to advisory services, for them, it makes sense to do it separately. But for retail investors who don't have access to that, I think it makes sense to do multi-asset funds. There are, you could look at, say, like an ICICI multi-asset fund. They are very good. The model which selects funds between equity and debt is pro, and they've been following it for a very long time. They have a lot of.
And it's an old fund. It's not a new fund.
It's an old fund. It's one of the largest funds also in the category. So that's a fund that one can look at. And that's also done well in the last 5 years, 20% plus. But I think the expectation there again should be around, like, say, 10-11%.
Which is not bad. So, that makes me think and brings me to the close of this conversation. If some of these hybrid funds with lesser volatility can give you 10-11%, then isn't there a very strong case to have a greater part of your portfolio going into hybrids?
Yeah. Exactly. For retail investors who cannot do the asset allocation themselves, this is a powerful fund. You get the equity taxation, the movement of the asset allocations done by the fund manager. I think it makes a lot of sense. For HNI investors, where they can do other stuff, like in the debt, they can do not only debt mutual funds, but other funds. I think for them, there are other options that are available. For retail, it makes sense.
All right. So final word then, half the year is done, Alek. What's your advice for the second half of the year? How to make money?
So I think, just remaining invested is the most premium thing here. I think there are going to be some alpha generation possibility that mutual funds can have. So selecting the right mutual fund, being with people who have proven themselves in the past, I think will also help. This may be a time for active mutual funds than passive mutual funds.
Okay, all right. So keep your eye on the ball and eye on the stocks that perhaps can outperform. Got it. A very, very helpful conversation. Thank you very much for joining us on the show today. Thank you.
Thank you so much for having me.
All right. Well, folks, hopefully you found that interesting and engaging. I certainly did. Keep sending us your feedback, comments, and queries. As always, we'll see you with another conversation. Same time, same place next week.
Let's talk money.
Hello and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra. The governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points, again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time.
Thank you. Thank you for the opportunity to be here.
So, first up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8 and the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than the current data which we have now only for Q1. Rightly you have said that it has come down, but how is it going to look like going ahead? And we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing that. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore, take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast, therefore, the outlook is lower, the growth is lower, certainly, the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
Okay. So what you're saying is when you are looking at the neutral rate, it is not the current inflation minus repo rate minus current inflation. Will it be more repo rate minus 12-month forward inflation? Because in the MPC minutes, members are doing both. They're looking at current inflation. Some of them are looking at some points at 12-month forward. Where will your accent be?
See, your this real rate, first of all.
Yes.
It is the long run rate, interest rate, at which the economy is to be, in a neutral state or a state of equilibrium or a state of steadiness. Now, it's very difficult. First of all, it's very, very difficult to calculate this. It's not observed. It's an estimate, and it's a difficult thing to estimate.
Yes.
Even, because you mentioned about this
real rate.
Real rate. So let's be very clear, that this is only a guidepost. This is not a precise number. Even in India, we have a range 1.4 to 1.9 or thereabouts. Even, in the US, they have a range. Each member, gives a very, very different estimate of this. And so John Williams, who's an authority in this, in fact, he says that, this is not a bright, this star, the so-called star, is not a bright point of light, but it is a fuzzy blur. So it's imprecise, and it's moving, it's changing. So while that is important, it's only a guidepost. Coming to your question of
12-month forward.
12-month forward, or whether it is the current inflation, as I already mentioned, monetary policy is forward-looking. And so for us, what is more important is the inflation going forward. But inflation going forward, you don't know, I don't know.
No.
It's only an estimate.
Yes.
It's an outlook. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Okay, let me persist with this just for one last question. See, the inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, is it one-third hike, pause, cut? Or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI? And
no, see, firstly, let me say that monetary policy, as I'm mentioning, it is forward-looking. At the point of time when the MPC met last in June, the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The average on the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards.
Okay.
And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. Well, sir, that's on the rate cut. Let me come to the VRRR, the liquidity issue. Now, when you do, what are the triggers you look at when you take the VRRR action? Do you want to only impact the call rate and ensure that the call rate is at least above SDF 5/4 to 5.5 range? Or do you want the TREPS market, which is, a very big interbank market where even mutual funds participate? 90% of the overnight exchange of money happens in the TREPS market. So will you target that also and want it to come to 5/4, or only you look at call rate?
See, the operating target for the monetary policy is very, very clear, which is the call money rate. And so we are looking only at that. We are not looking at the TREPS rate or the market repo rate or the collateralized money market trades. That's certainly not something that we are targeting. Of course, we look at it. I may also mention to you over here that these are although they are very, very different markets, because one of them is collateralized, other is non-collateralized, the other has, the participants are very, very different, right? Over here it's mostly in the non-collateralized market, it's the banks and the primary dealers, whereas over there you have the mutual funds, you have the insurers, provident funds, etc., etc. So they are very, very, although their composition is very, very different, they move in tandem. And we did an analysis. The coefficient of correlation between the two, both call money market rate and your market repo, 0.98. 0.98 is very, very high. Any economist will know that. And similarly, the TREPS rate and the call money rate is 0.98. Both of them. One is 0.977, the other is 0.983 for the last 1 year.
Yeah.
So they are very highly correlated. They move in tandem if we target. So it's really not material so much, I would say. Okay. If you target one, the other gets targeted on its own. Okay. And it's not true, only for the non-collateralized market, even for the CP, CD, Treasury bill, and so on. The whole spectrum of the money market. So that's how we are looking at
which rate to target, which is your
target,
call.
yes.
Which is your call rate. Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate? As you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly within the corridor, which at present is 5/4 to 5/3, and while we would like it to be at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well on new loans. On new loans, there is a 24 basis points of transmission already till May. Okay. We have data only till May, which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning, it was 544, so it's quite close.
Yes.
Friday it closed at 545. And so our effort will be to, while maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Okay, it should help you.
These are the two factors which will continue to guide us.
ownership of banks. You said that there is a review. Personally, what is your opinion? Would you want at some point conglomerates also to have banking licenses?
This is a very, very old question. This is a very...
It doesn't go out of fashion, sir.
Yeah.
Or out of the desires of conglomerates.
Yeah, so I think this question primarily comes from the fact that some of the corporate groups, they have deep pockets. And the banking industry, at the same time, needs capital, whether it is the existing banks or whether it is, the new banks. So that's certainly, a valid question. But at the same time, let's also keep in mind that conducting business, financial business and real economic activities within the same group has a conflict of interest. And I would say, that this counter argument is equally valid and equally relevant, even today.
Okay, you were talking about that you will review bank ownership rules more in the instance of...
Yes, we are, of course, reviewing it and seeing, as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks, how, we can tweak, change some of these, the foreign banks, how, we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really.
Yes.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%.
Yes.
All right. And the foreign banks can actually start business in our country
100%.
as even up to 100%.
Yes.
So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. Okay. So if you don't allow them even 26%,
yeah,
that kind of seems to defy logic.
Yeah.
So we will be okay in allowing them whether it is on a case-to-case basis, whether it is as a general matter of policy. These are matters of detail, which we'll work out.
Let me come to the final growth picture that you have. The e-way bills have dropped a bit. GST collections in May was excellent, June was unimpressive. Car sales are unimpressive. And the global uncertainty is not going away at all, if anything compounding. Would you worry about growth at this juncture? Is this 6.5 also possible?
Well, that's 6.5, is our latest number. Yes, there are mixed signals, high frequency indicators, more or less, they are aligned with our projections. We'll again, revise them in case needed. We will again reassess them, review them for our monetary policy, which is due in another 15-20 days. Urban, yes, you're right. Air traffic is subdued. Passenger cars are again, that is subdued. FMCG sales, of course, are doing well in the urban areas as well. There is robust growth of consumption in rural areas.
Yes.
Monsoon is favorable. Yes. We are hopeful of, a good trade deal. Hopefully, that's in the final stages. Let's see. Let's keep our fingers crossed over there. There is good optimism that we see in our surveys of consumer surveys that we see. We'll again reassess the situation on the growth front going forward.
Just the final question is, because there is this law that is sitting in front of the US House of Representatives, crypto law, in fact, they're calling it crypto.
I think it got passed recently.
Yeah. So I was just wondering if in the Reserve Bank, any chatter on this. Reserve Bank was opposed to it, and I thought with very good reason, but
see,
when you re-look, because the world is moving.
There is, I would not like to talk about it, because there is a group already constituted by the Government of India, headed by the Secretary. We are also represented over there. We have given our views. It has implications for monetary policy and financial stability, as we have already mentioned. I may also mention, see, that the landscape here for payments in India is very, very different.
Yes.
A lot of the issues which are there in some of the other economies, we have been able to resolve because we have the UPI, we have the NEFT, we have the RTGS. The problem is basically, for small payments, costs of small payments in these other countries and cross-border payments are high. We have been able to resolve it. So let's wait, for the final recommendations of the working group.
Okay, thank you very much, Governor, for your time. I just wanted to ask you one personal question. You landed in at a time when things were quite tense for the economy. I mean, the election in the US had made things a little difficult for the economy, uncertain for the economy. What was your learning curve as a central banker? I mean, usually when you come as a DEA secretary and then you already had one foot in. But you came, Revenue Secretary is not part of the board. So what was your learning curve like?
No, first of all, it's an honor, to be here. It's a challenging one, as you are saying, but at the same time, it's an honor. It's a very revered institution, and so it's a prestigious for me, to be heading this organization. We have a good, very good professional team. We in the IAS, of course, you are aware, we move. Yes. We move, from sector to sector, which are very, very diverse. And
so I would argue that is useful as a governor, because you all have seen a large part of the economy. But in 6 months to learn so much.
So that's the point I'm making, that when we move, I'm not saying, because we move, so we have a lot of experience. The point I was making is that because we move from one sector to another sector, there is always, a learning curve over there. Some will have a steep learning curve, some will have less learning curve. So without naming, sectors which had a steeper learning curve, but each so that gives you, that kind of experience, to how to handle, and how to learn going into a new organization. Having said that, of course, I've had experience, I was the banking secretary for some time. I've headed an NBFC, one of the largest NBFCs. in the country that helped me. My course, in Princeton, I did a monetary policy course there with Alan Blinder over there. So that, helped me. And we have a very good team over here, which supports us. I am hopeful, that I'll be able to do my bit in these challenging times.
Okay, if Alan Blinder was a teacher, then you've already been coached very well in the theoretical foundations. Thank you very much,
my pleasure,
Governor, for spending time with us. And I'm sure you've answered a lot of queries that economy and the markets had. Thank you very much for your time.
Thank you. It's been my pleasure.
Focus and simplicity. Steve Jobs said that this was his mantra. In his words, simple can be harder than complex. You have to work hard to get your thinking clean to make it simple. But it's worth it in the end because once you get there, you can move mountains. I have a feeling my guest today would readily agree with Steve Jobs. Anish Shah assumed leadership as the managing director and CEO of the Mahindra Group in 2020. When Shah took over the company, it was facing challenges and it was what Motilal Oswal's 29th wealth creation study defined as a bruised blue chip, a fundamentally strong company that had lost over 50% of its market value. Within 18 months, the company divested 15 non-core businesses. M&M delivered 22% compounded annual growth rate in revenue and a 31% CAGR in profit after tax between FY20 and FY24, while its return on equity improved from 10% to 22%.
So the first thing starts with company first. Anything we're going to say, anything we're going to recommend is because it is for the benefit of the company.
Like life, in business, you do get emotionally attached to decisions, to businesses.
The role of a CEO is to have a wide spectrum where emotions one end of that spectrum and practicalities on the other end of that spectrum.
You know, you talked about Anand and working with him when you joined the Mahindra Group in 2014. I mean, those are pretty big shoes to fill.
So Anand is a remarkable leader. What I've learned from him is find ways to bring out the best in people.
Is there an innings, a captain's innings that you would like to emulate?
I have a lot of regard for Dhoni as a captain, for how he brought the team together. He actually put 20% of our KRAs for everyone as helping others.
So what is the best piece of advice that you've received?
To get control, you must give up control. And it was finally my older son who helped me understand that, because I would continue to tell him, here's what you need to do. He just rebelled, as I had done when I was growing up.
You rebelled against your dad?
Oh yes, of course.
Really? You don't seem the sort. You haven't been bitten by the marathon bug yet, like many of your peers in the city.
I shall get to it at some point in time. I think it's good for everyone to have things that they really love doing. For me, it's a range of things right now. So it's been difficult to focus on
one thing.
Just one thing from a personal standpoint, because again, for many years I've always wanted to spend weekends with family. And that's always been the one driving part, because weekdays tend to get quite crazy usually.
But do you like, is there a family passion that all of you kind of share, or
so we love traveling.
Yeah.
And we usually do 2 trips a year, one in summer, one in winter. And then maybe a few smaller weekend trips at times.
Okay. Joining me today to talk about the art of sacrifice and his formula for focus is the man himself, Anish Shah. Many thanks for joining us here on the Leadership Language. Let me start with that, Anish. We were talking earlier and you told me that you finished your PhD thesis in less than 3 years. You divested 15 companies after taking over as CEO of the group in 2020. Many people say that you're a man in a hurry. Where does that sense of urgency come from?
So Shireen, first, it's a pleasure to be here with you and an honor to be here as part of the Leadership Language program. In my mind, it's about focus, what you just mentioned earlier. I've always believed in the mantra of doing less, but doing it very well. Completing something, moving on to the next thing after that. And that has helped across my career in various things I've done. Though I must say, the credit for my PhD goes entirely to my advisor. He played a big role. In fact, a set of advisors, both of them played a huge role in enabling me to complete fast. So I shall give credit where it's due.
Oh, so the doctor in Anish Shah is actually the real deal. It's not an honorary doctorate. This is something that you've actually earned. But, Anish, let's talk about 2020 when you took over as CEO. And I want to understand from you, in light of the experiences so far, what you believe the job of a CEO is today. What is the role that you believe a CEO plays today?
I think it's very important for the CEO to have clarity in terms of the direction, because everyone in the organization must march to the same tune in the same direction. A CEO must have a clear understanding of stakeholders and what does each stakeholder want. And then third, a set of priorities that's going to enable us to get to the direction we want in sync with what the stakeholders are looking for.
But as you said about divesting these businesses, and I would imagine that these are not easy choices to make. And these are entrenched businesses. Learning the art of sacrifice, learning that less is more. What have been some of the metrics? What have been some of the guiding principles that have helped you take that course of action? What have been some of the things that you've done that you communicated to all stakeholders to ensure that everyone was on board with these decisions as well?
So the first thing starts with company first, if that is well ingrained in all the discussions you have, which is anything we're going to say, anything we're going to recommend is because it is for the benefit of the company and not for your personal benefit or not for the benefit of the department or the unit that you run, it changes the tone of the conversation completely. It allows people to speak a lot more freely, a lot more openly, because they know that they're giving ideas that are important for us to consider in taking the right decisions. The second is the courage to take the harder decisions. It's sometimes much easier to say, let's go with hope, this will work out. But if we really go through the details and analyze, and in the instance of the companies we exited, our question was, will we ever make profit in these businesses? What will it cost for us to make profits? What do we need to do differently? And in almost all the cases, we realized that it was not a business that made sense from our standpoint. We were never going to make profit for our shareholders for that. And therefore, a tough decision, but the right decision for the company was that we need to exit and maybe hand the business in someone else's hands, where there's a greater synergy, where they can do more with it for whatever reason, and focus our efforts on things that make sense for our shareholders and grow those businesses.
You know, is it harder to be in a diversified conglomerate like the Mahindra Group to actually get everybody to operate on the same page, to have an alignment not just of purpose and vision, but of execution as well?
So there, I would say that we've been blessed with the DNA we've had, because I give a tremendous amount of credit to our leaders from the past. Mahindra has been the best performing stock in the Nifty from 2002 till 2018 for 17 years. Right? And I always remind folks of that. So while you may call us a blue chip, it is a blue chip. That's where the starting point is. And that DNA has helped us a lot. Our leaders from the past always believed in company first. So therefore, for us, that was not something difficult to get to. It was part of who we were. We believed in entrepreneurship. We believed in taking bets. Some bets may not work. But yes, we need to then act on them quickly enough. But then we've got to take other bets that work and be able to create value. So all of those metrics were important. And therefore, when I took over, one of the most important things was what we coined as continuity in change. It was a significant change. It was a non-family member taking over as group CEO for the first time in 77 years, and the first time in the history of the company. But it was very important for us to ensure that the principles of the company, the DNA of the company did not change. And therefore, while from the outside you might look at it and say that, yes, you've exited 15 businesses, there are a bunch of other things that have been done, there is a stronger performance orientation, the foundation for us stays the same. And therefore, continuity in change was the most important mantra for us during that phase.
You know, it's interesting when you talk about continuity and change, because it suggests that there has to be a balance, that while you are changing, you're still holding on to fundamentally who you were or who you continue to be. But easier said than done, isn't it?
Oh, absolutely. Because everyone is expecting change. That's the starting point. Right? They're basically saying, you've come in, things are changing. Right? We're a different company now. And therefore, it takes a lot of effort to be able to continue to deliver that message, not just in terms of what was said, but in terms of your actions. And it takes time for people to look at it and say, you actually mean what you said there. But that requires consistent set of actions and efforts, and that also requires support from a much larger set of folks around us. And many of our senior leaders stepped up to give that support, and that helped the transition be a lot more smoother than it would have been otherwise.
You know, speaking of the transition, and something that you just alluded to, that you were the first non-family member ever in the history of the group to take over as CEO. In your own head, you know, how were you looking at this? Because for many years, across different sectors, across different companies, this issue of ownership and management and how the two are different and how the two should actually converge has been discussed and debated. How did you look at that issue before you took this role on?
So, to be honest on that, Shireen, in my mind, it really wasn't any different from what I've done through my career. And I think the big reason for that was the management style that Anand had. When I came into the group in 2014, and worked with him closely for a few years. His style was completely empowering. It was not the traditional family-based business that you would see. The Mahindra Group had been set up as a professional group by him many years before I came in. He would trust his leaders, empower them completely, and create an environment where everyone was free to say whatever they wanted to, create an environment where people could take the bets that they wanted to. And that was a very, very different environment than what you would look at from a traditional family-based organization. So in that environment, it wasn't really difficult to move forward, and which was also more important for us to establish that aspect of continuity and change, because a lot of things we had were outstanding, and we needed to make sure that they stayed as part of that change.
What was harder, the diagnosis of the problem or then finding the right prescription to address the diagnosis?
The diagnosis was fairly straightforward because it's something we had been seeing for some time, and it was just about execution. What helped was a burning platform in some sense, because COVID had come in as well, and revenue in that first month in April was literally zero, and therefore the ability to take actions faster was made easier. And sometimes you have to take advantage of a crisis, and we took advantage of that and moved fast, and that got everyone on the same page very quickly. The toughest action was taken first, which was SsangYong. And for many months, our analysts and investors did not believe that we actually had taken that action. They kept telling us that you're going to come back in it somehow. Right? And when they realized that that was a real action.
Why do you think that was the case? Why do you think they didn't believe you?
Because it was a large company. It was one that emotionally was a difficult decision, and one that made a lot of sense for shareholders. So the result of it was that our stock price actually had gone up quite significantly with that one action and with a few other things we'd done. And that got the troops rallied around very quickly, saying, we're doing something right here, and let's continue on that path. And that really helped us get momentum, and that momentum has continued through that time period.
You know, you talked about how SsangYong was the toughest decision, but a decision that you decided to take first in this effort to kind of get rid of companies that no longer made sense from a profit point of view. You also talked about emotional attachment. And like life in business, you do get emotionally attached to decisions, to businesses. What has been your way of creating a distance so that you can observe without getting attached?
I come back to the point around company first. And I will also go back to your question on the role of a CEO is to have a wide spectrum where emotions one end of that spectrum and practicalities on the other end of that spectrum, or rationality, and be able to traverse that spectrum, because you have to understand emotion well. You have to understand where people are coming from. It's all about people. You have to understand their aspirations, where they want to go, their fears. You've got to be able to understand what's right for the shareholder as well. What do the financials tell us? And where on that spectrum should one be? And then collectively try to get everyone to making a decision that's right for the company. And to me, that framework helps make those difficult choices.
SsangYong was a difficult choice. What have been some of the other difficult choices that you were afraid of making the choice, but also of the response and the reaction to those decisions?
I would say every single company we exited was a difficult choice, because it's not just a matter of scale. Even for a smaller company, there is something that's invested in there. There are people there. And therefore, each of those choices was a difficult one that we had to consider very closely before we did it. There were a few others that we put on a turnaround mode, and I'm very glad today that many of them have turned around and are on a very good path today. So that's always a difficult path. The second difficult choice was, in many ways, to create a much stronger performance orientation and create a culture which is a very healthy mix of being a friendly and a caring culture to being a strong performance-oriented culture. This is one thing that I would say is unique among what I've seen across the world. You have cultures on both ends. But what we've got at the Mahindra Group, and here again, a lot of this has come from the past, is this very healthy mix between a caring culture and a performance-oriented culture. One where people care for each other, people help each other in what they do, where teams are focused on performance. It's not about individuals. It's about the entire team working together. It's about coming to work every day and loving coming to work because you know that people are going to be helping you in everything you do. That is the kind of culture that we've created. But having the performance orientation aspect along with the friendly and caring aspect, I think was an important part there.
How have you tried to prioritize what the culture should be for the group? And in terms of leadership, walking the talk, in many ways, that demonstrates action. So what have you done, especially over the last 4 years, to demonstrate what the organization stands for culturally?
So I'm going to focus on one specific area on this, Shireen. I'm going to go back more than 4 years. And that specific area is around helping others. Right? It's easy to talk about performance orientation. It's easy to talk about many of the other parts. But let me focus on this one because it's not easy to do. And here I'm going to give you, again, a longish answer to your question because I'm going to go back in time when I realized this part. Early in my career, in my second year at GE, I had been asked to go and be the sales and marketing head for a .com in GE. This was during the .com boom. And it was a fun business. It was setting up a mortgage marketplace in the US. We had got the top 5 mortgage banks on the marketplace. We had 200 brokers on the marketplace. And everything seemed to be going really well. We just got $5 million. At that point was a big amount of funding from the parent GE company for this .com. And as we looked at certain things around how it worked, over time we realized that the technology that existed in 2001 wasn't sufficient enough to be able to tackle the complexities of how the mortgage business was done in the US. And at that point, we went to our CEO and said, you've just given us $5 million, but here is what we've learned along the way. We should not do this as a .com. Let's save that money, fold it in the parent business, which was a mortgage insurance, use that as a tool or a value-added service for our customers. And that's going to be better for the company. And the CEO looked at me and said, are you sure? Because this means that you and the team are going to be out of a job. And I said, I'd rather put myself out of a job than have you put me out of a job 6 months later. I'm not sure where I got the courage to say that at that point in time, but I did. And that evening I called one of the senior leaders in the business who didn't know me and said, look, we've just had this discussion. I'm going to be looking for a new role. And he said, Anish, I don't have time. I'm rushing to the airport, but I'm back on Tuesday. Don't call anyone else. You have a job here. I don't know what it is, but you're staying here with us. Right? So I asked him, I said, you don't even know me. How did you do that? He said, I've heard a lot about you helping others across the organization, and that's what we need here. Right? So to me, that was the learning around the fact that when you help others, you're giving credit to them often for what you've done. And that's a painful process at times. But that enables something that's better for the organization, that creates a better environment, and that makes you wanted in the organization. And which is why through the years, I've always focused on that. And when I came into the Mahindra Group in 2014, the group strategy office, we actually put 20% of our KRAs for everyone as helping others. And we had folks coming in from McKinsey, BCG, Bain, all the top consulting firms. And there was always a topic of conversation saying, 20% of our KRA, everyone's so used to, I need to do ABC to be able to get to my goals and to be able to get to my performance pay. And we have L1 to L5, which is a measure of performance, where L3 is meets expectations. So we'd have these interesting discussions. And I finally got to a way to be able to articulate that well, which I would tell folks is L3, which is meets expectations, is if you can articulate, here's what I've done to help so many people, and this is how I've helped them succeed. L4 has nothing to do with you. If other people come and tell me that
you help them,
and therefore they really value what you brought, that's L4. And L5 is when we don't need to ask anyone, where you can just go to anyone and say, who do you go to when you need help anytime? And in a couple of instances in group meetings, I asked, who do you think is L5 here? Right? And 5 or 6 people shouted out the same name, because that person was always there to help everyone. And folks just knew it, saying, if I have a problem, I go to that person.
But you talked about this realization, and in the journey between sort of hoping that the realization will dawn on your leaders and working through that. I mean, you do deal with your own insecurities, you do deal with your own apprehensions and fears. What do you believe is now the relevant organizational structure. You talked about the way that you're mapping things within the group. And again, there's a lot of conversation on currently on how hierarchical organizations need to be, how lean management teams need to be, how agile and adaptable they need to be in a state of constant volatility and flux that we live in today. What do you believe is the relevant organizational structure for the future?
So I would talk about the key principles because it's different for every organization. A key principle I would always use is to have as few layers as possible. Because hierarchy often becomes something that takes away the empowerment, it takes away the agility in an organization. So fewer layers. Second is a clear alignment between the organization and the priorities of the company. Third is focus on value creation, not on how wide a role do you have. And that is, again, something very difficult for any leader to understand because a natural tendency always is
add more.
Add more. The wider the portfolio I have, the bigger the leader I am. And that's one thing we worked very hard at Mahindra to talk to people about and say, that's not the right way to think about it. The more value you create, the bigger the leader you are. So if you want to do A and B and C and D, you may not do any of it well. But if you focus only on A, you can create a lot more value than actually doing all four. And as we think about promotions, as we think about bigger roles, we're going to look at the value you create, not about how many things you have on your plate.
Speaking of value creation, one, of course, was the aspect of getting rid of things that didn't make sense any longer. And the other was actually identifying engines of potential growth that would fortify you in the future. Take me through that journey. What was guiding the thought process at that point in time for you to say, we're going to double down on this bet?
So having spent a few years in the group strategy office, I had seen many of our businesses and they were very strong businesses. And that's where, again, I go back to what had been built earlier was really the foundation for us to take it forward. And there have been many who've told us, you've got the capital, why aren't you entering new areas? What is the next new area you're entering? There have been many such conversations. I think we've had one as well in the past.
Yes.
And I just look at our business and say there's so much potential here. We've grown organically at 25 to 30% a year for the last 5 years because our businesses have that potential. We've got what we call our growth gems that are very well positioned in the industries, and we want to put more capital behind them to be able to help them grow in multiples. So for us, it was in many ways a much easier choice because we saw these businesses with a lot of potential and we said, let's put our shoulder behind it. Let's put everything we have behind it and enable these businesses to grow. It's going to create a much better outcome for our shareholders. And it has. Our market cap is up 12x in the last 5 years. And it's a function of what we've seen from our current set of businesses growing without really any major acquisition except for the recent one on SML, which again is going to help one of our growth gems catapult into a different league.
But, so far, as you pointed out, with the exception of the acquisition that you've just done of SML, it's largely been organic. But you're now in that wanting to take bold bets. How much of this is going to continue to be organically driven? How much of it is now likely to be inorganically driven? And I know that you're also focused much more on expanding your global footprint. How crucial is that as a priority for the group today, for Mahindra to become much more of a globally relevant brand?
So I would outline 3 specific areas. First is continue the organic growth and ideally strive for a 25 to 30% organic growth every year in our core businesses. Second is international, because having now produced products in India that are of very high quality, we have earned the right to go international and compete internationally. And that's going to be a very important growth vector for us. It will require potentially a different set of skills because we want to be a major player in many international markets. We do believe that we can make in India for the world. And this is one area in automotive in particular where I think India is starting to get to a place where it can become the manufacturing hub of the world. Yes, more needs to be done. We need a broader ecosystem. We need more companies to come and manufacture in India to be able to create that ecosystem. But as we do that, we will get more cost competitive. We have the quality today, and that will allow us to manufacture for the world, not just for us, but for every player that's in India, including the foreign players who come in.
So what is the timeline that you've set for yourself as far as this international aspiration is concerned? What are the benchmarks that you're setting for the team in terms of what they need to deliver on to continue to kind of gather momentum, and at what pace?
So given the history of the group, I have a little more luxury in saying that we are building a business for the next 20 years. So my timeline is the next 20 years and what we need to build. At the same time, we have to deliver results in the short term as well. So we look at it as what are the set of markets we would focus on right now in the next year, in the next 3 years, next 5 years. Our immediate focus is on Australia, South Africa, and Chile. 3 markets that we have been present in for some time. We have 10% share in one of the segments in one of the markets now, 5% in the other. And we want to try to get to 15% in all 3. As we do that, we will then select the next set of markets that we go after and the next set after that. So for us, it is a long-term time horizon, but at the same time, one that we would look at each step as an important one and being able to deliver on each step, creating the foundation moving on to the next one.
How do you believe that you've evolved and changed as a leader? Where do you believe you find yourself on the spectrum of leadership today? And what is it that you would like to see you change about your own leadership style?
I would say, Shireen, a very significant evolution. There have been lots of things that I have not been good at. And,
like what?
So I'll share feedback that one of my managers at Bain gave me very early. This was literally in the first 3 months of my joining Bain after Carnegie Mellon in Boston. We'd gone to a client meeting somewhere in Ohio, and we were driving back to the airport, or I was driving, and my manager looks at me and says, "Anish, you add no value in meetings." So I was trying hard to focus on driving and not on what he was saying, but I asked him, I said, "Why do you say that?" He said, "You don't say anything in meetings. So you may know a lot, but if you don't say anything, you don't add value." And he said, "Let me give you one tip. Use the whiteboard. Stand up and put your thoughts on the whiteboard. It takes the attention to you. You're good at structured thoughts, and you will set your structure there. That will allow you to be able to share what you want to share, and that way you will add value in meetings." I said, "That's a great suggestion." I still get up and use a whiteboard on lots of occasions. That just has become a habit. But that enabled me to come in there and be able to add value. There were many such things over time that I've been fortunate to have leaders and managers tell me that, "Look, you're not good at this." Today, I'm fortunate to have a number of folks on my team that will tell me that, you're not doing this well. And
people in your team tell you you're not doing this well?
Yes.
When was the last time this happened?
So a few months ago, someone came and told me, I said, "Anish, when you send us messages on email versus you talking to us in person, there's a very different tone to it." Because on email, often it comes across as very impersonal and cold. But when you have the same discussion in person, it's a very different tone to it. So, either do more in person or improve the tone on the email. I found that to be a very useful suggestion. Right? But that to me is important for a leader, to have that environment where people can come and tell you that you need to improve on this. And it's a journey for every person. If I put the list of things I wasn't good at, you'd look at it and say, "How did he ever become a CEO?" But it's about the openness to accepting that, and then having the courage to say that, "Yes, that you're right. I am bad at this, and I need to change."
How did you check your ego at the door? Because it's not easy, and it's certainly not easy when you're operating in a position of power for somebody to tell you that you're not doing something right. Egos get in the way. How did you find the grace the humility and the acceptance?
I think those are big words, grace and humility. I look at it more as if there's a job to be done for the company and that's what you put first, you have to do it in the best way that you can. And to be a better person, to be a better leader, you need to be able to get that feedback and have the courage to be able to address it. And this is something, again, maybe there is an element of the US culture that comes in, which is very direct. That helped me learn this early on. I saw myself improving and I valued getting that feedback before it was appraisal time or promotion time, because then it's okay, you haven't got this promotion because you're not good at this. Right? I'd rather get it up front and address it so that by that time that is addressed. Right? I've been in a situation again many years ago where my team had feedback that said that you don't like some of these things that you do. So I actually got all the team together, got a whiteboard again and said...
Again, a whiteboard.
Yes. And I said, look, I've written down a few things that I've heard from you that I don't like. So I want to talk about this a little more. I want to understand, what I should do differently.
As you look at what's happening today, I mean, the transformative pace of technology changing, AI, what are you fearful of? And what do you feel confident of embracing today? I mean, everyone's talking about what this wave of disruption is going to mean as far as organizations are concerned. Will you be relevant? Will you no longer be relevant? As you look at this, are you being driven out of a sense of fear, or are you being driven out of a sense of purpose and relevance?
I see opportunity. This is time for us to get in and establish tech leadership, do more with customers, do more with the products we can create. And for me, this is an exciting time. Any time of change is a time of huge opportunity.
So in an AI world, I mean, how much of that is already a reality at the Mahindra Group? How much of it do you believe you will need to invest in, both in terms of bandwidth and resources, to make yourself future-proof?
So I'll tell you what we've done and what we still have to do. We have a far way to go, but what we have done is first instilled in every leader that they have to be a tech leader. If you are not a tech leader, you can't be a business leader. You can't rely on your CTO to say, here's what you should do from a tech standpoint. Every leader should understand technology. Second is, each of our top 100 leaders has one project that they've got to work on for AI. That's in their organization, an idea that they have, and they've got to show results from there. Third is we've taken teams from across all our businesses and in some ways tweaked our federation model in this particular area and said there'll be one common team that looks at AI across the group, because there will be lots of lessons that we will have from across the group. And that has to focus on delivering results. And then fourth is skilling for AI. So these are the 4 areas that we've done.
How tech savvy are you today?
I'd say reasonably high. But I've always believed that technology is going to be important. As part of my PhD, I had mentioned to you offline, I'd created this network lab environment where we had 30 computers connected for a game that was a stock exchange game with CEOs, stock market traders, and directors in the game. And this was in the early 90s, and I literally took a book and learned how to code and spent nights coding it and creating a network lab.
You talked about gaming. What do you do to reinvest in yourself? Not just as a leader, but also as a person. I mean, what are you passionate about today outside of work?
So for me, the biggest source of energy is spending time with family. And that's something that over the career, I've always believed that weekends should be with family. For my boys growing up, that was a huge thing for them because they knew that they had my calendar for the weekend and they could set it as they wanted to. And that still continues to be the biggest source of energy, spending weekends with family. I do,
do you
end
take
up
calls?
working.
Do you do emails?
I do end up working a lot more on weekends in the last 3 or 4 years than I have in the past before that. So I'm still trying to get back to the balance that I ideally want on weekends. I haven't been successful on that front as yet. But to me, that is, we travel as a family twice a year. And that's something that we all look forward to. Both boys come down to India at least 3 or 4 times a year, even if it's for a weekend at times. And we encourage that and we love spending time together. So to me, that's the biggest source of energy. Beyond that, travel, sports, love playing sports, love watching sports.
What do you play and what do you spend most of your time watching?
So I can tell you what I love playing. I don't think I play it often enough.
Okay.
But cricket, volleyball have been the 2 sports I've loved playing over the years. Table tennis to some extent as well. I love watching American football and cricket, of course.
Let's talk cricket. I mean, is there an innings, a captain's innings that you would like to emulate?
I have a lot of regard for Dhoni as a captain, for how he brought the team together and how he dealt with various personalities in teams. And to me, I come back to the concept of team, because that's the most important aspect. And I'll extend that to American football and my team there was the Pittsburgh Steelers from my days in Pittsburgh. And this is a team that has won 6 Super Bowl titles. Over the last 60 years, it has had 3 coaches. So there's been longevity in each of the coaches. Through that time period, it's very difficult to pinpoint superstars in that team. And to me, that's what I take from sports as to how do you create those teams? How do you have people work together and thereby create a winning record?
Well, speaking of creating a winning record, the last 4 years, you've been able to deliver on several milestones that you had spoken of, and that's a reality today. As you look 5 years on, what do you believe the group will look like?
So first, we will continue our path on value creation that we have. That's an important commitment to our investors. Second is we will continue the culture that we have and the DNA that we have around purpose. That's a very important aspect of the group. And with purpose, the environment around helping others, being a friendly, nurturing environment, and being performance-oriented at the same time. We will enhance the level of diversity and inclusion that we have in the group. That is one that, again, we've made some meaningful strides on, but I still think we have a long way to go in being able to get to a place where everything is equal. There is no question about it. There is no conversation that's required. And that to me is a North Star for that. And we continue to be a place where people look at us and say, that's where I want to be. I want to be part of the Mahindra Group.
What is the best piece of advice that you've received in the course of your career that has shaped who you are today and shaped your journey in many ways?
It's a piece of advice which I didn't understand for many years. But the advice I got was, to get control, you must give up control. And I just struggled with that. I said, I just don't understand what that means. And it was finally my older son who helped me understand that, because I would continue to tell him, here's what you need to do. You need to get to this level to be able to apply to these colleges and everything else. And he just rebelled, as I had done when I was growing up.
You rebelled against your dad?
Oh, yes, of course.
Really? You don't seem the sort.
There are many other elements which we shall not go into at this point. As a leader, the easiest part is to go in and want to control. And we talk about different spectrums. I talked about the emotional versus rational spectrum. The other spectrum is control versus giving it up completely and empowering completely. How do you consciously decide what part of the spectrum you should be on? And in what situation should you be on a certain part of that spectrum?
You talked about Anand and working with him when you joined the Mahindra Group in 2014. I mean, those are pretty big shoes to fill. What was it that he told you, a piece of advice that he gave you that you remember?
So Anand is a remarkable leader. And for me, it's never about filling his shoes. I think it's about his having helped me walk a path which is far better than what I had imagined at one point. And what I've learned from him is find ways to bring out the best in people. I'd come from, I would say, a lot more clinical set of organizations where performance was looked at with a certain lens. And I think what Anand brought was a very different perspective around there's a lot that people can deliver. Look for how you get the best out of them. And that's been remarkable in terms of how we've been able to build teams and how we've been able to get everyone to contribute. And that's helped build a much stronger group. In fact, that has been the DNA of the group that Anand has built over time. But to me, his continuing guidance, mentorship, and I'll still reach out for lots of questions I have. And he'll always tell me that, look, it's your decision. But he'll always give the guidance that I would seek. And that continues to be very, very helpful.
But what was the role that your parents played? And, I bring this up because when I started my career as a young reporter, your father was somebody that I would call up to understand what was happening in the world of pharma. And he was hugely accessible and generous with his time to explain to me the ins and outs of Indian farmer. And I will always have the fondest memories of him. What was it like, growing up?
They played a huge role in who I am today. First was the expectations that they had. Second was, in many ways, the role models that they were. And some of this I've learned, in fact, over time. But my father went out of his way to help lots of people. And I talk about helping others in the professional context. He would always be accessible for people. And to me, that is a trait that I would say I've taken time to imbibe. And it's gradually increased over time. My mother was someone also who was in the second batch of IIM Ahmedabad, set up her own business in the late 60s because she wanted to balance time with young kids as well as career, and ran a business which was making packaging for Colgate and Sivagaigi and others at that point in time, and ran a successful business, finally retired and sold it. So she was amazing in terms of what she's done. And again, the values, the belief that you can do what you want, the importance of balance in life. I think all of those things are important aspects that have got me to where I am today, right? And while on that, I have to talk about my wife and her shaping me, because I would say I had a lot more hard edges, and she's been the one instrumental in softening them over time.
She's polished the hard edges.
Yes. So when I talk about the emotional versus rational spectrum, I was very much on the far side of the rational spectrum, and she's helped me learn over time that the emotional spectrum is very important as well.
Thank you so much for joining us. And for very candidly, I have to say, talking about the journey that you've made so far, the changes that you've not just built within the organization, but even as far as your own leadership style is concerned, I don't think people talk about them as candidly as you have. And so we truly appreciate that. Thank you so much for your time on the Leadership Language today.
Thank you, Shireen.
Well, thank you very much. Well, the fabulous and formidable martial artist Bruce Lee said, a successful warrior is an average man with laser-like focus. We do hope that you enjoyed the conversation that we brought you on this edition of Leadership Language, insightful stories that have helped shape India's successful entrepreneurs. And if you want more, then tune into Leadership Language on CNBC-TV18. But for now, from all of us here on the team, goodbye and many thanks for watching.
and welcome to Startup Street. I'm Arundhati Ramnan, and these are the top headlines from the startup world. Former OpenAI employee Meera Murati's AI startup Thinking Machines Lab lands an investment of $2 billion and is likely to announce its first product in the next couple of months. She left OpenAI in September and launched her venture in February. Ola, Uber and drivers of other cab aggregators go on strike in Mumbai, demand implementation of aggregator rules and pay parity with regulator taxi drivers. Prices rise on taxi apps as lack of drivers lead to surge pricing. Kettleborough VC has launched Fund 2 with a target corpus of 80 crore rupees. The fund has already marked its first close at 35 crore rupees with commitments from family offices and entrepreneurs from India and the US. With Fund 2, Kettleborough VC plans to write initial seed checks of $300,000 to $500,000 and further back them up with meaningful follow-on capital. Culture Circle, a hype and luxury fashion app, has raised strategic funding from OYO's Ritesh Agarwal at a valuation of over 100 crore rupees. The startup claims to be witnessing a 4x growth in business and is currently valued at over 400 crore rupees. Deep Algorithm Solutions, a cybersecurity and AI startup, has raised 10.8 crore rupees in funding from Unicorn India Ventures. The funds raised will be primarily used to scale engineering and threat intelligence teams and accelerate GTM activities in India and Southeast Asia. Meta shareholders have launched an $8 billion trial against Mark Zuckerberg and other current and former leaders, alleging they illegally harvested Facebook user data, violating a 2012 FTC agreement. Testimonies will include Zuckerberg, Sheryl Sandberg, Mark Andreessen, Peter Thiel, and Reed Hastings. Those were the headlines that we're tracking for you this evening. But on what's brewing today, Uber and Ola drivers and other gig economy workers across Maharashtra staged a flash protest at Azad Maidan. The drivers' demands include pay parity with taxi drivers. Rachna Dhanrajani filed this report earlier today.
If you've been struggling to book a cab via Ola, Uber, Rapido in Mumbai in the last 24 hours, then you're not alone. Because either the rides are just available or the wait time is too long, or even if you manage to get a ride, the prices are way too high. Now, all of this is because the drivers are on strike of these cab aggregators. They started on Tuesday, that was yesterday, where there was a gathering that was held at the Azad Maidan, and these drivers got together and listed out a charter of demands. Now, these demands include rationalization of fares, a blanket ban on bike taxis operating on a white plate, urgent implementation of the Maharashtra Gig Workers Act and the activation of the Drivers Welfare Board. Now, all of this was already notified under the MVA guidelines that were issued earlier this month. So, while these associations are happy with the guidelines, what these drivers are demanding is more clarity. One major thing that they're asking for clarity is about the insurance bit that the MVA guidelines came with on 1st of July. The MVA guidelines suggest that the aggregators are supposed to provide insurance to these drivers, but how and what would be the amount and how would be the payout, how would the drivers access it, all of that remains in the unknown, and which is what the clarity is being demanded for. Another major point that these drivers have demanded is uniform policy centrally and not just state-wise, because the MVA suggests that the states come up with the base fare and that's how the fares would move forward. But what the drivers want is a central policy than a state-wise policy. What they are suggesting is what the policies in Maharashtra should be similar to what it is in Telangana or Karnataka. So while they welcome the new guidelines that the MVA guidelines came from the Department of Road and Transport, but what they want is more clarity and clarification than just policy on paper.
So Rachna there with the latest on what's happening with the taxi driver protests in Maharashtra. Now, digital content company Chai Biscuit recently announced a $5 million seed round led by InfoEdge Ventures and General Catalyst. The company says this funding will power the launch and growth of Chai Shorts, a mobile-first short-form OTT platform designed to deliver premium fiction in ultra-short formats to India's next billion entertainment consumers. Designed for Gen Z as well as the rapidly growing Tier 2 and 3 markets, the app will launch with original content in Telugu and scale across multiple languages in the coming months. For more on the significance of this funding and how it will propel growth for Chai Biscuit, join me now is Sharad Chandra, the co-founder of the company. Sharad, thank you so much for taking time out and being here with us on Startup Street. You know, if you could briefly start by telling us about what Chai Biscuit is solving for in the content space and why you're launching Chai Shorts now, you know, because large platforms like YouTube Shorts and Instagram Reels already generate massive demand for short-form video. Aren't you a little bit late to the party, so to say?
No, I don't think so. I think YouTube and Instagram at some level have made a case that people enjoy short form content. But then if you look at the evolution of content, even in YouTube, so when content started in YouTube back in 2016-17, gradually it developed into more structured storytelling. People wanted to watch web series and not just short films. So I think I see a similar pattern here. I think over the last 4-5 years or so, people have gotten used to watching short form vertical content, primarily UGC. What guys like us are trying to essentially do is bring more structured storytelling, bring more drama, bring better produced shows to the audience. So I think there's definitely merit in what we're trying to do. It's like how YouTube and Netflix coexisted in the long form space. I think Instagram Reels and YouTube Shorts and guys like us will coexist.
So the market is large enough to house all of these players in it. If you could sort of, break down how this capital will be allocated across content creation, technology development, and user acquisition for Chai Shots?
So I think primarily we at Chai Shots are content guys. So Chai Biscuit has been in the content space for the last 10 years. So content is something that we really believe in. And our firm belief is that if you make great content, everything else will follow. And we see that in movies, we see that in web series, one great show and all of us are talking about it and we all go there. So I think I would rank content in the first place and consistently good content and therefore money going there. Technology, product, wonderful user experience remain to be our next thing. And probably third is user acquisition. But like I said, if I'm doing great at number one, creating great content, my user acquisition cost should be low. And that is the goal at some level for us.
Sure, and Chai Shots is entering an emerging niche, right, which is premium short-form fiction in regional languages. So from a business model perspective, what does, monetization sort of look like in the short term? Are you going to prioritize subscriptions, ad-based revenue, or strategic brand collaborations?
So strategic brand collaborations is definitely one. We've been doing that in Chai Biscuit already. Most of our web shows are sponsored as well. So that is definitely one revenue for us. Advertising is something I don't see happening in this format because it's already very short. I don't want to annoy my audience with an ad in for a 2-minute video, I can't show a 30-second ad or a banner. So that's not done. Till we build a large size catalog, I think we will also avoid subscription. So that leaves us with microtransactions. We are trying to do something very interesting in this space with a slight twist compared to what everybody else is doing. And we are excited for that. But yeah, microtransactions will be the way to go. So, and this is the way we put it, right? Like if you go to your chai tapri next to your office every evening and have some chai and come back, how does it feel? That is the kind of experience we want to have, we want to give to our users.
So microtransactions and collaborations are what you're going to be focusing on. You say Chai Shots, which, as you pointed out, will do 2-minute-long episodes, will launch in early access soon and aims to sort of release over 100 original shows in the first 6 months, right? That's quite an ambitious content pipeline. Will these be in multiple languages? What financial or operational models have you put in place to maintain both high volume and high quality content delivery at this scale?
So we are already an 80-member team based out of Hyderabad creating content. So we do have that muscle and we do have that backbone per se when it comes to content. I'm not essentially scrambling for content at this point. We do have a fair bit of strength to produce a lot of stuff in-house, which is something we've already begun to do. We're going to launch in less than a month with at least 50 titles live, everything original, cultural, made in India, made by us, made for Telugu. We do want to go into other languages as well, but to begin with, I want to reduce the variables in the equation. So this is a market we understand. There's a product that we don't essentially understand so much. So we want to start with something we know in the equation, which is the market. And then we'll start expanding into other languages as well very soon. But the plan to launch in other languages also comes with some amount of belief that content is culture. And unless I'm able to create culturally relevant content in a different language, I'm not just dubbing and putting it up. So I want to maintain that balance between having some culture content plus some dubbed content. So we will take some time to get into each language.
Sure. And, like you pointed out, in a competitive digital content ecosystem, right, user retention is sort of king. So how are you thinking about the lifetime value of a Chai Shots user? And what early indicators will you be tracking post-launch to sort of justify scale-up investments?
No, I think if I'm able to launch 1 or 2 wonderful shows that people enjoy watching every month, I think you have a winner at your hand. And in content business, that's very difficult also. So I think the answer to your question is we hope to consistently generate great content and provide our users with the best possible entertainment in this format. And that's how we hope to retain them. And regional markets have always been proving to us that they're very content hungry. So I think that's what I'm banking on.
Okay, all right, Sharad, thank you so much for taking time out and being here with us on Startup Street. And moving on, India's beauty tech space just got a major glow up. Cult, a next-gen discovery platform, has raised $20 million in a Series A funding round. The round was led by the M3M family office. With AI at its core and personalization as its promise, Cult is blending tech and beauty like never before. The goal, to simplify how Indians shop for skincare and makeup with smarter recommendations, inclusive visuals, and a curated global catalog. Joining us now to discuss this further is Karishma Singh, the founder and CEO at Cult. Karishma, thank you so much for taking time out and being here with us on Startup Street. You know, like I pointed out, you're a beauty tech and discovery platform. If you could sort of take us through what inspired you to build Cult and what was the gap that you saw in the market?
Hi, thank you for having me. And just to answer your question, you see, all my experience has been through investment banking, right? So I was very fortunate to observe businesses from a close seat, a lot of digital first businesses. But when I looked at beauty and e-commerce, and I was an avid user throughout, it seemed very outdated. It seemed very broken, right? So we don't have any offline retail infrastructure in India. It's still very, very nascent compared to the West. So as a user, if you have to decide, okay, what is the product that I want to buy, which sunscreen to use, what lipstick to buy, it would take you like hours of research on the internet, right? Because the most traditional e-commerce players have the same copy-paste template where they will list the products, a consumer needs to search a product and then scroll through thousands of options. And that is the problem that we are trying to address here, where we say that can a consumer come onto the platform without, knowing what they want to buy and still are able to make a decision. And we are using a lot of AI and personalization to enable that.
Right. And, India's D2C market is sort of an overcrowded space to say. So if you could take us through the firm's AI-driven personalization and what actually works behind the scenes and how do you sort of stay ahead of competition?
So I'll give you a little context here, right? So to set things into perspective, when we look at any other e-commerce player, right, whoever that be, it can be in fashion, it can be in beauty, and I'm talking about the mature players here. Most of them, when they claim personalization, they are talking about, say, segmenting their users into 30 or at max 40 personas, right? As compared to that, when you look at Cult, within just skincare, we have over 96,000 unique skincare personas, right? So that's what we mean when we say hyper-personalized. It's not an approximation, it's a one-on-one. And how that works is we approach it category by category. So it's very different the way it will work in a skincare. So when a consumer comes in and gives us a little bit of information about their skin and needs, eventually what happens is the algorithm is able to give them for each product, what the relevancy score is for this product for this particular user. Even the product descriptions, right? These are not something we write manually. These are all automated, generated for each user. So you'll see a different product description and I will see a different product description. And in makeup, it goes very, very different, where for each product, like up until now, the industry, when you say, oh, this color is a red or this color is a pink, they would approach it manually.
Right. And
yeah.
Sure. And you've raised this $20 million. If you could take us through how you're planning to allocate these funds?
Yes. So we've just finished our 20 million fundraise, like you mentioned. A significant chunk of this capital will be utilized in scaling our AI behind our product, right? So we are talking about not just one feature or a chatbot, we are talking about touch points across apps. So whether it's your routines, personalization, dynamic imagery, dynamic kits, right? So we will be able to offer a radical experience within the category. And of course, we will also be scaling our assortment. So some part of the capital will be utilized secondly for that. Our core focus is on partnering with a lot of international beauty brands exclusively. And of course, scaling the business, scaling the orders, that's one of our goals for the next 12 months.
Yeah, and speaking about scaling your orders, you aim to process 10,000 orders a day by the end of 2025. So what's the roadmap to sort of get there? And how many new products do you hope to onboard?
So currently we have almost around out of 250 brands that we have on board, we have 15 brands which are only exclusive to Cult. These are international brands. Over the next 12 months, we are looking at least 40% of our assortment exclusive to us, right? So we are looking at somewhere around 40,000 SKUs is what towards the end of 12 months we will be. And to achieve our orders, our core four fundamentals remain the same. It's scaling the assortment, which is going to be differentiated, but also a differentiated experience using AI to help the user discover, right? So it's one thing to partner with an international brand and list it on the platform, but it's another thing where a consumer can come and actually discover whether this product will work for them and whether they want to transact.
Sure. And if you could sort of take us through your current presence, what's the expansion plan on this front? Any new geographies you're looking to enter?
See, beauty in India, it's a very pan-India approach, right? So it's not like it's just the metro cities or the tier 1 or the tier 2, right? Even though we are a young company, we've already served over 6,000 pin codes, right? So we are already present pan-India. Having said that, our current operations are fulfilled from Delhi and NCR, right? So our warehousing and fulfillment is here. Over the next 6 months, we would be scaling it to the top 10 cities to be able to offer a better, delivery timelines. That's our focus.
All right. And if you could quickly tell us, if you could take us through your business model, what's the kind of revenues that you've clocked and where do you hope to end this year?
So currently, because like I said, we are a young company, we are seeing a lot of traction. We are growing our orders every month, 100%. And for the next 12 months, our goal is to sustain this, right? So have 100% month-on-month order growth. And some of the matrices that we track, right? One of the key indicator in our business is something called average order value. Our current average order value, surprisingly, is 2,800 INR, which is way, way ahead of the industry average, which currently stands at 1,900. So these are some of the key, very encouraging feedback that we've received on our platform.
All right, great. Karishma, thank you so much for taking time out and being here with us on Startup Street, and we wish you all the best going forward with this.
Thank you. Thank you so much.
On that note, it is time for us to head into a short break. But coming up next, in a bid to boost India's MSMEs, Shiprocket unveils Shunya.ai, the country's first sovereign multimodal AI engine. More on that on the other side. Stay tuned. Welcome back. You're still with us on Startup Street. In a major push for India's MSME, Shiprocket has unveiled Shunya.ai, the country's first sovereign multimodal AI engine. Built in partnership with UltraSafe, Shunya.ai is trained on Indian commerce data, supports 9 Indian languages, is hosted entirely within India, and promises to be a digital co-pilot for over 1 lakh small businesses. To understand how this move fits into its larger roadmap for Shiprocket, Aishwarya Anand caught up with its CEO, Sahil Goel.
So Shunya is India's first multimodal and agentic LLM that we have launched for Indian businesses. And it's hosted in India. It's trained on Indian data sets and public data sets. The second thing is on agents, right? Agents are important because it allows us to extend the LLM, right? So if you wanted to use it in a business case to integrate GST or make a payment or book a flight or make a web search as we do today on the other LLMs, right? That agentic capability is what gives it business legs because it can really help MSMEs do a bunch of things and literally like having a 24/7 digital employee, right, over time. That's the vision to help the smaller businesses. And then the tool also can be used for enterprises to actually help them launch workflows, automation, building their own models, for example.
How many languages currently is Shunya AI supporting? And, what is going to be the translation for over 1 lakh small businesses that you have already?
Yeah, so I think we have 9 languages today, natively built into Shunya. The plan is to continue launching, per common use. And for the 100,000 plus businesses that already are on Shiprocket, we are releasing every week. You'll see us kind of doing some announcements on, for example, releasing an API and an enterprise dashboard. We'll be releasing a few agents, right, that basically businesses can use out of the box. To give an example, we'll be releasing agents around saying connect your Google Analytics, for example, and ask questions, right? Okay. And you will also see us focusing a lot on voice. Right, whether we do it ourselves or we partner with the industry, because I think India needs India's voice first.
And what role is UltraSafe and L&T Cloudfinity is playing in developing Shunya AI, and how does their involvement enhancing the platform's capabilities?
So this joint venture between Shiprocket and UltraSafe is the technology partner. So they've had the technology to build and run and train models and host them, etc., etc. This model for Shunya Mini and Mini X1 was built jointly.
So your early pilot has suggested that 30 to 40% time savings for SMBs, right? So I want to understand which specific workflows are seeing the most dramatic efficiency gains.
Yeah, see, I think this is we haven't launched it yet, right? Hadn't launched it yet till today.
Correct.
So we'll see as we go along the way. But from our current platform, what we have learned, like even the non-Shunya AI stuff that we had been building in the Shiprocket platform, like I said, I think voice, the ability to, let's say, search and filter by voice, right? I think or by typing, will become the standard user experience is our prediction. So I think that is where merchants are getting insights. It's less about productivity and gains for them because the SMEs we work with are 5 or 10 people. I don't think their biggest problem is how to operationally become efficient in terms of cost, right? I think their biggest issue is how do they grow their business and how do they get to know what they don't know.
So how are you monetizing this? Especially when we speak about smaller merchants, they're very price sensitive. So how are you aligned on that front?
So 100% built for India pricing, right? It's $499 a month, right, for unlimited usage, of course with a star. But compare it to ChatGPT, it's like at least less than half, right? At $20, which is about $600-700 a month, right? So it's pretty cheap. And also we will build agents which are India specific. For example, the first agent that's launching is with Shiprocket, which means that on Shunya you should be able to do all things Shiprocket from that chatbot.
And how do you see this translating in terms of revenue for Shiprocket going forward? If there's a target, if you could have any.
There's no target. I think right now this just came out of the lab, so to speak, right? And it will be pretty much in beta for a while. So I don't think the focus immediately is to try and peg a huge monetization target on it. But I think everyone knows where AI is heading, and everyone knows that this is going to be the way we consume information, right, going forward. There's no question about it. So us making a pretty big, foundational step there, I think is a huge indication of what we believe can happen in the, let's say, in the 5 to 10 year period.
Okay. Though I know you're in your silent period, but I'm still going to ask you this question, that you've filed your DRHP in a confidential manner. So I want to understand that, factoring in Shunya, what is the kind of market proposition that you're looking at going forward, and where will the proceeds go to from the IPO?
See, I think we have always been a technology-focused company, tech and data. Our focus now is on, one, going after offline merchants, right? Right now we work with digital natives, right? Where we work with over 150,000 merchants, which are typical like e-commerce websites and Instagram sellers, et cetera, right? Brands, D2C brands. But what we're finding is, especially with quick commerce kind of becoming a way consumers are shopping, that even offline merchants in especially similar categories, so clothing, fashion, accessories, electronics, things like that, they are getting demand digitally.
Yeah.
And then they want to service it through like a rider, right? Which is also a kind of e-commerce. So we are starting to get into that segment. So a large part of our acquisition cost over the next, or focus, or branding focus, is going to be on this new market, right? Okay. And all the engineering effort, whether it's AI or other innovation, is continues to be our main area of investment, because as a company we don't actually, as an operating system, we're not asset heavy, we are asset less, in fact, right?
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
Hello and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra. The governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points, again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time.
Thank you. Thank you for the opportunity to be here.
So, first up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8 and the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go, in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than, the current data which we have, now only for Q1. Rightly, you have said that it has come down. But how is it going to look like going ahead? And, we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations, we are still in the process of doing them. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore, take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast, therefore, the outlook is lower, the growth is lower, certainly, the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than, the 2.1% or the current inflation that we have.
Okay. So what you're saying is when you are looking at the neutral rate, it is not the current inflation minus repo rate minus current inflation. Will it be more repo rate minus 12-month forward inflation? Because in the MPC minutes, members are doing both. They're looking at current inflation. Some of them are looking at some points at 12-month forward. Where will your accent be?
See your this real rate, first of all.
Yes.
It is the long run rate, interest rate, at which the economy is to be, in a neutral state or a state of equilibrium or a state of steadiness. Now, it's very difficult. First of all, it's very, very difficult to calculate this. It's not observed. It's an estimate, and it's a difficult thing to estimate.
Yes.
Even, because you mentioned about this
real rate.
Real rate. So let's be very clear, that this is only a guidepost. This is not a precise number. Even in India, we have a range 1.4 to 1.9 or thereabouts. Even, in the US, they have a range. Each member, gives a very, very different estimate of this. And so John Williams, who's an authority in this, in fact, he says that, this is not a this star, the so-called star, is not a bright point of light, but it is a fuzzy blur. So it's imprecise, and it's moving, it's changing. So while that is important, it's only a guidepost. Coming to your question of
12-month forward.
12-month forward, or whether it is the current inflation, as I already mentioned, monetary policy is forward-looking. And so for us, what is more important is the inflation going forward. But inflation going forward, you don't know, I don't know.
No.
It's only an estimate.
Yes.
It's an outlook. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Okay, let me persist with this just for one last question. See, the inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, is it 1/3, 1/3, 1/3 hike, pause, cut? Or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI? And
no, see, firstly, let me say that monetary policy, as I'm mentioning, it is forward-looking. At the point of time when the MPC met last in June, the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The average of the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards.
Okay.
And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. Well, sir, that's on the rate cut. Let me come to the VRRR, the liquidity issue. Now, when you do, what are the triggers you look at when you take the VRRR action? Do you want to only impact the call rate and ensure that the call rate is at least above SDF 5/4 to 5.5 range? Or do you want the TREPS market, which is, a very big interbank market where even mutual funds participate? 90% of the overnight exchange of money happens in the TREPS market. So will you target that also and want it to come to 5/4, or only you look at call rate?
See, the operating target for the monetary policy is very, very clear, which is the call money rate. And so we are looking only at that. We are not looking at the TREPS rate or the market repo rate or the collateralized money market rates. That's certainly not something that we are targeting. Of course, we look at it. I may also mention to you over here that these are although they are very, very different markets, because one of them is collateralized, other is non-collateralized, the other has, the participants are very, very different, right? Over here it's mostly in the non-collateralized market, it's the banks and the primary dealers, whereas over there you have the mutual funds, you have the insurers, provident funds, etc., etc. So they are very, very, although their composition is very, very different, they move in tandem. And we did an analysis, the coefficient of correlation between the two, both call money market rate and your market repo, 0.98. 0.98 is very, very high. Any economist will know that. And similarly, the TREPS rate and the call money rate is 0.98. Both of them. One is 0.977, the other is 0.983 for the last 1 year.
Yeah.
So they are very highly correlated. They move in tandem if we target. So it's really not material so much, I would say. Okay. If you target one, the other gets targeted on its own. Okay. And it's not true, only for the non-collateralized market, even for the CP, CD, Treasury bill, and so on, the whole spectrum of the money market. So that's how, we are looking at
which rate to target, which is your target, call.
Yes.
Which is your call rate. Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate? As you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly within the corridor, which at present is 5 quarters to 3 quarters. And while we would like it to be at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well. On new loans, there is a 24 basis points of transmission already till May. Okay. We have data only till May.
Yeah.
Which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning, it was 544, so it's quite close.
Yes.
Friday, it closed at 545. And so our effort will be to, while, maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Okay, it should help you.
These are the two factors which will continue to guide us.
Okay. No, it's fair that, transmission is a very important instrument, and you have the freedom from 5 quarter to, 575. But would you say we are still in early stages transmission?
Yes, of course. Because, see, when I said May, I have figures till May, that's only 3 months. And in June, we cut by 50 basis points. So there's a long journey, yet. 100 basis points. As against 100 basis points, it's still, I do not have the figures for June, but till May it was 24 basis points. My sense is that it has, of course, improved, but there is still distance for us to cover over there.
Just a final question on this repo call rate thing. When will the liquidity framework be published? Because the market is very anxious as to what rates.
There is an internal working group which was constituted. They have had extensive consultations with various stakeholders, banks, economists, etc., etc. There are multiple views, as with multiple stakeholders, with divergent interests, which is.
So when does it come out, you think?
As I mentioned to you, it's not such a major issue.
Okay. No, I'll tell you
why.
why.
As I said, it's not a major issue because, As I mentioned to you, the call money, one of the important issues that this internal working group is actually deliberating upon is that what should be the operating target.
Yes.
As I mentioned to you, they move in tandem. They're very, very highly correlated. So that's really not a major issue, even though, as you are saying, the volumes are less, but the impact is, throughout the spectrum. So that's not, the report should be out, by the, I think, by the end of this month, we should have the report out. I do not expect major changes. We are trying, of course, to increase volumes in the call money market. We extended, the times for the markets.
Yes.
Made some improvement. We'll see how, we can further improve these markets. Let me emphasize that these are two different segments with two very different regulatory regimes. Some of them, we don't even regulate. And so, we need to keep that in mind when these questions are actually
In any
addressed.
case, as you say, the coefficient correlation is very high. Now let me come to the other big announcement you made on CRR, the big CRR cut. What is the trigger? Was it that our current account deficit is now under 1%, so we won't need so much money for intervention like we needed during Lehman crisis and all that? Or is it more because there is a lot of LCR? What's the trigger?
See, first of all, it's not a prudential tool. So LCR, is more of a prudential tool, right? It's not a liquidity tool. It's a liquidity tool for the banks.
Yes.
Not a liquidity tool for the system as a whole. You understand that, and so would your viewers. So it's more, of a monetary policy tool for the liquidity management of the system. Now you are aware, it used to be very high, 15% and all. 2006, we had this amendment in the Act. It's now, and then, later on it was brought down in 2013 to 3%, to 4%, sorry. Earlier we used to give an interest. And post the amendment, there is no interest. Interest has a bearing, because if you pay in interest, then you can have a higher CRR. The effectiveness of the CRR, however, decreases if you have the payment of an interest. And so that's why gradually, post 2006, it was brought down to 4%. 2013 to 2025, we have decreased it a few times, but never below 3%. So we have used only
very sparingly.
Not only very sparingly, the amount is only 1%. The ammunition that we have is 4%. We can pass on, 4%.
Yeah.
I can always withdraw as much as I want, from 4% to 5, 6, and there is no ceiling. But the amount that I can give, because I can't go in a negative zone, and start, which also I can, in fact, I can start giving money, right? So I can go in a negative zone. But assuming that, I don't go into a negative terrain, I have the 4% cushion, which last 12, 13 years, including COVID, we have used only 1%. So, and it has a cost, as you are aware, it has a cost, and the cost is not only on the bank intermediaries, it gets passed on to the depositors and to your borrowers. And so, while, we have provided this certainty, you can always ask us, as to why we did it now. If we had to actually implement it from September onwards, why we did it now? But that was only, as we have been saying, we have been preemptive, we have been, so that, it gives us, in these uncertain times, to our banks, a little more certainty to plan things out. And so that is the new kind of a normal, that I was talking about earlier.
Ownership of banks. You said that there is a review. Personally, what is your opinion? Would you want at some point conglomerates also to have banking licenses?
This is a very, very old question. This is a very...
It doesn't go out of fashion, sir.
Yeah.
Or out of the desires of conglomerates.
Yeah, so I think this question primarily comes from the fact that some of the corporate groups, they have deep pockets. And the banking industry, at the same time, needs capital, whether it is the existing banks or whether it is, the new banks. So that's certainly, a valid question. But at the same time, let's also keep in mind that conducting business, financial business and real economic activities within the same group has a conflict of interest. And I would say, that this counter argument is equally valid and equally relevant even today.
Okay, you were talking about that you will review bank ownership rules more in the instance of.
Yes, we are of course reviewing it and see, as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks. How we can change some of these, the foreign banks. How we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really. Yes. There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission. Right. Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So, what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So, as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%.
Yes.
All right. And the foreign banks can actually start business in our country
100%.
as even up to 100%.
Yes.
So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So, I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%.
Okay.
So if you don't allow them even 26%,
yeah,
that kind of seems to defy logic.
Yeah.
So we will be okay in allowing them, or whether it is on a case-to-case basis, whether it is as a general matter of policy. These are matters of detail which we'll work out.
Okay. Fine. Now let me come to small finance banks, which you already alluded to. You have eased the priority sector requirements from the earlier 60% to 40, from 75 to 60%. Will you see more reason to ease the rules further?
Yeah, we change. See, small finance banks can actually transition to the universal banks. And so this change that we did was primarily because the PSL targets requirements for universal banks at 40% was a huge difference. And so that would certainly, have impeded their diversification and their transition into universal banks. We consider the small finance banks as nurseries for universal banks, and it will certainly be our endeavor to provide them the right climate, the right regulatory regime, so that they not only grow as small finance banks, but they graduate into universal banks. Our regulations are not fixed in time. They are not frozen in time.
Yeah.
We keep evolving, we keep changing with the times. We have come out with you are aware, with a regulation making framework where we have said that we'll be reviewing each and every regulation every 5 to 7 years.
Yes.
Of course, we do it continuously, but as a practice, every 5 to 7 years, each and every regulation, so that we are aligned, with the times. So that is something which is applicable even for the small finance
banks as well. Okay, more generally, if you look at banks, they have a lot of obligations. They have SLR obligations or LCR obligations. They have PSL, a priority sector, and then they have CRR, which was all okay. All this is a cost to the banks, which was okay when they were the king of all the savings. My father saved only in FDs, and perhaps that would be true of your father. But increasingly, mutual funds have become far more attractive for the savers. So will you consider even more of the constraints on banks need to be removed, giving them more of a commercial chance?
No, see, as I mentioned to you,
you removed CRR by 1 percentage point, but more.
Not only CRR, we also changed priority sector lending guidelines that will help them. And over a period of time, changes have happened for the whole regulated space, not only banks, even the NBFCs, etc. All these, as you are mentioning, they have a purpose. It's not, that they are not without a purpose.
No, they all have it.
They all have a purpose,
Either prudential or.
Either prudential or liquidity or, stability or a socio-economic purpose, like the priority sector loans. But we do recognize, as you are mentioning, that they have also costs at the same time. And as I have, and these are trade-offs. So these trade-offs we have to balance.
Yes.
And we have been doing this. RBI has been, doing this. Yosef mentioned, CRR was reduced, LCR, was amended to
tweaked.
Was tweaked. SLR was brought down. It used to be very high, 18%. Now it's only perhaps lost its relevance to an extent. Right?
Yeah, it's become mainstream.
So RBI has been very nimble-footed. We have always kept in mind and tried to balance these trade-offs. As I mentioned, we have now come out with a regulation-making framework.
Joining us in a special chat today, we have India's golden boy who's bringing glory to the nation at the global stage, one throw at a time. We have Neeraj Chopra joining us today along with Tushar Gokuldas, who's the MD of Underdog Athletics. Their campaign together that they worked out, Zid for More for Under Armour, has been a raging success which showcased Neeraj's relentless training sessions and his mindset. नीरज, सबसे पहले जिद फॉर मोर के बारे में ही बात करते हैं क्योंकि मुझे बहुत पसंद आई आपकी ये कैंपेन अंडर आर्मर के साथ। आपकी जो जिद वाली फिलॉसफी है वो किस तरह से दर्शाती है ये कैंपेन नीरज?
नहीं, बिल्कुल, सबसे पहले तो बहुत ही अच्छा लग रहा है आपके साथ, तुषार जी के साथ और अंडर आर्मर स्टोर में हैं। तो जिद फॉर मोर दर्शाती है इसको, मैंने अच्छे तरीके से बताया है कि अगर अच्छे तरीके की जिद हम करें तो वो बहुत ही अच्छी होती है। जैसे कई बार हम ट्रेनिंग कर रहे होते हैं और थक गए हैं, फिजिकली हम बहुत ज़्यादा थक गए हैं, लेकिन मेंटली हम अपने आप को पुश करते हैं और ज़्यादा, ये पता होते हुए कि हाँ हम और ज़्यादा कर सकते हैं और हमारे अंदर और कैपेबिलिटी है, हमको रुकना नहीं है। तो उस तरीके से, ऐसे नहीं कि भाई हम ख़राब फील कर रहे हैं, ऑलरेडी थके हुए हैं और फिर भी और हमें इंजरी होने के चांसेस और फिर हम जिद कर रहे हैं, तो वो अच्छे तरीके की जिद है कि भाई हमको और करना है। क्योंकि अगर हमको अलग दिखना है और अलग बनना है तो हमको और ज़्यादा ट्रेनिंग करनी पड़ेगी। तो जिद फॉर मोर, तो जिद करो और अच्छी जिद करो और ज़्यादा ऊपर जाने के लिए।
मिड मई में ही आपने वो 90 वाला मार्क क्रॉस किया, तो कैसा लगा? किस तरह के इमोशंस थे आपके वो 90 क्रॉस करते हुए, 90 मीटर को क्रॉस करते हुए?
बहुत ही स्पेशल था क्योंकि वही एक ऐसा बार बार एक अचीवमेंट ऐसा रुका हुआ था, क्योंकि सभी वर्ल्ड क्लास कॉम्पिटिशन्स है, ओलंपिक लगा लो या वर्ल्ड चैंपियनशिप, डायमंड लीग, एशियन गेम, कॉमनवेल्थ गेम्स, तो सभी में अपने पास जेवलिन में गोल्ड हो गया था, तो जेवलिन ऑलमोस्ट कंप्लीट हो गई थी। तो एक 90 मीटर का वो मेरे माइंड में नहीं था, लेकिन वो सब लोगों को ये था कि 90 मीटर क्रॉस करना है। और ये जो हर 10 मीटर का बैरियर है ये बहुत ही ज़्यादा होता है। 80 मीटर मैंने 2015 में क्रॉस कर दिया था, तो अभी 2025 चल रहा है, तो 10 साल लग गए ये 10 मीटर को बढ़ाने में। तो ये बहुत ही टफ था और ये मैं बिलीव कर रहा था 2018 से कि मैं कर सकता हूँ, क्योंकि मैंने बहुत ही क्लोज किया था, एशियन गेम्स में 88 मीटर थ्रो किया था, तो तब से मुझे लग रहा था कि मैं कर सकता हूँ। लेकिन फिर भी कंसिस्टेंट तो मैं बहुत था, लेकिन फाइनली एक रिलीफ मिला कि यार ये हो गया है। सबसे बड़ा रिलीफ ये था कि अब आप पूछ रहे हो कि कैसा लग रहा है 90 मीटर क्रॉस, पहले बोलते थे कब कर रहे हो 90 मीटर तो वो
तो रिलीफ वाली फीलिंग थी
और एक बिलीव बढ़ा है कि नहीं अब और अच्छा हो सकता है। क्योंकि मेरे हिसाब से वो बेस्ट टेक्निक या बेस्ट, मतलब मेरा बेस्ट नहीं था उस दिन जो मुझे फील हुआ, तो और अच्छा हो सकता है।
और अच्छा हो सकता है तो कितना अच्छा? अगला टारगेट क्या है? 10 साल लगे आपको 90 मीटर क्रॉस करने में, आपने बताया, तो अगला आपका टारगेट क्या है?
बस मुझे ये लगता है कि एक बार वो होता है ना कि आपको एक जिस चीज़ का एक वो बिलीव मिल जाता है। अब वो मुझे डिस्टेंस मिल गया 90 प्लस का, अब वो मेरे माइंड से हट गया है कि 90 मीटर क्रॉस करना है, अब वो हो चुका है। अब मैं यही कोशिश करूँगा कि स्टेप बाय स्टेप, मैं ये नहीं सोचूंगा कि अब मुझे वर्ल्ड रिकॉर्ड के लिए थ्रो करना है, अब मुझे 92 तक, 93 तक ऐसे थ्रो के लिए तैयारी करनी है। जब वो क्रॉस हो जाएगा तो स्टेप बाय स्टेप फिर अगले टारगेट के लिए सोचेंगे।
सो वन स्टेप एट अ टाइम, ये फिलॉसफी है। तुषार, Neeraj has been associated with Under Armour since 22. You mentioned how, like, it could have been much before that. So tell us, working with him, what has been one of your standout moments, working with Neeraj?
One thing that kind of really endeared me to him is he's very caring and compassionate personality. ये सबका ख्याल रखते हैं। इनका स्पोर्ट ऐसा है जहाँ पे he's an individual athlete. There is no team, लेकिन he treats everybody as his team. बाकी javelin athletes भी, which I was surprised, पहली बार मैं यूजीन में जब मिला, I thought कि ये सारे competitor हैं, लेकिन इवेंट के बाद सब गले मिल रहे थे, हंसी खुशी से बात कर रहे थे। I was taken aback कि इतना intense competition जहाँ one-on-one हो रहा है। And even the other younger Indian athletes, he's very caring and compassionate and takes care, guides them, helps them, क्या खाना है, कैसे train करना है। I've seen this over the last 3 years multiple times. So that's something that really stood out for me as an exceptional part of his character, and which makes me really admire him and like him even more.
Yeah. Neeraj, because Under Armour focuses so much on performance gear and you're the topmost performing athlete in the country, तो किस तरह का feedback आपने दिया है Under Armour को gear को लेकर और किस तरह से लेते हैं ये feedback?
नहीं, बहुत ही डिटेल में लेते हैं और हर एक चीज़ हम बात करते हैं। हमने बहुत ही ज़्यादा काम किया है बीच में कि हम जेवलिन स्पाइक के ऊपर काम कर रहे थे और हमने काफ़ी अच्छे स्पाइक बनाए और बहुत ही डिटेल में हमने बातें की, प्लस गियर के बारे में, शूज़ के बारे में कि मुझे मकीना अच्छा लगता है और तुषार जी फिर उसके बारे में प्रॉपर बताते हैं कि अब हमने उसके ऊपर वाला वर्जन कर दिया है, अब मकीना का ये वर्जन आ गया है। तो बहुत डिटेल में बातें होती हैं, जो कि अब रखे हुए सब शूज़ ऐसे ही लग रहे हैं नॉर्मली, लेकिन वो प्रॉपर कि भाई अभी वेलोसिटी है, फैंटम ने आया है, तो बहुत ही डिटेल में बातें होती हैं। प्लस मुझे गियर में बहुत ही अब मुझे काफ़ी सारे लाइफस्टाइल क्लोथ्स भी दिख रहे हैं कि भाई पहले हम ज़्यादातर परफॉर्मेंस में ज़्यादा काम कर रहे थे, जैसे प्रोजेक्ट रॉक भी परफॉर्मेंस के लिए था, लेकिन अभी लाइफस्टाइल भी काफ़ी ज़्यादा आने लगे हैं। तो वो काफ़ी अच्छा लग रहा है कि हाँ, कि इतने कंफर्ट हैं। और मुझे तो बहुत ज़्यादा शुरू से ही बहुत ज़्यादा पसंद था कि जब मैं बाहर जाता था तो अंडर आर्मर के टाइट्स और ये और कंप्रेशंस, ये इनके डिज़ाइन बिल्कुल यूनिक होते थे। तो मैं बहुत ज़्यादा खुश था जब हमने आपस में बात की और अंडर आर्मर के साथ एसोसिएट।
ग्रेट। एंड आपने बहुत अच्छी बात कही कि लाइफस्टाइल के कपड़े भी अभी स्पोर्ट्स परफॉर्मेंस स्पोर्ट्स वेयर की दुकान में मिलने लगे हैं। ऑन दैट नोट तुषार, आई वांट टू नो दैट the line between what qualifies as sportswear, athleisure, everything is blurring. So what does that mean for business for you?
See, many brands have taken this to a very different extreme level. Our focus as a brand is of course athletic performance. However, even athletes need something which is an intermediate product, garment to wear when they are not in their intense training. So, before training, after training, there are opportunities to equip our athletes with product that looks great and also delivers a certain level of performance. So that's the kind of extent to which we are going. We are not anywhere close to going into fashion or complete lifestyle, but it's very comfortable, high performance gear that also looks great in whichever circumstance or situation you want to wear it.
Neeraj, जैसे मैंने शुरुआत में कहा कि you're truly the golden boy, not just for the Indian sport, but also in the world of brands these days. From Under Armour to digital payments to beverages, you seem to be endorsing every other brand. So how does it feel? How does this entire attention feel for you as a sports person?
नहीं, बिल्कुल, जब ये ज़्यादातर ये सब सारी चीज़ें मैंने टोक्यो ओलंपिक्स के बाद ही फील की और बस मेरा एक ही मन था कि परफॉर्मेंस और स्पोर्ट्स पे पूरा फोकस रखना है, क्योंकि इसी की वजह से सब कुछ है। और अगर सब कुछ मुझे और ज़्यादा आगे बढ़ाना है तो सबसे ज़्यादा फोकस मुझे अपनी परफॉर्मेंस पे और स्पोर्ट्स पे रखना है। तो बहुत ही अच्छा लगता है।
किसी दिन आप अपना खुद का ब्रांड लॉन्च करने के बारे में सोचेंगे, नहीं सोचेंगे? क्या ख्याल है इस चीज़ का?
बिल्कुल, काफ़ी सारे एथलीट्स एग्जाम्पल हैं, माइकल जॉर्डन और स्टेफ करी, या जो अंडर आर्मर के साथ एसोसिएट हैं, और मतलब बहुत सारे ऐसे एथलीट्स हैं। तो बिल्कुल ऐसा कुछ हम भी सोच सकते हैं। अब वो देखना पड़ेगा, वो प्रॉपर टीम लगेगी कि भाई कैसे हम इंडिया में उसको कर सकते हैं, पर बिल्कुल ऐसा हो सकता है और बिल्कुल पॉसिबल है।
बिल्कुल,
हाँ जी।
I have seen how Under Armour has stayed away from the Bollywood superstars or the cricketing superstars and focused on like phenomenal athletes like Neeraj Chopra. Is that going to be the strategy going forward? And if yes, who else is going to be under the Under Armour umbrella?
See, absolutely, we will continue with this approach. We want to focus on athletes who will bring glory to our nation. Some have already brought a lot of glory, such as Neeraj, and there are many other hidden talents. The next Neeraj could be a male or a female who is going to bring glory, maybe in LA or beyond. Those are the athletes that we would like to partner with, and those are actually our dream athletes. The next athlete that brings a gold, especially in an individual capacity for India. In fact, today, in addition to launching or relaunching this store in its new avatar, We're also introducing 4 new members in our athlete roster who are in Olympic disciplines. There are 2 fencers and 2 track and field athletes. So, you know, when we had the first press conference with Neeraj, he said something which was not clearly in my mind, but that stayed in my mind.
Which is?
He said कि हम आज जुड़े हैं अंडर आर्मर से, लेकिन हम अब एक टीम बनाएंगे. So वो बात मेरे दिमाग में तब से है. So we are slowly building more athletes or adding more athletes to Under Armour, which can be part of the team where Neeraj is a sort of a leader. Though they may be from different sports, but we would like to build that Olympic movement and get help and support athletes who can bring glory to our nation.
वही लोगों को साथ में लेके चलने की फिलॉसफी जिसके बारे में आपने शुरुआत में ही बात करी. लेकिन हाल फिलहाल नीरज चोपड़ा क्लासिक जस्ट कंक्लूडेड with close to 15,000 spectators, national and international athletes competing. आपके लिए एक पर्सनल माइलस्टोन की तरह लगा ये?
बिल्कुल, ये बहुत ही चैलेंजिंग था. खासकर ट्रैक एंड फील्ड, वो भी एक इवेंट में इतनी पब्लिक को लेके आना. पहले तो मैं बहुत ज़्यादा नर्वस था कि भाई इतना हो पाया कि नहीं, कि इतना बड़ा स्टेप लिया तो है. प्लस वर्ल्ड एथलेटिक्स ने हमको एक कैटेगरी का इवेंट दिया था, तो वो बहुत बड़ी अपॉर्चुनिटी थी अपने आप में. मुझे लगता नहीं कि सिंगल इवेंट को इतनी अटेंशन मिलती है. तो वो कहीं ना कहीं मुझे लगा कि यार ये तो अब और ज़्यादा प्रेशर आया कि इसको तो कामयाब करना ही है, इस कंपटीशन को. फिर काफ़ी सारे ब्रांड्स ने सपोर्ट किया, अंडर आर्मर ने सपोर्ट किया, तो सभी ने साथ मिलके फिर मुझे लगा कि यार हाँ सब लोग साथ में हैं. प्लस गवर्नमेंट ने सपोर्ट किया, JSW टीम साथ में थी, तो लगने लगा कि हाँ. और मैं डायमंड लीग पेरिस और ओस्ट्रावा गोल्डन स्पाइक compete करके और काफ़ी सारा ट्रैवल करके आया ही था. और काफ़ी सारी चीज़ें चल रही थी. मैं शूट पे भी जा रहा था, कुछ वीडियो वगैरह बनानी पड़ रही थी. नॉर्मली मैं कंफर्ट नहीं होता इतना. मैं कंपटीशन से पहले मैं सोचता हूँ कि मुझे ट्रेनिंग करनी और रेस्ट करना है बस, और माइंड को रिलैक्स रखना है. और प्लस ये इतना बड़ा प्रेशर था कि इंडिया में ही हो रहा है. यार यहाँ पे तो बहुत ज़्यादा ज़रूरी है, और इससे बड़ा प्रेशर है कि मेरे नाम से ही हो रहा है. तो काफ़ी ज़्यादा ऐसे बिल्कुल जो मैं प्रेशर फील करता हूँ बाकी कंपटीशन में, तो उनको तो संभाला जा सकता है. लेकिन ये कुछ अलग था. मेरी फैमिली भी सभी आए हुए थे. मैं यार इन सभी के सामने तो नहीं हार सकता मैं. एटलीस्ट फर्स्ट एडिशन तो हमको ही जीतना है.
यही मोटिवेशन था.
हाँ, तो काफ़ी सारा वो था. प्लस मैं ट्रेनिंग वगैरह से भी दूर था, और एक वीक में पूरा सब इन चीज़ों में था, तो माइंड बहुत ज़्यादा ऑलरेडी भरा हुआ था सब चीज़ों से. लेकिन स्टिल मैं जब ट्रैक पे था और वो चीज़ लगा कि नहीं यार करना ही है. और उस दिन कंडीशन भी इतने अच्छे नहीं थे, लेकिन स्टिल वो काफ़ी अच्छा कंपटीशन रहा, एक अलग एक्सपीरियंस रहा. और कंपटीशन ख़त्म होते ही जब वो ख़त्म हो गया और पता लग गया कि जीत गए हैं, तो एक रिलीफ मिला कि नहीं यार. और मुझे रियलाइज़ हुआ कि कितना बड़ा प्रेशर लेके घूम रहा था मैं. लेकिन हाँ, वो फर्स्ट टाइम था. अब अगली बार से थोड़ा सा लाइट हो जाएगा, क्योंकि मुझे लगता था कि ये ट्रॉफी सबसे पहले वाली तो अपने इंडिया में ही रहनी चाहिए.
बिल्कुल. और आपने जीत लिया. और जैसे आपने कहा कि डायमंड लीग पेरिस, उसके बाद ओस्ट्रावा, फिर क्लासिक, तो ये जो हाई प्रेशर इवेंट्स है, और इस बार तो आपकी फैमिली भी आई हुई थी, तो किस तरह से आप डील करते हैं इस प्रेशर के साथ?
नहीं, देखो डायमंड लीग्स काफ़ी ज़्यादा हेल्प करते हैं हमको compete करने में और प्रेशर को हैंडल करने में. क्योंकि डायमंड लीग एक ऐसी इवेंट है वो जो साल में हमको 4-5 बार मौके मिलते हैं. और एथलीट्स सेम होते हैं, जो ओलंपिक्स, वर्ल्ड चैंपियनशिप या वहाँ पे जो टॉप एथलीट्स होते हैं, तो वो काफ़ी ज़्यादा हेल्प मिलती है. तो अब जब भी ओलंपिक्स में या कहीं पे खेलते हैं, तो बिल्कुल वो कंट्री की तरफ से खेलते हैं, वो अपना अलग प्रेशर है. लेकिन वो अंदर जब फील्ड पे होते हैं तो ऐसा महसूस नहीं होता कि हाँ हम ऐसा कुछ में, हाँ बस हम फिट होने चाहिए. कई बार एथलीट्स को छोटी मोटी इंजरी है, वो एक अलग बात है कि वो अलग प्रेशर है. लेकिन अब वो अच्छे से हैंडल हो जाता है. और काफ़ी टाइम बाद मुझे लगता है लास्ट टाइम डायमंड लीग विन हमने तब किया था जब लोजान में आप भी वहाँ पे, तो उसके बाद अब काफ़ी टाइम बाद मतलब सेकंड आ रहे थे, तो दोबारा से पेरिस डायमंड लीग में फर्स्ट आए. और फिर ओस्ट्रावा गोल्डन स्पाइक वन ऑफ द ग्रेट कंपटीशन है एथलेटिक्स का, काफ़ी पुराना है, और वहाँ पे पहली बार खेला और जीता. और फिर NC क्लासिक, तो एक अच्छी 3 कंपटीशन ये अच्छे सीरीज में रहे. तो अभी इस साल का सबसे बड़ा टारगेट अपना वर्ल्ड चैंपियनशिप का है, टोक्यो में.
hosting a World Athletics Gold event in India, एक डिसिप्लिन से आपने शुरू किया
जी।
आपने हिंट किया था कि आने वाले दिनों में नए डिसिप्लिन जुड़ेंगे इसके साथ, तो कौन से डिसिप्लिन जोड़ रहे हैं आप?
वो कोशिश करेंगे कि हमारे जो एथलीट्स जिन इवेंट्स में स्ट्रॉन्ग होंगे कि भाई उनको मौका मिले, ऐसे इवेंट्स जोड़ेंगे। बट अभी तो जस्ट वो ख़त्म हुआ है और अभी बातें चलेंगी इस पे वर्ल्ड एथलेटिक्स और सभी से मिलके कि कौन से इवेंट्स जोड़े जा सकते हैं और फिर हम वो डिसिप्लिन ऐड कर सकते हैं।
Tushar, brands such as Decathlon coming into India in a big way and spreading their presence across different markets has also made, gear affordable to the masses. And then there are a lot of these D2C brands that you browse through Instagram, you browse through Twitter and different social media platforms and you get access to that. Are they growing the market for you? What are they doing for, the business?
We operate in a fairly premium segment. So in that sense, we are fairly unique in India. Most of our merchandise is based on innovation and high technology, which delivers benefits to the consumer. So at this point in time, so far, there's no immediate brand in our immediate vicinity which delivers this kind of product benefit. A lot of brands are tapping into the athleisure part of the sportswear space, right?
Okay.
Which is, I've heard brands say we are about wellness and lounge, etc. We are not at all in that space. We are in the athletic performance space, but extending to pre and post sport and a little bit of, how should I say, comfortable wear. So we are fairly unique in terms of our product technology, as well as the price points at which consumers are buying our brand. So I don't know if I mentioned it ever earlier, the average selling price of our shoes in retail is 16,200 rupees. This is probably more than double of even the rest of the international sportswear brands. So we are pretty much at that top of that pyramid and not directly, I would say, affected or impacted by some of the other developments that you're talking about.
Yeah, and then on that note, I would like to ask you, how do, Indian athletes bringing glory at global stage are driving inclination towards this premium high performance gear in the country?
There it's a very straightforward correlation and so many stories that I can tell you. One example is, we've been selling men's leggings. You can see those up there. And nobody would ever buy men's leggings in India, right? In 2022, July, Neeraj, started wearing our gear and then he started competing and then there was Eugene and many events after that. And suddenly the consumption or the purchase of men's leggings zoomed, which is a direct correlation, directly attributed to Neeraj wearing them. Otherwise, leggings were meant to be for women.